By Invesco QQQ. Here we look to awaken your minds to the transformations and technological advancements that are happening across finance, markets, and business. As AI continues to just dominate headlines, this year we decided to focus on the monetization efforts that are taking place around artificial intelligence. So across these 2 days, what we aim to do is really highlight how investors are extracting value from this technology. We're going to talk about the risks and the opportunities across public and private portfolios, and we'll really help identify where that smart money is going. We've got some great conversations happening across these next couple of days and this morning. First, though, I want to make sure we get you set up with everything that you need for this event. So please take out your phones, and yes, I'm going to ask you to silence them in just a moment. But before you do that, please scan this QR code that you see right here on the screen. It's going to take you to a landing page where you can find our agenda. It'll prompt you to download our event app. But with that, you can follow along sessions, receive push notifications, and access digital networking community to really message fellow attendees to set up meetings and more. On this page, you'll also find the Wi-Fi information. And there's also a tab that you can use to click to submit questions to our speakers on stage. Please feel free to do that. It's going to flash on this monitor for us. We're going to get to as many questions as we can throughout the event. If you don't already subscribe to Bloomberg.com and all of our global finance coverage, shame on you. But today's your lucky day because you can get discounts to individual or group subscriptions there as well. And lastly, we are active on social media. And if you are active on social media, we want to hear from you there. So just use the hashtag Bloomberg Invest in your posts, and you can follow along with our coverage at Bloomberg Live on all of the major platforms. Now, generative AI's capabilities in finance are continuously being discussed and explored, but we really wanted to show you just how it can be utilized in the hands of investors. Sig Tech is a London-based fintech. It's spun out of Brevin Howard, and its flagship Gen AI product, Magic, is a team of specialized AI agents that collaborate among themselves and with the user to analyze financial markets. We're going to show you a demonstration of the product now, and then I'm going to pop up back here in just a few minutes to interview the brains behind it. Please welcome him now. Ben Ren is founder and CEO of Sig Tech.
Morning. We all talk about AI every day, but today I want to show you what we have built. So my colleague Krishna is in the back, so we'll bring up the demo. Yes, so our product is called Magic. It stands for Multi-Agent Generative Investment Co-Pilots. It's actually listed on the Microsoft Teams App Store, which allowed us to provide access to millions of users in financial services. So today I want to focus on two things. Number one is we think for Gen AI to take us to the promised land, we need a major UI breakthrough. Because up to this point, people's experience with Gen AI is mainly restricted to chatbots, like ChatGPT, like Claude. But for AI to really make a difference, we have to move beyond that. And that has to be something like a multi-AI agent framework. So Magic is a multi-AI agent framework. The idea is we have a team of specialists. Each AI agent is powered by a large language models and able to access private tools and data sets. Each one is tuned and trained to do very specific things. And because the niche focus of each agent, we are able to eval their performance and make sure they do the job very much to the standard of a human professionals. And once we have the team of AI agents, we can just ask them to do research and ask questions. So we prepare this question, which can be quite interesting and topical. So let me explain what happens now. So the prompt is about analyzing the Trump administration's policies and its impact on the markets. So what's going on here is there is hidden chief of staff AI agent in the background. And that chief of staff interacts with me and translates my questions and problems into a plan. So you can see the plan is made up of a list of tasks. And you can see the tasks on the right-hand side. When I tell my chief of staff the problem I want to solve, each task is automatically assigned by my chief of staff, AI agent, to the corresponding specialist agent that's most qualified to do this job. And while we speak, the team is actually working in parallel, working on different steps of the plan, and in the end, will collate the information and give us response. So this is very different from speaking to, say, ChatGPT, which has one model, which may do web search, but the future really belongs to a system where allow people to build, orchestrate, and utilize a large number of specialist AI agents. The other thing is, you can see when AI agents work on each task, it takes a series of actions. The actions could be reading the central bank policy statements, could be accessing other data sets, but also writing code and access other tools. So I think there's a major trend in the industry of actually converting the legacy systems built for human users to make them available to AI agents. So you see that the numbers here, we also asked about how the Trump policy has affected the market. So in the background, actually, it wrote code to do a back test. So the numbers, the performance metrics are very familiar to all of you, like the Sharpe ratios, Saltino ratios. Those are actually written by the AI agents using code on the fly with access to our data lake with market data. So it's implemented a very simple portfolio, back-tested before and after the Trump administration inauguration date. So this is one way for us to demonstrate how things work. The other one is we have a separate follow-up questions. And Krishna, you can. So this follow-up prompt, which way, by the way, we copy paste from Teams, which is very convenient for our users, is to say, hey, which sectors potentially can benefit from such administration policies? And then we ask the team again to create a plan, work on it, writing code. The truth is, I don't need to worry about direct messaging each of the agents myself. And that's very important. Because think about it, I mean, by the end of 2026, each one of us may be working with hundreds of agents to amplify our daily job. It will be a very unwieldy user interface if I have to basically get notifications and have to stay in the loop with hundreds of agents working on my behalf. So it's really important to be able to build a team and let my chief of staff agent to be responsible for coordination. So that's the major UI breakthrough that we will see between now and end of next year. I think while we run that prompt, the other thing I want to show you, which is probably very relevant to the asset managers and hedge funds, is that we can actually get the team to read a description of a trading strategy, whether it's from a research paper or from the website. And just by asking them to read this article, they will be able to implement it and give me a basic draft and returns of the strategy. So this is something we can run. So here, we've published a blog post about a year ago about how to use VIX options to hedge a long-only portfolio. So VIX options are not the easiest derivatives to work with. So we wrote this article without any code. And we are basically asking the agents to read it and basically figure out what it's about. But in the prompt, we don't say anything, actually. In the prompt, it doesn't say anything about this article at all. So the team has to go, understand it, and implement it on the fly. And Krishna, you can switch to the previous one. I think the ETF maybe came back. Yeah. So we constructed a portfolio of equally weighted portfolio, which is aerospace, financial, gold, and financial sectors. So they back tested the whole portfolio on the fly. Took about, I think, 2 minutes. Entirely on their own. So AI agents, people ask me, what's the difference between AI agents and large language models? AI agents have an objective. So you can assign the objective, then it will pursue it almost entirely autonomously. The other one is AI agents are able to use tools and data, just like ourselves. And on this particular tail risk hedging example, you can see that the agents, actually, if you look at the tasks, one of them went to read the article on internet, understand it, summarized it, pass the information to a quant agent that take that information as a description and implement the entire VIX option tail hedge strategy on the fly. So I hope this gives you an idea about where we are building and where the industry is going. For us to really realize the full potential of Gen AI, a multi-agent system is here and will become the paradigm. So at this point, I will come back, Tim.
All right.
Thank you,
Tim. Ben, thanks so much. Obviously, it's come such a long way in a very short period of time. I just want to start by asking all of you, raise your hand if you're using AI at work right now. So it looks like a little less than half, maybe half of you. What's the risk to these folks if they're not using AI right now?
So currently, we work with clients to focus on workflows that share a few characteristics. I would describe them as intellectual but not creative. For example, one of our biggest clients, they are using us to completely transform the commercial loan underwriting. To be honest, when you are the human professionals underwriting commercial loans, you don't really want to be creative. So it's a very intellectual but not creative endeavor, but it's very boring. The other one is it's very manual because, for example, on the commercial loan applications, each firm has to apply in their own format. There is no standard or template for the application. So each business just sending their documents in whatever formats that they feel comfortable with. It could be a motley pot of PDFs, slides, and Excel spreadsheets. And at this, I want to make one statement which is very interesting, which is in finance, we create documents and materials by humans for humans. So if you look at all these presentations, right, actually the most important information, we actually spend extra time to turn it into a graphic. Right? We want to visualize actually the most important information in our slides because that's how we make an impact on the human reader. But it turns out this information in that format is really not very friendly to large language models. So a lot of our efforts want to make sure that we can actually extract that visual information into a format that we can work with using large language models.
Ben, when I saw you using Magic, demonstrating it for everybody, there was a little font at the bottom that said something along the lines of, this is not investment advice, there could be errors in here, make sure to use independent research, something along those lines. Obviously, I'm not a lawyer. What is the risk with just taking what it spits out and pasting it and giving it to your boss?
I think for regulated services and businesses, the human will stay in the loop for the foreseeable future. The regulators, the entire regulation framework it's human-centric, right? So the regulators want to make sure that someone is staying in the loop and is accountable for the actions and consequences. So in these businesses, AI agents, they can automate a huge amount of work, knowledge work. We have seen people used to spend 6 hours in processing loan applications. Now they only need to spend 30 seconds. That's 200x improvement in speed, actually makes a huge impact, but someone has to be there and supervise. That's why this user interface, UI design, is super important, because as we scale the capabilities of the intelligence, how do we make sure that the human is not overwhelmed by a new type of work?
But how do you know that what Magic produces is correct?
There are actually many ways to do it. First, as the large language models get better, they are more and more grounded. For example, the latest generations of reasoning models, they essentially have built-in self-reflection and self-critique. So the quality of the response is going up. And that's just mainly because of the pre-training and post-training breakthrough by the foundational model AI labs. But on the other hand, as we build magic and build AI agents, we can actually building grounding into it. So as the responses come back, we always want to provide citations, quotes, so the human can one click away from verifying it.
The whole idea behind a product such as this is to give you an edge over your competitors, to find that alpha. But what happens when my competitor asks Magic the same question that I asked? You'll get a result that's the same, and then you won't actually have that advantage?
I think if you ask exactly the same question, you'll probably get some very similar answers. But I do think the nature of the work going forward will become, each individual contributors will become a supervisor. I think that's a fundamental shift in the role, in how we do our jobs. I think today we go in there, most of us are individual contributors. But it's like the transition from a PhD researcher, PhD student to a supervisor, to a research director. The other thing is, I think people will ask different questions. I think people have heard about the phrase prompt engineering for a few years now, but it's surprising to me how difficult or counterintuitive it is to most people. I would say there is no substitute for spending 10 hours of your time on seriously learning how to have a productive conversation, and I try to push the limit of what this model can do or not do. I think the difference is most likely will come down to who asks better questions and who can follow up with better questions.
So it really raises the question, I think, in the financial services industry about what this looks like if it's widely adopted in terms of what it does to workforces and how it changes the way companies think about who they need to hire and who they need to pay. If this does the work that a quant can do in 45 seconds, that would take a quant, 3 to 6 hours, then what do the quants do?
I think the quants will find more interesting things to do. The truth is, I think, if you think about it, up to this point, the technology made a difference only in the field of what we call explicit knowledge, right? We automate stuff, but in order to automate, that knowledge has to be explicit, something we can write down, codify, almost linearly, and then we get people to implement it in Python or some other programming language, then automate it. But there's a huge amount of tacit knowledge that exists, especially in industries like financial services. That's why we have human experts. They are experts because they have knowledge in their head that's based on years of experience, but that's simply impossible to write down in a very codified, simplified way. But now with large language models and AI agents, what we have learned is that for the first time, we can use AI agents to distill these tacit knowledge from human experts into automated processes. I think that's where the breakthrough will really come from.
You told me in one of our prep calls ahead of this panel that by the end of this year, the workforce will likely be half human, half AI agents. You stick to that right now?
I think half, yes. I think by the end of next year, ratio will be, for each one of us, there will be multiple AI agents. So I think by the end of this year, we'll all be very familiar with the concept of a hybrid workforce. By the end of next year, I think that ratio will only keep going.
I mean, you're talking about a fundamental shift in the way that an economy runs here. Contextualize this moment in economic history for us. Is this like the Industrial Revolution? Is it like the rise of the internet and the browser in the 1990s? Where are we?
I think about this in terms of electricity. I think we are very close to a point where intelligence in terms of streaming tokens will be on tap, similar to electricity on tap. Now, I recently looked into it. I mean, it's quite interesting. In the last 200 years, each country, on average, spent about 1% of the nominal GDP on building and upgrading the electricity grid, even today. I think during the New Deal in the 1930s, the US spent about 1.2 of GDP on building out the power grid. Actually, the first power station in the US was built in Manhattan. So 1% of GDP today is about 300 billion. So coincidentally, this year, the big tech companies have already announced 300 billion of investment into data centers. So I think the investment is not over-investment, but it's quite shocking how quickly we ramped up the investment to literally this magic number, 1% of the GDP.
You did say also a couple months ago to me that this tends to move in 3-month increments. The idea being the technological breakthroughs that we see are really happening so quickly, you have to think about the development of AI within 3-month increments. What's it going to look like a year from now?
I think for us to, given the 1% GDP investment, for us to really deliver the promise, we have to see something like 8 to 10% of GDP growth. We have to quadruple our GDP growth.
Here in the US?
Here in the US, in a world where adoption for AI is really, China is very keen to adopt AI for pretty much everything. So, and that's really when I say that's the promised land, that's the promised land, right? That's the promise we have to deliver given this kind of investment. I mean, just to illustrate how fast things have come. 3 years ago, to train the GPT-3, it only used something like a 15 to 30 megawatts data center. It was quite normal. And today, Elon Musk and Meta are building 2 gigawatts data centers, which is 10 times bigger. And for that to work, they have to build everything. They have to build their own natural gas power plant next to it. So the sheer scale of the investment is really unprecedented. But for us to deliver that promise, we have to see in the next 5 years a GDP growth of 8-10%.
You mentioned China, and I'm wondering about the country's ability to pull this off if there are export controls in place on American tech, such as we've seen with NVIDIA. Since we last spoke, everything with DeepSeek happened. How do you look at what's happening in China and whether or not they can become like a competitor to the US when it comes to AI?
I think to scale the intelligence, there are only a few variables. Number one, data. In China, the data privacy is much less a concern. So, and also there are many people generating data. So I would say China probably has an advantage in terms of having access to the quality, the quantity of the data. The second thing is just sheer talent. There are 200 papers in AI published every day. I read some of them, obviously not all of them, but one thing is very striking. You can open a random AI paper these days, about 30% to 50% of the co-authors are Chinese. So China has this big supply of talent. But same in the US. The last one is just compute. All else being equal, intelligence is basically the logarithm of compute. So you increase by 100 times, you get 10 times better intelligence. So I think China and US are really the two countries in the world who are really pushing. It requires sheer amount of investment into hardware, into power, into talent, into data. But this is the first time when we build businesses where people think about the revenues, not in terms of billions of dollars, but in terms of percentage of the global GDPs. So it's really quite exciting.
Hey, I want to bring things back to magic in the last couple of minutes that we do have with you. We're Bloomberg, we love numbers. I know you're still considered a startup at this point, but just give our audience, everybody watching right now, an idea of the types of companies that are using the product. Give us some numbers like how many customers you have, if you can, and where you're seeing it be deployed.
So this version we just showed you actually is 2 months old. In the last 2 months, we built a lot of private proprietary versions for different firms, but I can't show you. But so this one is actually 2 months old. So we officially launched in September 2024. We started 2 years ago. We made a very big bet 2 years ago to say this is the future. We are going to, bet the company on this. Even that took us 18 months to figure out how to do it right, because it's so new, unprecedented. We have to experiment, trial and errors. So we launched in September last year. So we got into the hands of over 150 financial institutions. We are extremely excited about the use cases we are able to deliver. So we currently focus on 3 categories. Number one, macro market research. Just because my background is from macro hedge fund, I know the field very well. People think people use magic to get some magical insight, but funny enough, actually people find it extremely useful to have an understanding of where the market has priced in. It's kind of counterintuitive, but if you think about it, right, since large language models by construction always give you the most likely word one by one, so it's actually a fantastic tool to survey the market at any point in time, understand what other people know, how other people think about it, so what the market has priced in, which is the first step toward for hedge fund managers to figure out, do I have some view that's different and how to put on a trade. So number one category, macro market research. The second is equity fundamental analysis. So we did a big talk on this because in the last 10 years, the number of equity analysts has dropped by over 35%, whereas the public market has become more concentrated than ever before. So we have this very weird dynamic, tens of trillions of capital going to passive. Top 26 companies are responsible for half of the market cap of S&P 500. And I don't think people can name the other 474. So in some sense, we feel like the market has become less efficient, where we need analytical power to cover more companies, but we don't have it. So we're working with equity fund managers who have, by the way, who had a very tough 15 years, just because this concentration in the top stocks. It's not really stock pickers.
The S&P 500 has performed very well over the last
it's very hard to beat.
Or so. It's been tough to beat. You did recently write that AI is going to dramatically impact financial services in terms of cost structure and profit margins.
Yeah.
Give us some numbers there.
Yeah, so we'll put on the slide. So financial services, excluding payment globally, is a $20 trillion business, right? $20 trillion of revenue every year. And we will break it down, about $3 trillion of profits. But then in terms of costs, we think $8 trillion of costs can be hugely affected by what's going on, by what we are building in Gen AI. That includes $5 trillion of staff costs, $2 trillion of risk and regulation related, and then $1 trillion of tech spend. Right? So I think $8 trillion, that's just a starting point.
Are the financial firms that you're trying to sell to, or that are your customers, do you believe that they're being too cautious with their adoption of the technology?
I think they are being very cautious. But again, it's very difficult to make a very clear decision, because just given how things are moving, and it's very hard to get, I think especially in large regulated businesses, to make such big decisions, you need some kind of consensus building in the firm. But by the time you build a consensus in 3 months, things have changed. So I think that in terms of the adoption in financial services, I think it will start with a few firms with visionary leadership that embrace it. And given the speed at which we can implement it, I think within 6 months, they will be able to disrupt the market segment they operate in, and then that will have knock-on effect.
We spent the entire conversation talking about sort of the optimism and the hopes and the dreams when it comes to this technology. Just in the last minute that we have, what keeps you up at night? What scares you?
First, I sleep pretty well these days because I'm so busy. So I don't have many hours to sleep, so whenever I get to sleep, I really sleep really well. So really the only thing that keeps me up is just be able to keep track of the industry. Because I honestly think maybe there are 500 people in the world who actually know exactly what's going on. There are a lot of noise, a lot of hype, sometimes pessimistic views. It's really hard to keep track of. But things are moving much faster than we ever saw. It will continue like this. So we always worry about that we err on the side of being too slow and too conservative, not really pushing the boundaries. We recently automated a very complex workflow by 300 times. That means that this firm, once we launch it, will be able to completely clean up the entire market, because their competitors takes about 8 hours. Right? So we are looking to see the impact of our work And we worry about we're not moving fast enough.
All right, that's good. Better than the machines taking over, so I appreciate that. Ben Wren, founder and CEO of Sig Tech. Thanks so much for joining us.
Thank you, Tim. Thank you.
Good.
January 27th, 2025 may go down in history as DeepSeek Day.
DeepSeek shaking up global tech.
The entire stock market has been really hinging on this AI supply chain. And what DeepSeek threw into question is whether or not that supply chain really needs to be built out as much as the companies have projected.
DeepSeek makes an app similar to ChatGPT or Claude. It'll write code, answer questions, or script an empathetic breakup text. And what's extraordinary is its apparent quality and low cost.
DeepSeek revealed that it was able to outperform the leading US AI companies at only a fraction of the cost.
It's also open source. Developers can inspect the code, modify it, and run it on their own servers, even for commercial use.
The release of DeepSeek AI from a Chinese company should be a wake-up call.
Washington, for a number of years now, has been restricting China's access to cutting-edge chips, which they thought would hold it back significantly in the AI sector.
There are a lot of people now in Silicon Valley trying to decipher how exactly DeepSeek was able to build this model, whether it used technology from other companies, and whether it used more chips than it's let on.
I don't think there's a clear answer to that yet, but I do think they have shown, in the research that DeepSeek has published, that they have been able to, come up with their own innovations here, and they have been able to really be efficient with the technology that they do have.
Please welcome to the stage Marc Mahaney, Senior Managing Director at Evercore ISI, and Solita Marcelli, Chief Investment Officer for Americas at UBS Global Wealth Management, for a conversation with Bloomberg's Danny Berger.
So much for joining. I'm really excited for this panel, and that was a great intro video to get us all excited about DeepSeek Day and the ramifications. We're not exactly going to start there. We're going to talk about the wider AI picture. Marc, Solita, thank you so much for joining this morning. Look, it's been a bit of a tough run for tech so far year to date. The Mag 7, it's down more than 10% in the past 2 weeks. NVIDIA is down 15%. Solita, if I can start with you, the tech leadership, the AI leadership of this market, is it broken or bent at this point?
Not broken. Maybe let me start with, so coming into this year, we have been advising our clients that we're bullish on artificial intelligence, but we should expect volatility. And of course, we were 2 years into this rally. You have, uncertainty around the political environment. And of course, we got that volatility, right? And probably will continue to be here for a little while. But our views actually has not changed. We are still bullish on the broader AI theme. And technology, in fact, is our favorite sector. And US, in particular, is our most preferred region in our portfolios. And there are a couple of reasons for that, right? And one is, I think the DeepSeek news is a positive overall for the AI story because lower costs lead to wider adoption. And that's pretty much has been the tech playbook throughout history. When we look at cloud, for example, Amazon sales went from 5 billion to 100 billion over the last decade, despite prices falling significantly. And also, I think this big spending on AI from the big players is not stopping anytime soon. In fact, we have revised up our CapEx expectations from the big four, not down. And structurally, I think the US AI leaders are very well positioned going forward. They're still delivering robust earnings growth. And structurally, they're operating across the AI stack. They're sitting on piles of cash. They have mountains of data. From month to month, it's hard to predict who's going to be leading the market. Right? Even within Magnificent Seven, there are some names we like, other names we don't like as much. But I would say, these companies have are really well positioned. Now, one thing I would say is, all of that said, it's not U.S. tech, and it's not the only game in town, right? We like other things. We like industrials and, we like healthcare and financials in the U.S. There are things we like in Europe and Asia. So it's not like U.S. tech and nothing. It's U.S. tech and other things, and we're much more balanced right now in our portfolios compared to 6 months ago.
So, Marc, Salita there mentioned one of the companies that you cover. Not sure which mic is working for me at this moment, but hopefully you all can hear me. Salita mentioned one of the companies that you cover, which is Amazon. And look, not all the internet companies are down. Meta is an exception, but a lot of the firms that you cover have fallen so far this year. Can I get your take on what you make of that sell-off and whether this is just a buying opportunity?
I think it's probably a healthy thing that we've had a bifurcation in stock price performance, because we've had a bifurcation in some of these companies' fundamentals. Mag 7 there's some very different business models, very different markets in there. So if they were to all to trade the same, that'd be, I don't think that would be healthy. They're not trading the same. So maybe there's something in there that's good. The setup also, just so we remember, and Salita mentioned this too, we've been in a two and a half year bull market for tech. And it started when the interest rates spiked from 0 to 100, ended in the middle of 2022. Since that point, in the middle of 22, we've had a phenomenal surge in tech stocks. It's been a risk on market, and especially for the highest quality names, not for the lowest quality, for the highest quality names. So I've looked at names like that I look at, like Amazon and Google and Meta. And then there's a series of names under that, like Netflix and Spotify, that have done phenomenally well, and DoorDash, and even Uber, that have done phenomenally well in that time period. That brought us to going into this year where multiples were pretty reasonable. I thought there was only really one dislocated name, high quality stock that was dislocated. I call them DHQs, and that was Uber. And it's performed great year to date. It's only 2 months, but it's up 20% year to date. We've had names like Spotify up almost 30% year to date, and Meta is up 12%. So I think the market's kind of discerned these companies reasonably well year to date. Google is underperformed. There's a lot of overhang issues on Google. There's regulatory issues, and then there's sort of relative underperformance, and I mean fundamental underperformance. The growth rate of advertising revenue at Meta is 2x that of Google. So one of the companies is doing great, the other company is doing good, and the stock should bifurcate, and they are. So I find a lot of this sort of healthy. And I know there's a huge amount of political uncertainty, and these companies also have dramatic international exposure, so that the global uncertainty just adds to these volatility in these names. But what I see so far in the market year to date, I think is reasonably rational.
Well, let's maybe get into that. And so, Lita, if you look at the market action, should I do all three mics maybe? There we go. Okay. So, Lita, if you look at the market reaction just yesterday, you get ISM comes in poor, you get announcements that tariffs will indeed be put on. It wasn't necessarily the international manufacturing stocks that did the worst. They, of course, sold off. It wasn't necessarily the importers that did the worst. It was tech stocks. That was the worst performing sector yesterday. What do you make of the macro of it all? The fact that we're having these macro, I guess you can call them mini shocks happening in the market, and that it's tech, it's AI, it's NVIDIA that seems to be faring the worst.
Yeah, look, I think we have seen the rotation in the market since the beginning of the year, right? And I think there's a continuation of that a little bit. But let's not forget, people are kind of selling things that have done the best, right? So taking profits and maybe reducing some of their position, not necessarily because they think things are worse in that industry, but sort of like reducing some of the risk in light of the fact that there might be some level of growth scare. The way I look at this rotation, sort of the American exceptionalism we have experienced, in the US, right, the starting point has been different than the rest of the world, driven by technology. We had euphoria in the market around the election and post-election, number one. And since then, that euphoria is coming down because you have obviously a lot of policy, uncertainty, tariffs, export restrictions. You have some mixed data, not bad. I mean, let's put it this way. It's not like the market is down 10% year to date. So you have a different starting point. The rest of the world, the sentiment was so bearish. And since then, you're hearing more pro-business sentiment from China, maybe on the margin, better fiscal stimulus from Germany. You have potentially maybe earlier end of Ukraine, and then global manufacturing numbers have come in better. So, and when you see that rotation, naturally the tech stock gets hit first, but I think this could last probably another 2-3 months, but I don't think that's a 2025 trade. It's maybe another quarter.
Marc, I'd love to get your thoughts on this as well, whether what we are seeing is just a rotation, to Salita's point that these were very loved stocks, or whether there is something to this new normal that we're in, where tech companies have gotten political, that at the inauguration, lined up behind President Trump was the CEOs of many of the companies that you cover. If they are more vulnerable when it comes to geopolitics in this new world where they have embraced Trump.
Okay, boy, there's a lot in there. I don't at all mind.
Take your time with it, Marc.
Yeah, I don't at all mind making political statements that just seem like smart business sense to be honest. Although I don't think we've ever seen an inauguration where we had the leading business leaders. Somebody can correct me on this, and maybe 100 years ago it happened. I don't recall it in my lifetime seeing that. So I thought that was pretty unusual, but maybe savvy on the part of these companies. And they know that this administration can be very volatile. He said all along he was going to be tariff man. Well, here we are. It shouldn't be that surprising. He's for good or for bad. He's true to his word, and I think these companies realize that. They thought it'd be better to get in his good graces rather than his bad graces. I'm not sure that's good for all of us, but it is the reality. And then, and I think about what would have we lived with in the past? Remember the sharp sell-off we had in tech in the fourth quarter of 2018. If you go back, I remember studying this once on Amazon, stock to trade off 25%. I remember going back when I was writing a book on this, trying to remember why it corrected so much, and then I realized, oh yeah, China tariffs, Trump. So the administrative decisions can occasionally, especially if you go big tariff, and maybe in regulation, you can have a real impact on these companies, not on their fundamentals. Amazon's fundamentals didn't change at all, but certainly on the multiple that the market's willing to pay, at least for a short period of time. We could well go through something like that now. The good news for investors in some of these names is that there's a heck of a lot of valuation support. Salita mentioned this earlier. I mean, you've got rock solid balance sheets, companies that are paying dividends, not Amazon, they should. But other names like Google and Meta, they're paying dividends now. They weren't back then. They're trading at 20, 22 times earnings, close to a market multiple. They're gushing free cash flow. So you're going to have less fundamental volatility. You can have maybe more stock volatility, and that should create, I mean, you trade off Amazon right now 25%, it'd be a screaming buy. Same thing with Meta and same thing with Google. Calling the bottom on these things is impossible. But these we've seen this before, and so that's the only guidance I'd give to people, which is, look, we came into the year with valuations reasonably normal. I considered them compound. These were, we consider ourselves compound constructive. They hold the multiple, the stock goes up 20% because the earnings go up 20%. Hey, great. It's not that you're still looking for these dislocated names. My guess is that we're going to get more dislocation, unfortunately. But then, if you're a patient investor, these are the moments you wait for. So my guess is that we're going to get more it's going to get more dislocated than less in the next month, and that's going to create good opportunities because I don't think the fundamentals have changed. Salita mentioned this earlier. There are companies here that are leaning heavily into AI, and I think they're getting a good ROAI, return on that artificial intelligence spend. And I'll talk about some examples later, but I can quickly click off. When Google tells you that 25% of their code is written by AI, that's an enormous cost savings. When Amazon is telling you that they now have a 25% lower cost to serve in their most advanced distribution centers because of robotics and automation, that's a really good sign. And then, I live in San Francisco, and I see the ultimate AI machine roaming around our city. There's 700 of these Waymos, and I think there's some wonderful innovations that are coming because of AI, and I think we're going to see more evidence of this ROAI. So at the margin, I'm more bullish on the fundamentals of the space, and if I'm just, we're waiting for these great dislocations. It never feels good, but I think they'll create opportunities.
Well, I think we only have about 5 minutes left, so I do want to end with basically where we started, which was DeepSeek. The fundamentals don't change based on the geopolitics. Salita, did DeepSeek, a cheaper model coming into the fore, presumably is more efficient, does it change the fundamentals for U.S. tech at all?
I think it changes in a good way. Like I said in the beginning, I think doing things cheaper increases wider adoption, and that's part of our thesis. But I just want to make sure I say this right. Like, DeepSeek was a huge engineering feat, right? Because they created a more efficient model. But it's not necessarily development feed. And those companies that want to keep on innovating, that want to break ground in the space, will still have to continue to spend, right? I mean, I think that's an important distinction. Yeah.
Yeah, Marc, I wonder your take. Are we going to look back at this moment and say, Microsoft and the hyperscalers, they all spent too much on CapEx and they should have known with DeepSeek and they should have pulled back? Do you think that that's a risk? Did DeepSeek change anything for the companies that you cover?
My guess is that if you're at the app layer, and Meta's the ultimate app layer stock, they're not selling LLMs, they're not selling cloud services. Anybody who comes across with more efficient, better, more productive, cheaper large language models. And then, it's open source, so you can look and see some of the hacks, and I mean that in a positive way, some of the tweaks that they made that allowed them to inference more cheaply, to develop these models, to develop the model more cheaply. I mean, that means that your cost of operations are potentially materially lower long term. That's a really great thing. I don't think these companies are going to cut back on their CapEx spend. It's well possible that they'll generate even more product, and names like Google and Meta and Amazon, more personalization, more targeting, better targeted recommendations, better services for advertisers that advertise on those platforms, better campaign management, measurement. Like, I just think at that level, you've just anybody. It's an infrastructure improvement, and so the companies that buy the infrastructure benefit from that. So that was my take on DeepSeek, which is that this is a long-term benefit for some of these names.
Just to wrap things up here, I'd be remiss if I didn't do this. I just want to get both of yours top picks. I know, Salita, you're not going to give us individual names, so that's okay. You mentioned this a bit at the start, but what are your favorite sectors and regions now?
Maybe I'll just, so US is our favorite region. Technology, we like financials and healthcare in the US. We like Germany. We like Chinese internet companies. But I would say on the AI, since that's our topic, our view is that it's really important to get exposure to AI across the entire value chain, both the enabling layer, application, and also intelligence. Now, over time, we think that the greatest value creation is going to come from application. In fact, we're already seeing, from a cost-saving story perspective, companies making headways. If you're a company that are spending a lot of money on administrative tasks, 15% productivity gain would make a huge difference. And we expect revenue and monetization to pick up this year as well. But we're still in the very early innings of that. So in the near term, we're tilting a lot more towards the enabling, so the infrastructure, chips, power, data storage, et cetera. So if I had $100 to invest in AI today, I would put 55 in enabling infrastructure, 30 in the application, and the rest in the intelligence layer.
Marc, where are you putting that pocket change of $100 in the companies you cover? What are your top picks?
I'll give two top picks, Uber and Amazon. I already mentioned Uber earlier. I think the bear argument on Uber is that there's only going to be one or two AV vendors, robotaxi vendors, and that they're not going to work with Uber. I don't think that's true. I may be wrong. And look, if all the world goes to Waymo, it's bad for Uber, and this stock call is going to be flat out wrong. But what we got today, if anybody lives in Austin, Texas, Waymo's available to you starting today on Uber's network, and I think we're going to see more of these type of partnerships. So as long as robotaxis are on Uber, there's a huge win, and it's a company that's generating 20% top-line growth, expanding margins, they're trading at half of their free cash flow multiple. This is the only truly dislocated, high-quality name that I see right now. So Uber's our number one pick. Number two pick is Amazon. I think they're going to be a winner off of this, the dramatic increase in demand for cloud services because of the deployment of AI at all levels, but especially at the app level. 2 years ago, with the launch of OpenAI, there was a belief that Microsoft was going to be the winner in cloud services because they had the AI partnership. Well, that narrative is changing, and if it becomes clear a year or two from now that organically that the fastest growing AI cloud company is Amazon, that stock is going to go up materially from here. And then secondly, there's another theme tied into AI, which is robotics. And I've talked with investors who are looking for ways to play the boom in robotics. I have a great example of one. Amazon. They're probably the single largest deployer of robotics worldwide, and it comes through in the P&L. That's why their operating margins in their retail business now are moving up really aggressively. So Amazon's our number 2 pick, Uber's our number 1 pick.
I'm very impressed. We got through a lot of topics in 20 minutes. Unfortunately, that's all we have time for. Everyone, please join me in thanking both Marc and Sonali.
Thank you.
Please welcome to the stage Lynn Martin, president of the NYSE Group, for a conversation with Bloomberg's Carol Masser.
Are we awake? I had just pulled up, both Lynn and I were doing this before we came on. Right. This is my Bloomberg app. There's a fair amount of red. We're down about 0.9% on each of the major averages. It was a little bit worse before. I was thinking about 2 years ago, I think we're on the Invest stage, and the title of the thing, our discussion was Market in Chaos. Are we in market in chaos right now?
No.
Okay.
Markets go up and markets go down. Today it's going down. Yesterday it went down. But remember that the S&P and the Dow in particular are still above the pre-election levels. So remember, there was a big euphoria that occurred post-election day in the market. So,
which was maybe overdone at that point?
Potentially. Yeah. Potentially. I mean, markets recalibrate.
So I was thinking about yesterday, CoreWeave, backed by NVIDIA, cloud computing provider. They filed for an IPO. Bloomberg reporting it could raise $4 billion from the listing. It's expected to target a valuation greater than $35 billion. We are expecting kind of a wave of potentially sizable listings this year. On a day when the market sold off, it was the worst sell-off so far this year. What was more interesting to you? Was it the sell-off or the CoreWeave listing?
So what you will see now are companies start to flip public. But it's a timing thing. What most people don't appreciate is if you're a private company, your financials go stale at some point, so you need to restate financials. That's what happens between sort of that mid-February to end of February when you get your audited financials for the previous business year. So I anticipate, based on our pipeline, we're going to start to see some companies flip public. We had one flip public called Mountain on this past Friday.
Are you hearing from companies? You're busy.
Yeah, we are busy. We are busy. We're busy not just from the perspective of working with our pipeline to actually get them out the door, so in execution mode, but also we're very busy in terms of pitches.
Are you
where companies are, making plans? They're making plans for more like second half.
Sizable ones, smaller ones?
Yeah, decent sized ones, mix of both.
Now, are you worried though about our world is day to day, where whatever comes out of Washington, whatever executive order, whatever press event happens from the Oval Office, because it moves markets, Are you concerned about what you're hearing now and what seems to be optimism for IPOs, that could get derailed?
The only way that I think it's going to get derailed is if the volatility in the market becomes outsized. And I don't think it'll get derailed.
We've moved up a little bit, but...
We've moved up a little bit, but, a VIX around 20 is still fine.
So is there something, though, the president could do?
I don't know. He seems to be very focused on 3 key areas, or this administration's focused on 3 key areas: border security, resolving the wars that have sadly overtaken other nations, and our economy. And what you're seeing right now is the confluence of all 3 come into the fore and start to affect policy.
It's a lot.
Yeah, it is.
What about the rate environment? Because we have seen the U.S. Treasury curve move down significantly. It's been interesting the last few days. If we see that move down. I guess there's a couple scenarios, right? Moving down without a recession, better, especially for the IPO market. Like, tell me some of the other factors that you think about that will determine what happens this year.
Well, I mean, if you also look at the rate environment, that's going to affect mortgages, it's going to affect loans, it's going to affect other parts of the ecosystem. You look at the bank stocks, for example, they're doing quite well at the moment. That's probably more to do with promises on the regulatory side as opposed to the interest rate side. But there are a variety of other parts of the ecosystem that would benefit from a lower rate environment. So we'll see. What
do you think about the private equity world in terms of finally looking to spin out some of their investments?
Yeah.
It's not been an easy environment. We know that Carlyle telling Reuters, I think it was yesterday, we're looking maybe for $4 billion worth of maybe, investments coming out. What are you hearing, or what are your expectations? Do we finally see some of the private equity investors somehow, either IPO, selling assets? What do you expect?
Yeah, we've seen a couple of sponsor-backed deals go out last year. Actually, Standard Aero was one that did particularly well. That was a Carlyle deal that did particularly well in October of last year, raising north of $1 billion and trading really well in the secondary market. I think the more deals that get done at good valuations and raise good amounts of capital, and then importantly trade well in the secondary market, given the liquidity and demand from investors, I think you'll start to see some of the sponsors start to float their aged assets or look to the M&A markets. So it's not just about IPOs.
Right.
I mean, this administration's also promising a more favorable M&A environment, which is another area that's attractive to sponsors.
Lynn, one thing I wanted to ask you, the NYSE IPO index is down about 5%. That was as of yesterday's close. Bloomberg reporting about a couple of weeks ago how 3 of the U.S.'s 4 largest IPOs this year have traded below their offer price in their first session. So many would consider that black.
It's been a quiet though.
Does that tell you that they shouldn't have gone public, that they went too soon?
No, I think there's just a question on the valuations maybe, but sometimes that happens.
Yeah.
First of all, there's been very few deals that have gone. We've had a couple of deals that have done really well. If you look at Flowco and Carmen, space and defense, those are in industries that are very attractive to investors at the moment. They've done really well. It's a bit of an art that the bankers have to do, though, figure out the right valuation mixed with investor demand. The companies that are trading below, they haven't had their first earnings calls yet. I mean, let's see where.
You're saying be patient a little bit?
Yeah, it's not an instantaneous. It's not an instantaneous judgment on a company. Let's see how some of those companies do, particularly like a Venture Global, who's really well positioned in the LNG markets and all the infrastructure moves that are taking place in this country.
We've got 2 minutes. There's 2 things I want to ask you. In 2021, the U.S. IPO market hit a record high. There are some expectations that we could get back to pre-pandemic level. On the record, do you think we could get there this year?
I think 2021 is an anomaly. I think 2022 is an anomaly. I think those are 2 ends of the bell curve.
Yeah.
Positive and negative when you consider, depending on what your perspective is on 21 and 22. I think we'll get back to a more normal IPO environment where companies raise an aggregate about $50 billion, and there's a good number that actually go out. We would have gotten there last year, I think, if we didn't have a pause in the summer, which we saw, which was all sparked by the election and uncertainty around the election. So if you had asked me last May or June, I thought we were on pace for a pretty normal IPO year for 24. Right. So I think we'll get there in 25.
The other thing I've got to ask you, there's so much money in the private world. I mean, just this week, Anthropic closing a deal to raise $3.5 billion at a valuation of $61.5 billion. OpenAI, meantime, currently in talks to raise $40 billion, SoftBank, other investors for an even larger $300 billion valuation. I could go on and on. Yeah. How does that hold back the IPO market? That especially, I don't know, is it just the AI world that is able to tap it in your view?
I think when a company comes out, they are more ready to be a public company. By more ready to be a public company, I mean you've got durable growth. You can articulate a very clear strategy, a very disciplined P&L.
So this is a good thing?
I think it's a good thing. I think the private markets and the public markets have to work in concert.
All right, so we have 13 seconds. This is what we call a super rapid round. Okay, what's the most optimistic view for the IPO market this year?
Most optimistic IPO, I think you're going to have a normal environment. Last year, if I look at the companies, the most important thing that I look at is the secondary market for IPOs. Yeah. Companies that listed on the New York Stock Exchange traded 58% above their IPO price. So I think we're going to hopefully see that type of growth in the secondary, just post-IPO market this year.
All right, last question, the flip side to that is what's the biggest risk
So
to
the biggest
IPO
risk
market?
is volatility, the things that are unexpected that happen in the market from time to time. I don't have a crystal ball. I don't know what that's going to be. Unfortunately, I don't know what's going to cause that unexpected shock. But I think the market does recognize those three pillars: resolving geopolitical conflict, border security, and focusing on a strong domestic economy. So as long as the administration stays within those three pillars, I don't know that there's much that's going to derail things.
But the risk sounds like it'll come from Washington.
I actually have no idea.
Okay.
It could be, I mean, you look at something like DeepSeek. I heard the folks right before, the panel right before this talk about DeepSeek. That was a big surprise that caused the market to react pretty negatively when those when those usage numbers came out. That has nothing to do with anything that's happening in DC.
You know someone's great when you just want to talk for another half hour. Lynn Martin of the NYSE Group. Thanks you so much. Thank you, everybody.
Thanks for having me.
So appreciate it.
Thank you.
Don't you dig it? And those collard greens, a little hot water, cornbread. I love you too, cat daddy, but don't you let that go to your head. That's what I'm talking, baby. You know I like spirituals and rock. Sarah Vaughan, Johann Sebastian Bach, Shakespeare, Maya Angelou, and Nikki Giovanni, just to name a few. Well, I'm warm and peaceful, Lady T. I got to keep my irons in the fire. You see, I got the points, the scams, the
Please take your seats. The program is about to begin. Please take your seats. The program is about to begin.
Global trade disruptions, inflationary pressures, the race for artificial intelligence supremacy.
DeepSeek really rattling, it feels like, every part of that supply chain.
And what an unpredictable Trump administration could bring next.
The golden age of America has officially begun.
Investors right now face uncertainty at home and abroad. From Wall Street to Main Street, every move counts. We'll look across public and private assets, crypto and wealth management, deal making and capital demands, and where the risks and opportunities lie. Bloomberg is here to track, dissect, and navigate the markets alongside the industry's most influential voices. Welcome to Bloomberg Invest.
Please welcome to the stage Sonali Basak, anchor and global finance correspondent for Bloomberg.
Good morning, everybody. What a day to have you here. And after planning this for more than a year, I could not have imagined that these would be the conditions that we are speaking under. As we're speaking here today, the market is pretty jittery. You're looking at an S&P 500, if you've looked at your terminals today, that has wiped out $3.4 trillion in value since the election. It has wiped out all of its gains. Of course, we've met a key tariff deadline this morning, and the market is also pricing in not one, not two, but now 3 rate cuts before the end of the year. So we're in a very fast-changing market, and so we're going to bring you a lot of people who have perspective on just how to look through it, whether things are going to go up or down from here. Now, we've been saying it's a complex time, global economy is rapidly changing, also a lot of questions now about how much capital is needed to fund an artificial intelligence boom. And also, we're going to talk about this a lot through the next 2 days. Investors are looking a lot to private markets for diversification and changing the ways that private markets get to a wide array of investors. Now, we brought together some of the biggest names in wealth, in asset management, deals, and private markets over the next 2 days, and it's the perfect group to set the stage for another pivotal year in markets. Before we get started, I would like to acknowledge our title sponsor, Invesco QQQ, our presenting sponsor, Mass Mutual, and our supporting sponsor, TIAA. Now, we very much encourage you guys to participate, so take out your phones first, put them on silent, and then scan this QR code. This is going to be very handy for everything about this event. On the landing page, you can find the agenda. It will prompt you to download the event app, but there you can subscribe to sessions as well. You'll get push notifications as you need them. You can also take part in digital networking where you can message fellow attendees to set up meetings while you are here. So just type in the special code to access that. You can also find what I think is very important, your Wi-Fi information. There's also a tab where you can click, and this is my favorite part, to submit questions to our speakers on stage. I promise you we will do our best to get to your questions as well. And additionally, if you don't subscribe to Bloomberg News and all of our global coverage, today is your lucky day. On this page, you can click to enjoy discounts to individual subscriptions or group subscriptions and discounts for them as well. If you are enjoying the event, if you have your own thoughts or just want to spread the word across social media, where I'm very active as well, you can follow along with our coverage under the hashtag Bloomberg Invest. You can add us on your posts as well. You can tag us at Bloomberg Live. Now, let's get started. And before we welcome my first guest, please enjoy this short video showcasing just a little bit about what he's been up to this year.
Clearly, private markets are playing a much more significant role in company growth. Our record performance demonstrates our ability to mobilize across the firm and deliver long-term value.
Please welcome to the stage Harvey M. Schwartz, CEO of Carlyle, for a conversation with Bloomberg's Sonali Basak.
I never had a video before.
Well, glad to make you one. We do a lot of those here at Bloomberg. Welcome.
Sonali, great to be here. Great to see everybody.
So not only are you running one of the most storied private capital firms on the planet, you were also at Goldman where you navigated very tough moments from the C-suite, including in the wake of the 2008 financial crisis. So you've seen a lot in markets, a lot of ups and downs.
Yeah.
How do you look at the environment that we're in today?
Well, again, it's great to be here. Congratulations on what's going to be an extraordinary event. I think it's my birthday next week. I'll turn 61. I think in my lifetime, the trends geopolitically have been extraordinarily favorable. And I think that certainly some horrific things have happened. But if you think about the Berlin Wall, globalization, and I would say that this is the first time we're really entering a period of what I'll call geopolitical economic tension. And so let's just pause on that for a second. Coming into the election, there was a lot of uncertainty. I mean, it seems like a long time ago now, but if you think back to the fall, there was uncertainty about whether or not we would have an outcome certainty around who the new administration would be. The administration ran on a policy very pro-business, pro-growth, all the factors that support that. And so markets reflected that. And I think there was this huge relief factor in knowing that there was certainty in the administration. It was a sweeping victory, consolidated government, and an ability to execute. Now, tariffs were always in the discussion. What's happened now is, and the markets are obviously reacting to it in a fairly material way, is we're starting to see what is the full policy mandate going to look like? And the reason I started with geopolitical economic uncertainty, and obviously we've had geopolitical uncertainty with the tragic war in the Middle East and the tragic war in Europe, but the geopolitical economic uncertainty, it's a new information set. And the opinions on tariffs vary from they're incredibly inflationary to they are potentially contributing to a recession. And so it's a bit of now uncertainty. And what the election originally people grasped to was certainty. Markets like certainty. And so now we're in a period of uncertainty, and I think you're seeing it in the risk reduction that we've seen over the past several days, and obviously this morning also.
When you look at what's happening with the tariff strategy, I'm guessing this kind of comes into part of that geopolitical uncertainty. At what point are you worried about it crossing over into a tariff war? Is this all kind of par for the course what we're seeing right now, or is there a risk of serious escalation?
Okay, so tariffs are a complicated subject that doesn't really get unpacked very often, so let's just try and do it super fast, given the time constraints. But if you think of tariffs, let's just split the conversation into two things really simply. One would be, let's just say, economic policy incented tariffs, which can make a lot of sense. We have the lowest tariffs in the world relative to other countries. And then you have tariffs that are motivated by, let's say, political objectives, social objectives. So first of all, you have to unpack the two. This bucket, I think, can be reversed much more quickly. We've seen that in discussions and negotiations. This might be stickier depending on what's happening. But in terms of, and you asked, your language was perfect, Sonali, because the real question is, are they inflationary? And a one-time tariff, let's just say 25% on a country, a one-time tariff is a one-time step up in price acceleration. But it's not sustainably inflationary. Trade wars are sustainably inflationary because then, of course, you could perceive a 25% step, 10, 10, 10. And I think that's what the market is now responding to. But what the market's really responding to is increased uncertainty because we just don't know where the tariff discussions are going to go. It's too early.
To the point you're making on uncertainty and the earliness of the conversation, how do you think about this as it pertains to your business? Do you have to make changes? Are there portfolio companies that are structuring differently? Are there deals that you can't do right now because you don't know what the tariff impact is going to be?
So the vast majority, so for those of you not as explicitly familiar with Carlyle, we're $440 billion of assets. We're one of the largest private capital managers in the world. That's split across real estate, private equity, credit insurance, which is our largest segment, and our solutions, secondaries, and co-invest business. We're micro-investors. So as micro-investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. So we don't, when we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. And so, yes, now in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, we have, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself, but in our portfolio companies, we roll up this data every month. For example, in the PMI yesterday, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
So what are the things that you see now that investors are going to see 4 months later?
So today, nothing about today looks dramatically different than 3 months ago. By that, what do I mean? EBITDA growth is quite solid. Earnings are quite solid. The factors around input pricing, there's still marginal pricing capacity. And demand seems quite high. The consumer seems quite resilient. I think the administration inherited quite a stable economy. You know, inflation obviously not exactly where the Federal Reserve would like it, but it's come down dramatically. And so the environment feels quite good. Now, in terms of what we're seeing in that data, there's nothing suggesting today that the economic underpinnings of that have shifted dramatically at all. What you're starting to see, though, are the things I just described, which is preemptive actions around how best to position, again, around the uncertainty. the way I would describe it is for a long period of time, geopolitical economic risk tails were very tight. They're just fatter today, and we'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean. But this uncertainty factor obviously is affecting markets.
You started to hit on this a few minutes ago about inflation and worries about the impacts that tariffs would have on inflation, one time, more persistent. Where do you see the direction of travel? More recent economic data has created some cause for concern among investors.
Yeah, so first of all, we just came through an unprecedented period. And I got to give, and I know the debate around the Federal Reserve happens a lot. It always surprises me because I think the Federal Reserve and Jay Powell have done an extraordinary job navigating a massive spike in inflation. We went through an unprecedented period of rate hikes. There was a big audience calling for rates back to zero. I have no idea why anybody would want rates back to zero. Rates back to zero is not a normal way to run an economy, and we certainly shouldn't be wishing for that. In terms of getting inflation down, that's a very, very difficult thing to do. And I think the Fed has done an extraordinary job. I think at this point, given we don't exactly know how the tariffs will ultimately settle, I think the inflationary question is a bit uncertain. So what I mean by that is there is a path where you could see a one-time bump in prices, assuming there's no trade war and no future escalation, that will translate through the system as higher prices. It may also cause some demand destruction, which longer term would be deflationary. And you actually could see the economy experiencing stress as it goes through that. So I would say that all the parameters around forecasting inflation, forecasting interest rates, I said, again, I just think we should all buckle up a bit because markets will be more volatile, super data centric, probably too data centric because you can't extrapolate one data point to the future, but it's going to be a sort of a wait and see. I do think the administration will be very sensitive to pro-growth policies, and so I think they'll be watching also.
So with that push-pull going on, what you're looking at is a market that has changed so drastically in terms of rate cut expectations. You had a number of investors feeling like maybe you might get a rate hike this year coming into this year, but market consensus, now you have shifted from maybe 1 rate cut to 3. Market pricing overnight went to 3 rate cuts this year.
Yeah.
Does that make sense to you?
So we were never in the camp. You and I had this discussion 2 years ago. We've never been in the camp that the Federal Reserve was going to cut rates aggressively. Our strategic economist has really nailed this. Jason Thomas, if you don't read his work, you really should. I've worked with some extraordinary people in my career, a real privilege, and he's extraordinary. But he has the benefit of rolling up all our data. So he's been saying for a long time rates were stickier. I just spoke to him before I got on the show, and he said, listen, it's more complicated now to have a very firm opinion. Again, period of uncertainty. But it's not surprising to me that the market has shifted to this because of the unknown around tariffs. And I think what the Federal Reserve has proven to us is they're very data-centric because they know they're in a situation that is somewhat novel. So they're going to be very data-centric. They're going to do what they need to do. So if you see inflationary pressure, they're going to moderate up. If you see deflationary pressure or a slowing of the economy, I think the Federal Reserve, one thing they've proven to us now for a very long time, they know how to cut rates, and they're going to cut rates if they need to. But it's not surprising me that the market is forecasting more of that. But also, we were sort of shocked when they were forecasting 5, 6 cuts, and we were calling for 1 or 2.
So I want to back out for a moment because coming into this year, there was a lot of investors saying America first. And you saw the broader market really reflect that trade. That has changed. You have seen a lot of money flow into international markets. Carlyle is a global investor. Is American exceptionalism at risk?
I wouldn't bet against America. If you go back to the 90s, when in the mid-90s, the European Union and the United States had the same GDP. Here we are 25, 30 years later, we have $10 trillion more of a GDP. There's a lot of fundamental reasons for why that occurred. We don't need to go through them. I think that as a global firm, we see opportunities in lots of places. So we have taken in the past several months 3 companies public. Standard Arrow in the United States. We just 2 weeks ago took Hexaware public in India. It's the largest private equity-owned company to ever go public in India. We took a company called Rigaku, which is an X-ray technical company in Japan public. It's the largest ever private-owned equity company in Japan. all of this in the past 6 months, and our portfolios have gone up $5 billion in value, and we've returned a lot of value to clients. I would say that, is it surprising that after the S&P was up 50% plus in 2 years, and the rest of the world had lagged, that there's been more capital moving overseas? No, I do think that if you're going to have a European Union that's going to be very focused on, for example, defense, which is not a surprise to us. We've had an aerospace defense practice for a very long time. On the heels of all the global conflict, defense is going to be a sector that's going to grow secularly again for a very long period of time. Regardless of tariffs, it doesn't matter. And so in a period where you go from geopolitical and globalization to less globalization, you're going to have increased spending on defense. So you're going to see defense stocks go up in the U.S. I think it all seems quite rational to me. But no, I wouldn't bet against America.
So I want to shift gears a bit now, because there is this dynamic going on in the markets where you have, of course, the public markets, and then you have the private markets, which, of course, you operate well, and you've kind of operated many times through both throughout your career. So in the mid-1990s, there were more than 7,000 companies. Now there are less than half of that. Many people talk about that being the dynamic of the situation we're in. Nobody talks about what the implications are. If you have such a vast private market, what do you do with that? How do you get more investors access to that?
So you nailed it. I mean, if you went back 20 plus years, there were twice as many public companies. I think there were 8 times as many public companies. If you went back even farther, now there's 2.5 times as many private companies. And the private capital formation has been a trend that has been incredibly persistent for lots of very meaningful reasons. And it's secular, it's not going to change. Any prediction in terms of the sustainability and durability of private capital suggests it's going to keep compounding at 10%. So it'll be a $25, $26 trillion market before we blink in terms of private capital. Now, what's happening is there are a lot of forces in the system that are driving more capital to private markets, demand from insurance clients as they look for private investment grade. And of course, the biggest factor is, and a lot of you are involved in this business, is what's happening in wealth. And really, if you look at whether it's 1%, 2%, 3% of portfolios in wealth individuals' portfolios today managed by people in this room, then if that grows to 5%, 6%, 7%, we're talking about an enormous trend. And I think the stats on U.S. pensions, for example, 40% are in alternatives. Ultimately, retirement accounts will be in private capital. It's the perfect balance of liability and return, and it gives investors diversification. So
401ks?
Ultimately, yes, for sure. Pace of which, hard to predict. But the wealth transition to private capital, for sure, is a durable transition. Should be. The asset class makes a lot of sense for a lot of people. Advisors, I've spent a lot of time with advisors in the past 2 years. So Carlyle has been in that part of the business for a long time, but it wasn't strategically important as an initiative. When I showed up, we switched all that. We reorganized the team. It's one of our fastest growing areas. But this is, again, we've scratched the surface globally on wealthy individuals participating in these markets. So that capital stream will continue to come in.
How do you think about what might need to change about the industry in order to make this more available to wealth clients as opposed to institutional clients who have been able to get into a private fund, hold it for a very, very long time? Now you have investors borrowing their 401k that might want more liquidity. And do you think that that presents another set of risks too, a mismatch perhaps?
So I think the only thing that gets in the way of the industry and the growth of this is the industry. So if we execute at Carlyle, we don't want to rush. This is all about performance. If we say we're going to do it, we have to do it. And we have to understand the ultimate wealth client who's managed by an advisor or an RIA or one of the big platform partners that we work with. That is our obligation. And as long as we deliver the performance consistently over a period of time, with all the risk factors understood, then we will be successful and the industry will be successful. The only thing that worries me sometimes is there's a bit of an arms race, it seems, to develop solutions. There's clearly competition on the advisor side. Carlyle, I'm super fortunate that I had the opportunity 2 years ago. It's a really iconic name in finance. It's been around for well over 35 years. To be successful in this industry, particularly this segment, you need global brand recognition. Carlyle's well known. We have wealth partnerships in the Middle East, in Korea, in Japan. And we tend to think in a very US-centric way that the wealth phenomenon is a US-centric phenomenon. It's a global phenomenon. And that's why I feel confident in saying over the next 5-10 years, you'll see this trajectory of growth.
So we talk about private markets like it's a monolith. But of course, it's private equity and private debt and infrastructure and real estate and all of the above. Private credit in particular has gotten a lot of focus, that $1.6 trillion market of direct lending. It seems that the industry is pushing away from just that into new places. What's the biggest growth area in your mind, and what is driving it? Are there mega forces that will make this industry much bigger?
So So there's a flywheel effect in capital formation. This exists in public markets. I mean, if we went back many, many years ago, ETFs were new, then they became very efficient tools, then they became some of the most popular tools that exist in the marketplace for investors for a lot of obvious and very rational reasons. It's very hard for finance professionals to create demand for a particular form of capital. I don't think we're actually particularly good at that as an industry. When we really operate well in finance, and having seen it at over 30 plus years, when we really operate well is when we truly understand the client demand for capital. And what is the client demand for capital? The businesses that get supported by this capital are just looking for the most efficient form of capital. So they're not being sold direct lending. They're choosing direct lending over other sources. But what has happened, direct lending in many regards, which has been around for a long time and really grew quite quickly over the past, call it 5 years, what's really happening though is the understanding of the capital choices continues to expand. So direct lending will continue to grow, although more mature today, but now asset-based finance. And there are forces in asset-based returns, and really at the end of the day, what allows us to be most effective at that, Sonali, is we have the right liability structure. So because we have longer liabilities, which our clients provide us, whether they're wealth clients, institutions all around the world, we're able to structure and deploy that capital. But again, it has to be the most efficient marginal capital for the end user. There's no creating something and people come. These are really thoughtful business owners that are choosing to use that capital because it's the most efficient capital. And that's what we have to provide.
Harvey, we are out of time. You spared yourself from my lightning round. Really? What are you doing for dinner for your birthday? You can have that.
I'm hosting the first partner offsite Carlyle's had in a long time. They asked me if I would do it on my birthday, so I said, so all of our partners are going to an offsite for 2 days. I'm super excited about my birthday.
That sounds like
Yeah.
a blast.
Yeah.
Thank
everybody,
you so very
I hope
much.
you found that helpful. Thanks so much. Have a great conference. Take care, everyone.
Please welcome to the stage Katie Koch, President and CEO of the TCW Group, Jonathan Lewinson, co-founder and managing partner of Diameter Capital Partners, and Marc Lipschultz, co-CEO of Blue Owl Capital, for a conversation with Bloomberg's Danny Berger.
All right, thank you all so much for joining. I'm really excited for this panel. I mean, it's a topic that is very much so in the forefront of a lot of conversations about private debt right now. Convergence has been the buzzword of this industry. More capital is being raised on the private side. It's getting more complicated in some instances to draw a line between the two, with trading desks popping up, ETFs for private credit popping up. So we're going to have a conversation about what exactly this convergence is and what some of the consequences might be. So thank you all, first off, for joining this morning. Really wonderful to see you all. Katie, I want to start with you because TCW obviously has a very robust credit offering, both public and private. To you, what does this convergence mean? Is it actually something that's happening, and what does it look like?
Sure. So first of all, Danny, thank you so much for having us here. And I also really want to say to both John and Marc, it's an honor to be with both of you. Diameter and Blue Owl are incredible firms, so honor to be here. And yes, we manage at TCW, global asset manager. We manage about $200 billion.
A lot of it is in credit markets, as you said, private and public, regular way private credit, asset-backed finance, CLOs, and then on the public side, we manage across the full spectrum. So to answer your question succinctly, we do believe that there has already started a convergence, and we will continue to have a convergence in credit markets. I would also make the point that I think we're in the very early innings of this trend. Before I had the privilege to lead TCW, I ran a large public equity business at Goldman Sachs Asset Management. And over 20 years, we saw a very large disintermediation of public equity markets. We now have 50% less public companies than we did 20 years ago. And actually, in that market, it's a binary choice generally on the equity side to be public or private, whereas in credit markets, the same company can actually issue public and private. They can lend against cash flows. They can lend against assets. So you have many more options. And so for us, just to conclude, one of the things that we're always trying to do for our clients is be relevant to the borrower. Because if we can be relevant to the borrower across all of those choices, we have more alpha opportunities to capture on behalf of our clients. So we do see this convergence deepening. And we see allocations going up pretty dramatically, in our view, over the next decade. There'll be some vehicles dedicated to those segments, and there are also going to be some vehicles, both for institutions and wealth, that capture both segments.
So you're talking about some of the borrower driving this. John, I'd love to get your point of view, because you have both public and private credit too, about what is causing a blurring of the lines.
Well, look, I think that borrowers are commercial, and they're reacting to incentives. Historically, where private credit came from was the middle market not being served by the bank syndicated loan market. And so private credit rose up from this idea that middle market companies should have access to loans to be able to do deals. And the success of that built on it and built on it. And I think what you're seeing now is, as private credit succeeded and got into bigger and bigger deals, the line blurs as to what is an obvious private credit deal versus an obvious BSL deal, and it allows, I think, a lot of flexibility for borrowers to figure out what's best for that individual company. And sponsors, company by company, deal by deal, even within the life of the business, the number of times that now the BSL market is taking out the private credit market or vice versa has picked up. And I think that's the idea of providing capital solutions, whether public or private or structured, to borrowers, oftentimes private equity and otherwise, has allowed the entire industry to take off.
Can I press you a bit on that, though? Because you're talking about offering different products to an issuer. What does it look like when it's one and the same, when it's hard to distinguish? What does that actually look like?
Well, there's both technical and theoretical differences, I would say, or normative differences. So when you think about a private credit loan, oftentimes there is higher interest rate on it. Sometimes actually the covenants, most of the time the covenants oftentimes are better. But you're dealing with a smaller group of lenders. You're dealing with, I think most importantly, and this maybe hits the convergence question head on, you're dealing with a different set of norms. And so in the public markets, you are oftentimes dealing with underwriting banks who are then going to syndicate it to many, many, many firms. And you don't really control who owns it. And so your capital structure will look like it will. And so if your debt trades down, it might be hard for you to do M&A because you can't issue debt at par to kind of buy a business that was important to your thesis. But in private credit, if you think of really what the definition of private credit is from a norm perspective, it's that not too many people are in the loan, that you know who is in it, and then most importantly, if something goes wrong, your lenders are going to think about it as a relationship, as a repeat player, and they are going to work with the sponsor in a conciliatory way to deal with the business. And so while on paper it says, oh, I have a floating rate loan, who cares if it comes from Blue Owl or it came from a Goldman Sachs syndicated deal, the norms are actually not convergent. And in fact, they're very, very different in the markets, and it allows the private equity sponsors to choose what's best for each business.
So I definitely want to come back to this point because I think it's a really important one. But Marc, I want to bring you into the conversation because your DNA is private credit. And I wonder what you see as the driving force for this. What is the incentive to have a convergence, a blurring of the line of public and private credit?
So I think it's probably worth trying to unpack even what we mean by the word convergence, in so much as I really loved what Katie and John just had to say, and I think was all spot on. And here's the question: is convergence about this sort of bringing together of a very vibrant public and private market? And to John's point, for example, people are looking at both solutions, and maybe even in some cap structures, there are both. There's public and private pieces. That version of convergence, to me, makes a tremendous amount of sense, and that absolutely is happening. And I think that does favor the organizations like ones here represented, where you can offer a full range of selections between different types of solutions. However, convergence, I think, also is being used by some people to talk about sort of turning private markets into public markets, or I don't know if the reverse even makes sense, public markets into private markets. And I'm less clear on what that, honestly, I'm really less clear on what that means or what problem we're trying to solve. I would say from a private market practitioner, we manage about $250 billion, all focused on the private markets. I don't desire to sort of turn those into public securities. That solution already exists. In fact, we rose, as did many other private providers, private credit or otherwise, to provide a longer-term pool of capital that isn't subject to the vagaries of the daily market. Yeah. And today is a perfect example. If you're a borrower with us, then today you still have steady access to capital. We're not daunted by today's volatility. We're looking forward. But if you're a public borrower, you don't have access today. That's it. 2 days ago you thought you did, and today you probably don't. To me, that is, I don't think, a problem, quote unquote, we want to solve. In fact, we might be creating a problem if we just take the private market and just introduce all that volatility.
Katie, I mean, I want to bring you in this, because if we are entering a more volatile period, what does the macro setup look like for a world where private credit looks a little bit more public, where private credit might be subject to some of the volatility of this market?
I do think we have an interesting macro setup, so I'll comment on that for a second. So, we believe in the business cycle. That doesn't sound like a really brave statement, but we haven't had one for 17 years. That's something for all of you to think about when allocating capital. Everybody up on this stage has been whacked in the face by a business cycle, I think, right? Is that okay? Good. But many people in the industry haven't. I think that's a real thing. We had a short one, but we gave out a lot of free money and we fixed it quickly. So I do think that we are believers in that. We see some softening data. I don't need to rehash it. We all watch Bloomberg and we know what that is.
I hope so.
But I would say that the valuations haven't yet adjusted for that macro. I believe that to be true in private markets. And here I'm just talking regular way private credit, corporate lending. I believe it also in public markets. And so how do we navigate? So let me just say one thing on why I think it's what we're watching, and then I'll end with a comment on how we're positioned against that. Just stick on America for a second. We can't really get to a true business cycle until the consumer rolls over, because it's 70% of GDP. The consumer's already in a recession and has been for a while on the very low end of the market, just not the high end of the market. And I think, as many people here know, 50% of consumption in the U.S. is driven by the top 10% of the consumer. So you need to see a crack there to really get the business cycle moving. Employment will be part of that. We have payroll numbers on Friday. We know that there's some weakness in the employment market. It's not very weak yet, but we are seeing layoffs across multiple sectors. So we'll watch that. That's something to watch. I'd also watch equity markets, because this top 10% of the consumer, a lot of their wealth is in houses and in equity markets, and they're transferring that wealth, the baby boomers, to the next generation. So I want to posit to all of you that the transmission mechanism may be a little bit different this time around and come a lot through equity markets. So that's something to watch. I want to end by saying, how are we positioned in this environment? In liquid portfolios, we're running a very large underweight to credit, because against this possibility of a business cycle and some softening, I don't want to over-dramatize it, macro data, we have credit spreads still at record tights versus the last 20 years. And in the private markets, we're deploying capital probably more slowly than our peers. We have strong covenants. We are very disciplined lenders. We say no a lot, and we are at slower rates of deployment than the industry at large. I'll end by saying, where we interestingly do see some opportunity, even in the absence of the business cycle kicking in or a recession, is in rescue finance. So that is where we are deploying record amounts of capital. And that is because interest rates have stayed high because of inflationary pressures. You've got a lot of companies with upside-down capital structures. The operating business is okay. The balance sheet is not. And there's an opportunity to go in there, restructure, and ultimately deliver equity-like returns for our clients through the credit.
Honestly, just putting your thoughts and Marc's thoughts together, John, What I kind of almost hear is that this is maybe a horrible time to be an investor if you are seeing a convergence of public and private. If you thought you were getting an illiquidity premium from private markets and things are popping up like trading desks to trade them, or maybe you have to mark to market more, ETFs are coming up. It seems like maybe if you're an investor, if you're an LP, you'd want a clear difference between the two. I mean, is there not some degree where the macro environment that Katie was describing might undo some of this so-called convergence that's happening?
Sure. I think, look, Katie pointed it out well, right? We've seen, more people have seen Bigfoot in the last, decade and a half than a business cycle, most likely. And that means all of us are to some degree asleep. And if you think about the way private markets operate, they don't get marked routinely. And so you could sit around in a private portfolio for a long period of time and think there's no trouble under the surface whatsoever, and have really no incentive to kind of dig for that trouble under the surface. And so one way to maybe think about the convergence is using not merging public and private markets, because as Marc said, there's reasons for it and against it. But what you might want to think about is, what's going on? What are the public markets telling you that help you underwrite in the private markets? Right? So Katie was talking about, hey, spreads are really tight. That might tell me that the market is a little complacent. There's not a lot to earn there. Let me find elsewhere. What I see is there are sectors in the public market where there's a look ahead, where it's saying, hey, maybe the future is not as good as the immediate past. If you think about the way AI is interrupting progress in places or disrupting things, let's look at the software space. A lot of private credit has been in software, partially because software is not cyclical. And private credit was a business that pitched itself saying, hey, we're not going to be in the most cyclical places. But if you look to the public markets, the BSL market, many of the security type of software names have had trouble. Some of those moats were disrupted. Those BSL loans trade down. That, therefore, all of a sudden informs immediately, and in our business, we have public and private in separate funds for separate LPs, but kind of sitting together as a team, saying, wow, that would really change our underwriting of all of maybe SaaS software, or all or partial of it. And so I think that's the best way to think about it. Allow the markets to inform each other, such that you're not just, say, in private credit, not aware of what's going on in the markets, and in public credit, kind of having the back and forth.
So it's almost more like they're talking to each other than becoming one, almost.
In our business, that's what's happening. They're not one. But sometimes private credit refinances, sometimes the BSL refinances, but you always have to think about, hey, what's going on in public market spreads? Why is that not being reflected in the fact that I'm being asked to do a very, very tight deal in the private markets, and vice versa?
Just adding on that, if we think about the public and private market and this sort of adjacency, our job collectively is to gather all the information and knowledge we can, right? We've looked at 10,000 companies to make the loans that we have. And so there's information value in, just as John said, and as Katie said, in looking at the public markets, looking at the private markets, looking at industries. But I think for me, I come back to this point about the private market's job is to be able to take, and the opportunity, the reason we can earn a premium return for the risk collectively, is to be able to sort of see the signal for the noise, which is to say, today, everything is red. Does that make every company so much worse today than it was yesterday? No, certainly not. Now, you have to pick through it all and figure out what the implications are. But the difference is the sort of, call it almost technical or funds flow nature of movements like today. That's not what our investors want us to respond to. They do want us to respond to fundamental shifts in the world. So when the meta trend, and it's undeniably correct, right, that AI will have dramatic effects in the economy, then they want us to help guide their capital into things like hyperscale data centers. We want to skate to where the puck is going. So I think, to me, it is about looking at the markets holistically. And look, a great economy, the US economy, is one that has really vibrant public and private markets.
So if the convergence happens more forcefully, Marc, is it an unhealthy thing then? If you are forced as a private credit manager to market more frequently because the underlying asset starts to trade more frequently, and you have to incorporate some of the volatility of the market, is that an unhealthy thing?
We mark all the time. I don't find the marking to be the question. To me, the challenge and the negative of the public market in certain circumstances is accessibility. So it has to do with, is it even available? Think about this, go through COVID or hyperinflationary times or the run of Silicon Valley Bank. It really didn't matter what the particulars of a company were. If you were in the public market you had no access to incremental capital. If you were in the private market and you still had a fundamentally sound business, you had access from us or others like us. So to me, I look at more the volatility introducing issues of access. We mark all the time. We have BDCs, right? They trade every day. So people know more about the loans that we own than they could possibly know about the loans on a bank balance sheet, for example. Every single loan, you can go through our line items. We rate every single one every single quarter. So it's a bit of an illusion, this idea that there's not transparency in our marketplace, but it is true that we're making decisions that are looking not today, tomorrow, but through to the future.
One fun element of it is there's been nothing more boring in maybe the history of conferences than going to a private credit panel for most of the last decade.
I don't know, they're like hiring celebrities to show up.
Well, that's like them. No, partially because everyone's business is similar, right? Mark, like there's been, talking about like mega cycles, right? The mega cycle has been the rise of private credit and kind of flanked by firms that have kind of really taken advantage of that. And the reason that the conferences are not as interesting as public market conferences is that, you could have a guy in a public market, I'm long Coke, I'm short Coke, I like Pepsi, right? A total back and forth. Whereas in private credit, it's been a growth of a market that was very, very small, that didn't really exist, and now really maturing and coming into fire with similar business models. And maybe what convergence now can mean is they're going to look a little different. Right? The way we do, so we have a BDC, we have a CLO, we have public and private, but we do it a little differently than they do it at larger firms to my right and my left. And that how those portfolios, how they're going to, all of a sudden, we might sit here in 2 years and it might be a little more interesting on these stages because people's business models, their approach to how often they're trading, their approach to trading, their approach to these norms, how are these norms going to trade are going to be different. And again, at least it'll sell tickets to Bloomberg Invest.
Hey, well, that's if we're not here to do that, then I don't know what we're here for.
It's funny too because everyone's looking for the drama in private markets. Everyone's looking for the drama in private credit, and I don't know if you want to call this good or bad news. It's good news if you're an investor. It might be bad news for the question of seeking drama, which is the private markets by their design have lower amplitude. And the norms that John talked about. We work with our partner companies to solve problems. It's not, I win, you lose. People are looking for that shoe drop, the big dramatic moment. And I think people are going to be waiting a while to find that moment because it's not the way we operate.
Kate, can I bring you in on this as well? Because also Marc is talking about a bit of a difference of an incentive structure, I think we could call it that. That in private markets, you have an incentive to work with the sponsor, to work with the borrower. Public, not as much. You want to get into the right asset at the right time. If there is a convergence, what happens to that incentive structure? Does something merge with that too? Or are we talking about two different lines of how companies and how issuers and how borrowers work together?
Yeah, and I think that the way that people approach this is going to be, if we do get a business cycle and we do get more differentiation, to your point, not only has the asset class kind of gone up and to the right in terms of growth and launches, we actually haven't had that much differentiation of the credits in most of the environment in which private credit has existed. We have an asset class in private credit that 95% of people haven't invested through a recession, a cycle, or when rates were persistently not zero. So I would just start by saying I don't think we know yet, and we're going to find out. There was a question from the audience here that came up just around like, where will you see signs of excess? Like if we are having a business cycle, where are those signs going to get expressed? I think it's going to be different this time because we know that part of the high yield market, which usually we can look to for early signs of stress, has migrated towards private credit, which means that there's going to be possibly some more opacity or delay in those signals. I don't think there's going to be a crisis because I know you've originated well, you've underwritten well, you have all your covenant, you're going to do the right thing for your clients, but there'll just be a little bit of delay in how that signal comes through. And I just want to end by saying you're right that there's more ways and in theory, more tools to work out of a private credit that's gone wrong. I would just say to everybody in this room, defaults haven't yet risen. And that is, someone asked the question, where do you look for excess? Generally, you would look for defaults. We haven't had a dramatic rise in defaults, in private credit. There's been defaults in the bank loan market, but in private credit. That doesn't mean there's not stress. It actually may mean that a lot of those people wrote without covenants. They can't come to the table to restructure, and there's amend and pretend. So if someone said, where should we look? Look at extensions. Look at how many amendments are happening to those loans. That is a precursor sign to stress. And I don't think it's a crisis for the whole asset class. I'm a big believer in it. It's going to grow. The demand is there. The supply will continue to be there. It's going to be a great place to be. But there is going to be some testing around this. There are going to be some things that go wrong. And I think looking at people who have given up covenants, who have made optimistic loans, which isn't a great way to make loans, we're going to see some of that come through in this cycle. And that is my answer to where the stress will be. It's not going to express itself the same way it has previously.
Is it worrying then that people are buying private credit ETFs right now, that you have retail investors who maybe don't know the asset class as well in a vehicle that's liquid with underlyings that are less liquid?
Well, there's only one person that's done that, so
Yes.
I'm not going to comment on that.
Fair enough.
But I do want to say that going back to, because we're throwing around this term private credit, I want to say that some of these vehicles being offered to individual investors are IG. They're very different than the high yield market, the traditional middle market lending market. And so I want to make that point. And then there's final comment, because we haven't talked a lot about origination here. I do think that we've talked a lot about having good covenants, helping you work through a difficult environment. But the story does start with origination. And I think going forward, there's going to be much more scrutiny on behalf of LPs for what are the origination advantages here going forward, and who are you working with on that?
So yeah, the irony is that if you go back to before the financial crisis, there was a convergence in that a lot of people were doing private credit out of hedge funds. And structures that absolutely couldn't. You'd have monthly or quarterly liquidity hedge funds that were making illiquid loans. And that turned into a total disaster, and it exacerbated some of the problems around the financial crisis and liquidity constraints. Today, even in vehicles that may be shown to have done very poor underwriting, the liability structures are pretty good in terms of the ability of people to hold on to the capital, to see the deals through, and the run on the bank element. You saw some of this in the real estate market when some of the kind of retail products for real estate put down gates that were designed to allow people to stay in and work these things through. And so what was one pool of capital doing things has actually come apart. And the question is, how will it come together again? And if you think about excess, to Katie's point, is a cycle will show that not everyone can have the same underwriting standards. So some people will have been bad at underwriting and their portfolios will be bad. But it could also just come from an industry microcycle. If we do still never get to see the Loch Ness Monster and never get our time in the sun for a cycle, it could be that industries, so whether we've seen the microcycles in retail and in energy and in part of healthcare and in banks and in telecom, what's the concentration of risk in private credit vehicles? Do they have 30% in an industry? If that industry is particularly hit, what does that mean? Do they then all of a sudden say, wow, we can't necessarily exit those because it's private? How do we find capital?
It all gets down to origination, underwriting, documentation. And these are the calling cards of a well-run private credit business. Some are well-run, some we're going to find out are less well-run.
No one here.
Certainly not here. Not if they're smart enough to be at Bloomberg.
Of course. I have a feeling we could probably talk about this for the rest of the conference, but they might never allow me to come back to moderate. So unfortunately, we're going to have to end it there. Thank you all so much. Everyone, please join me in thanking Katie, Marc, and John.
Thank you.
Thank you so much.
It is clear that we're at the beginning of a mega cycle in spending in AI. Be patient and let the opportunity set come to you. Every now and then you're going to have a view that's contrary. Those are the views you will make the most money on.
Please welcome to the stage Dawn Fitzpatrick, CEO and Chief Investment Officer of Soros Fund Management, for a conversation with Bloomberg's Eric Schatzker.
Good morning, everybody. Dawn, did you ever imagine that we'd be here 6 weeks into the Trump 2.0 era and the Dow is flirting with negative, the S&P 500 is down 2.5%. The NASDAQ is down 6+. Did you?
So I would have thought that the markets would have held up better, but I would also not have thought that we would have had the level of frenetic activity out of Washington. And when we look at the headlines over the past 24 hours, they've been kind of breathtaking in speed and scale.
I'd like to point out, because some of you here may not know, or perhaps you've forgotten, that the Treasury Secretary, Scott Bessent, once had Don's job as Chief Investment Officer. He worked at Soros in the 1990s under George, of course, and also under Stan Druckenmiller, and he returned as the CIO in 2011. You arrived in 2017, a couple of years after he left, right?
I arrived about a year after he left.
I bring this up not just to establish a distinguished lineage, but because it serves as a useful reminder that Scott Bessent has to be, right, the most market literate and market savvy Treasury Secretary since at least Bob Rubin, and perhaps in American history. Now we have a president whom we know thinks of the stock market as a daily report card, and a Treasury Secretary who's laser focused on macro indicators. Why is that important?
So a couple things. Scott is incredibly smart. He's capable, and I think he is the most market-savvy Treasury Secretary we've ever had. I think it matters because when he says something, you should take him literally. So he has said he and Trump care about the level of 10-year treasuries, and I think he will pay very close attention. In a kind of perverse way, right after the election, we had the Trump bump, and as Eric pointed out, we've had something different in the past week or so, and you've seen that 10-year Treasury go from 480 in the middle of January, where they were getting nervous, and if you remember, they kind of backed off some of the tariff timing at that moment in time. Now you have a 10-year Treasury that's down at the 412 level. And I think they should be getting a little nervous. I think the one thing that market participants maybe have underestimated, in the first term, we all said Trump is very SPX sensitive, and that was invariably the truth. I think with Scott, I think their pain tolerance is different, and I think they're more sensitive to a broader set of asset classes. And I think they might believe that ultimately they have more levers to pull when and where they need it. That said, when you think about tariffs, we can all look at a textbook and we can say, and I think the Treasury Secretary said it today, manufacturers will absorb the price pressure, and then you can also argue that it's a one-time price shift. But I think what you can't control is consumer confidence and corporate confidence. And I think that is what is falling off a cliff right now.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
So I would take the other side of that bet because, again, I think ultimately they will bear more pain than I think market participants originally thought, but there will be a limit. And I think they will make deals.
There's a view in the market that Scott's preoccupation with keeping the 10-year yield low foreshadows a coming change in bank regulation. You know, if the administration wants to juice demand for treasuries, it could exempt treasuries from the supplementary leverage ratio, one of the capital penalties that the big U.S. banks have to pay. Do you think they'll go there?
So I definitively think that is going to happen. So when you look at kind of the net issuance of treasuries post-COVID, it's almost all been bought by the levered hedge fund community. And I don't think, first of all, that's not a sustainable kind of marginal buyer. And it also probably isn't good for market structure and market stability. And when you look at what came out of Congress last week, you know, the deficit is not going lower. in any material way. So what I think they're going to do is they will change bank regulation and the supplemental leverage ratio, allowing banks to buy treasuries in ways that won't be regulatorily punitive. And the next step is they will try to take some leverage out of kind of that basis trade and the levered market. And again, I think this is where Scott understands the moving parts in ways that I think will ultimately be really helpful.
You've given us a couple of clues about how you might be trading the bond market. You take the other side of 3 rate cuts this year, but at the same time, you think that the administration will be inclined to help lift demand for treasuries. How are you trading treasuries? Like, what would you buy and where? And are you a holder or are you a seller at any point?
So we are a reasonably large holder of U.S. government bonds, but we're below our benchmark weight by a little bit. And what we've been doing is we've been using volatility as our friend. So in January, when the 10-year rate spiked, we were buyers of bonds at that time. And then now, as you've seen kind of rates go lower, bonds rally a lot, we're not taking profits. And you'll see us continue to build a position into that volatility. And I think you're going to see continued volatility. Again, this moment in time, rates are going lower, but I don't think that's going to be true for the next 4 years.
Volatility can be your friend. Is that? I guess I better put it this way. What's the best thing and what's the worst thing about trying to put money to work in this market?
Yeah, so we're technically an endowment, but we use the best of the endowment model and the hedge fund model, so we can react very quickly. And I think we're very good, I would argue probably one of the best in the world at connecting the dots across asset classes. And from our perspective right now, the volatility is great. I think market structure is still challenged in that liquidity at moments in time when there's a lot of volatility is challenging. So you can see a great trade, but sometimes buying as much of it as you want is easier said than done.
Do you have a favorite trade right now?
Yeah, that's a good question. So we are tactically, at the end of last year, we bought call spreads on Hong Kong equity indexes. And I continue to like that trade, so we're holding that position. And again, when you see kind of the micro and macroeconomic data coming out of the US and you see the data in China, I think you will see a tactical deal out of economic necessity between China and the US. And I think when you look at investors generally, they've left China for dead. So I think there's going to be money forced into that market. Again, for us, that's more of a short-term tactical trade than a longer-term position.
I feel like I have to ask you the requisite Mag 7 question. Those stocks are down about 13% or so from the peak in December. That was, as of yesterday, I didn't check this morning, probably down by more. Tesla's off, 40? NVIDIA's lost 24%. Are those buying opportunities?
Yeah, so I think the Mag 7 those are extraordinary companies with real earnings power, and the unwind here has been pretty violent. So I would take the other side of that trade.
And of course, we are witnessing some historic shifts in U.S. foreign policy. It would appear that the United States is to a degree abandoning Europe, perhaps embracing Russia and Vladimir Putin. Has that translated? Will it translate into great macro trades?
Yeah, so, Russia's not that relevant from a trading perspective. When they invaded Ukraine, it didn't really reverberate through markets. And I think in the context of what's going on now, the only thing that's worth watching, in my opinion, in the context of trading markets, is oil. And whether ultimately, and this is a big if Trump can negotiate a peace between Russia and Ukraine, whether part of that deal is Trump needs more oil, right? Part of what he's been promising the U.S. consumer is lower prices, and particularly lower prices when it comes to the gas pump. The U.S. really can't drill more. It's not in Saudi Arabia's best interest to produce a lot more. They need about $90 a barrel to balance their budget. So the lever he can really pull there is Russia. And one kind of wild card would be Russia dropping out of OPEC. And that would have a real impact on oil price in the context of moving it lower.
What about America ripping the security blanket away from Europe? You know, I could imagine that we've already seen, right, the Germans move toward spending. In fact, I think they found some flexibility this morning, right? 200 billion euros on additional 200 billion on defense. And we hear the same noises out of France. Surely that has to, result in at least some bond issuance.
Yeah. So if you look at Europe, and if they end up spending the 2.5%, to 3% of GDP on defense, that's $175 billion a year. And when you think about the fiscal space they need just generally, the amount of bond issuance out of the EU and European sovereigns is going very materially higher at the same time when U.S. net issuance is also going higher. So I think one of the things that we might see, and this isn't going to happen tomorrow, but I think it could happen in the next 12 to 24 months, is a failed auction out of Europe. I just think at some point, sourcing that marginal buyer is going to become extremely difficult.
Do you feel confident enough to predict which country will fail to sell enough bonds?
The two most vulnerable countries are the UK and France, in my opinion.
Don, there's a lot of Western money, including some of yours, trapped in bets on Chinese private companies. ByteDance, of course, tops the list, but there are lots of others. Could that logjam maybe start to break if Presidents Trump and Xi negotiate some kind of a deal, whether it concerns trade or whether it goes even beyond trade?
So I think there's a lot of people hoping for that, and as Eric said, us included, where we have private capital in China, and we've been, everyone thought these companies would come public years ago, and the markets just didn't allow for that. And if you remember, the Chinese government kind of closed that door at the 18th hour. So if there is a tactical deal between the U.S. and China, I think there's a lot of market participants, us included, that will hope that the private to public markets unfreeze and we can get some money out. I think if you get money out of privates, it's only going to be in that very, very tight top tier, like a ByteDance. And to be clear, ByteDance is probably the most largely held private company by real asset investors in the world. So there's a lot of people with that hope trade on.
This feels like a good time for us to wade into the public-private debate for a moment. Because for years, right, foundations like yours and endowments and pension funds and sovereigns have been plowing money into private equity. Of course, they've had some trouble getting that money out of private equity over the past couple of years. And now private credit is the rage. And more capital, as a result, is flowing into illiquid vehicles. Why do you believe in liquidity when everyone else, right, from Apollo to BlackRock, is extolling the virtues and the benefits of private markets?
Yeah, so over the last, again, we typically are benchmarked against the typical largest U.S. endowments, but over the last 6 years, we actually let our private equity positions roll off. We still allocated to the best managers, but with a really high bar. So we lost about 1,000 basis points of exposure there, which, to be clear, has served us really well. And at the same time, we pivoted to public markets. And it's interesting. I think a lot of both high net worth and institutional investors pivoted to private markets in part because you didn't get a scorecard every day. And your Sharpe ratio and the returns looked artificially good. And by doing that, first of all, I think those investors are in a world of hurt right now, both in context of liquidity and in the context of they've massively lagged a equity market that has until the last couple of weeks been on fire. But the other thing is, if you're Soros Fund Management and you have a long-term perspective in public markets, you have a lot less competition because it's most of the active money is large multi-strat investors. So for us, the capital allocated to public markets above our benchmark, we've annualized 650 basis points of excess return over the last 5 years. And I think it's because we play our own game.
What does that mean in actual numbers? 650 over what last year? 650 over what in 2023?
So it's always our beta benchmark is MSCI ACWI, and then we have the risk-free rate. So we don't give ourselves any credit for what you can get, by in money markets or what you can get by buying beta, and we assume we're at our benchmark weight in those. So add those together and then add 650 basis points. By the way, the thing that's pretty interesting is when you look at the last 2 years, your private equity has lagged by more than that. So you needed that active return in public markets to make up for the sins in private equity. But we think our peer endowments and foundations haven't had that offset.
So you're thinking more along the lines of a hedge fund. Tell us what you returned in 24, what are you year to date, and when you look at those numbers, do you think of your competition as Citadel, or do you think of your competition as the Ford Foundation?
So we think of both. Like, we want to be clear, we want to take the best from both of those operators, but we don't play Citadel's game. There is no one. Citadel plays the multi-strat game, and nobody plays it better than them. And I think the distance between Citadel and their competition has only grown. And again, relative to other foundations and endowments, there are some things they do really well, and we like to take those pieces. But again, play our own game and play a game that we think no one else in the world can do quite the way we do it.
Dawn, on behalf of everyone here, thank you very much for joining us here at Bloomberg Invest.
Thank you.
Please welcome to the stage Jonathan Gray, President and Chief Operating Officer of Blackstone, for a conversation with Bloomberg's Sonali Basak.
Build with Blackstone, invest in our funds, not just in fixed income. I really think you're missing out on an alternatives industry, 40-year legacy.
I didn't choose the song, but I wish I did.
I love the song. Love the song. It's from our holiday video at the end of the year, if you haven't watched yet.
I was going to tell you to show up in the cowboy hat, but anyways, thank you all again for being here. John, thank you for being here. Tariffs. I mean, I don't know how you start anywhere else on a day like today, because the big question is, when you own so many businesses, when you have so many types of debt and equity tied to companies around the world, how do you think about the way this is evolving?
So I'd start with us. The good news is we don't own a lot of businesses that export physical goods into the United States at scale. So that's helpful for us. But of course, as you point out, we're big investors and lenders to lots of companies, and markets impact us. And what I'd say is we try to take a little bit of a longer term perspective, that there is tariff diplomacy going on, and that what is happening now could change depending on what market participants, what government officials do. And you've got to take that longer term approach and hope, or maybe expect at some point, that they'll get to outcomes, markets will calm, and actually in a moment like this, you look around and say, are there good businesses that are now on sale? We can deploy capital into this volatility. So I would just say to investors, be a little bit patient here. Let this tariff diplomacy play out a bit.
So as you look across the universe and try to find things on sale, What are you finding?
Well, I don't know if, it's so short term right now what's happened, but in terms of the areas we find most interesting, we love to be thematic in what we do. Think about sectors where there are long-term tailwinds that are quite compelling. So digital infrastructure has been a huge theme for us. Data centers, we've been the leading investor in the world in that area. There's obviously been concern given DeepSeek, but we continue to see big demand throughout that whole sort of value chain. We love power and energy. We think we're moving to a world of very heavy electrification. It's because of data centers, reindustrialization, robotics ultimately. We invest in generation, transmission, utility services. We like franchise businesses that are capital light. We bought in the last year Jersey Mike's. We bought Tropical Smoothie. We bought a small coffee chain called Seven Brew. We love the alternative space, stakes in other managers, secondaries, lending to private equity firms. And geographically, I would say also India is a really interesting place for us where we've leaned in, where we think there's a long runway. The last one I just throw out is the cyclical recovery in commercial real estate, which we're big believers in and have been deploying capital.
So big picture as well. People are talking about a return of the deal environment. People are talking about the return of an IPO environment. In the IPO space in particular, it's been almost stunning how slow it's been this year. Isn't it a big problem if this doesn't come back sometime soon? There are a lot of companies out there that have been holding assets for a long time.
Yeah, the IPO market and the M&A market, as you know, Sonali, are pretty cyclical. And we've been through a rough period of time, right? We saw the cost of capital go up globally as rates went up a bunch, as central banks tightened to fight inflation. We saw spreads go up a bunch. Market participants became cautious. We had a regulatory environment that was not that friendly towards M&A activity, particularly from strategics. And I think we're beginning to see a lot of that change. We've seen credit spreads tighten a bunch, both investment grade and not investment grade. The stock market, even with this recent trade-off, I think is up about 50% from 2 years ago levels. I think there's a pent-up desire to do transactions. And IPOs, when you have a stock market trading well, it's like a magnet. It starts to pull companies in as well. We've got a number of businesses that we're looking to take public this year. I think there's a receptivity to IPOs. But volatility, like this week, can slow things in the near term. But if you said, look, 24 was an increase both in IPOs and M&A over 23, I think you'll see the same thing in 25. And there's sort of a mean reversion in terms of activity levels, IPOs or M&A as a percent of the public market's value. And we're below that. And there's just a lot of pent-up demand looking for liquidity. I think it will come. I think high-quality businesses want to be owned in the public markets. And this week it may not feel as good, but I think when we finish the year, it'll be a better year in terms of activity.
The end of the year's a long way away still, John.
I was just saying cumulatively, but yes.
But to that end, if we think about what happened this week, if you looked behind the green room, a lot of people one by one are looking at their phones, looking at the stock prices of their own firms and others, and it's been pretty ugly. Yesterday was the worst day for the S&P this year. We've erased everything that we've seen the market gain since the election. Do you think that risk appetite could be significantly stunted in the near term?
In the near term, certainly. When you have these moments, investors tend to step back. Market participants say, well, do we want to make that big commitment today? Is the world more uncertain? But we've seen these, periods of time. And again, I like to look at the bigger picture. And what we see out there is still a decent economy. Right? In the fourth quarter, our private equity companies grew 7% in terms of revenues. We still have very low default rates amongst our private equity firms that we lend to today, non-investment grade lending. Our CEOs, when we asked them at the end of the year, do they see a recession? 0% in the U.S. said yes over the next 12 months. And we see inflation continuing to moderate. So shelter costs, the biggest component of CPI, is running well below the government's 4.5% data, which tends to lag Input costs are still pretty flat. And when we look at our companies and ask them, is it hard to hire? They say it's the easiest it's been in a few years. And so that combination of a healthy economy, some weakness certainly on the consumer side, but overall pretty good in the US, and inflation that is moderating, maybe the pace of disinflation isn't as fast as it was a year ago, that should give the Fed some room to bring rates down. They'll do it very gradually. That's a pretty good backdrop. So that gives me more confidence, again, why I think we'll see this pickup in activity.
There might be a silver lining to your point on the Fed potentially cutting interest rates gradually. Every morning, the first thing I do is look at the 10-year yield. We are down to 4.1%, which feels pretty stunning given we were flirting with 5% not too long ago, or 5% was the dangerous level that investors were talking about in January, potentially hitting. You're a big investor in real estate. What does that mean for the pressure that might be eased across the real estate industry, particularly the hardest hit parts?
Well, I'd start with sort of the bigger picture on real estate, which is we've been through a tough period of time, right? The sharp upward movement in rates hit real estate values, hit multiples, cap rates went up in real estate, spreads, borrowing costs went up a bunch. And in the office sector in particular, because of remote work, we saw a sharp decline in demand. And so that created a very tough period for valuations. I think we're on the other side of that. You and I have talked about that over time. And, the question is, should I be an investor in real estate? And what I'd say is, whenever you have a sharp decline in value, and then people stop building new real estate, we've seen 2/3 decline in apartment building and warehouse building, then it's generally a good time to invest. And the real question is the pace of the recovery in value. If it comes purely from cash flow growth, it may take a little more time. If rates fall as they have, then you may see an acceleration in multiples and it'll happen more quickly. But the path of travel in real estate is upward. So we've been leaning in quite a bit. We privatized a number of large companies last year. Clearly, real estate is a sector that's going to benefit from a lower cost of capital. But even if it goes back up the 10-year, I still think the path is very positive, just given the lack of new building in the space, which creates the ground really to have positive cash flow growth going forward.
I'm going to give you what I think might be a tough question for you. In the world of real estate, which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
It's an interesting question. I think from a value standpoint today, offices are pretty compelling in a place like New York City or San Francisco. Because in New York, you have financial services firms who are growing rapidly. You don't have any new building. In San Francisco, the values fell very hard, in some cases 75%. And AI and technology innovation really housed in San Francisco. And so I think in some of these markets now, given the sharp decline in value and the lack of new supply, office buildings become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically. And we think the usage is going to go up. There may need to be a little less training, and it may be more inference, but our lives are migrating online, and I think these data centers are a critical part of that infrastructure. So I'd say I like both of these children.
So on data centers in particular, the estimates are staggering. But they're not only staggering, they're all over the place. You've seen estimates from a need for $1 trillion or $3 trillion globally to build data centers. You've seen estimates higher than $10 trillion. Both things can't be true.
Yeah. Well, I think it's a question of what you're measuring. If it's just the physical data centers, it's probably on the lower end. But if you're talking about the GPUs that go in those data centers or the power that needs to go, then those numbers get really large, and then I'd be at the higher end. And it's a global phenomenon. I mean, if you think about where the world's going, I think our lives are going to be so impacted by this technology. What we do, how companies function, coding, customer engagement, even things like translation today now. You don't even need translation anymore because the machines can do it real time. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant. I'm not astute enough or knowledgeable enough to know exactly what the number is, but it feels like it's going to be very big.
You know, one investor that we're speaking to tomorrow has this theory where AI is going to be so productive that they're betting on leisure and entertainment because they believe the work week is going to be shorter. Do you see that happening? And I think it matters because of the implications it would then have across the real estate sector and offices and all of the above.
You know, it's hard to say. Historically, there's been a lot of prediction technology eliminates the need for work. What it's done is eliminated some needs, expanded others. I think there'll be some of that. I think there's a potential as you get further and further out that maybe the aggregate work hours go down. The good news to your point is the real world still exists. And so people are going to do physical things as well. And interestingly, infrastructure, which has been a great area for us, physical real estate, some of the entertainment, amusement parks, water parks, those things are going to stick. You're not going to do those virtually, I don't believe. So in the near term, I still see this technology in many ways, it's eliminating certain jobs, but it's creating others. And you know, we own a business, Ancestry.com, and you think about what that experience could be like where it starts to create movies and captures the music and the newspapers. And therefore, what it's creating to the end user experience is different, and it's going to require some human interaction as well. Obviously, other functions may not. So I think as investors, again, back to the beginning, what's going to happen with tariffs this week? I don't know. Will the Fed cut 2 times or 3 times? I don't know. But this technology and the way it's going to change our lives, I think that's profound. And thinking about these kind of big trends, that's what I'd focus on as an investor.
I want to ask you about a part of your business that I don't think that people ask you about enough. It's the business of hedge funds. We just heard from Don Fitzpatrick on the big picture here in terms of where the industry is going and how the multistrats are getting so big, but you seem to be finding a lot of opportunity elsewhere.
Yeah, it's interesting. So our hedge fund business is primarily focused on absolute returns. The division is called BXMA for us. It manages a little more than $80 billion of capital. Joe Dowling, who ran the Brown Endowment and was a hedge fund manager himself, runs the business. And what we're really focused on there is cutting off the downside for our investors and having things that are not correlated with stocks and bonds because our investors already have a lot of that, doing it in a liquid way and still delivering an attractive absolute return. And we managed to do that. So since Joe joined us 4 years ago, we haven't had a down quarter. We've outperformed 60-40 by 1,500 basis points. Last year, we were up 12% net. And we're doing it in this very uncorrelated way. And I think as cost of capital comes down, as base rates come down, I think investors will look for things like this as an area. I think historically in the old long-short equity days, people were looking for hedge funds to outperform equities and have downside protection. I think the business has evolved. And if you can have this piece of your portfolio as ballast, it makes a lot of sense. A number of the biggest endowments have as much as 20% in absolute returns. So this is an area we really like. And like everything in our business, if we deliver good returns, if we deliver for our customers, we tend to attract capital. And that's the key.
But are you willing to fight against the notion then that it's multi-strat or nothing in this environment?
Well, I think the multi-strats have done a great job. I mean, if you look at Ken and Izzy and the businesses they built and the performance, you can't argue with that. But it's a big world. And we can do things a little bit differently. Our approach is different. We think we can offer something attractive to clients. And if we do that, we think we'll find capital. And it can be across quant and macro and long-short equity and credit. And if you can deliver investors a basket of that, uncorrelated with an attractive absolute return, I think that's something that you do quite well.
So we have spent a lot of this time thinking about investment opportunities that exist in today's environment. If you can name probably the biggest shift heading into the next couple of years that you're trying to capitalize on, what exactly is it?
So in our business, I'd say it's a couple of things. First, it's the movement to private credit, which is essentially bringing investors directly up to borrowers. It could be non-investment grade direct lending or investment grade, in many cases, insurance companies doing things like consumer loans and infrastructure loans and energy loans, fund finance. And in that process of bringing them sort of farm to table, you can generate higher returns. And we're seeing, whereas in the equity bucket of most investors, private assets became a very large piece. Credit was pretty much all liquid, other than distressed and opportunistic. And this feels to us like a secular change with a lot of runway. The other area I would point to would be the individual investor. There, we have grown to $260 billion for individual investors. And again, institutions who are a third or more allocated to privates, even wealthy individuals, are only about 1%. And so the advent of these perpetual products across real estate and private equity and infrastructure and credit, and doing it in structures that have a little more liquidity but are still semi-liquid, don't have the drawdown features. These sort of products, if we can deliver outperformance, I think will continue to be very attractive. They've grown quite a bit. I think they'll continue to grow. But again, in both of these areas, I'd come back to our true north. We've got to deliver for the customers. If we do that, I think we'll continue to see major investors take a larger portion of their portfolio and move it into private assets. And at Blackstone, we should benefit from that.
John, I have a million more questions for you, but we have to leave it here. Thank you for joining us here on set in such a crazy day. Thank you.
Thank you, Sonali.
You can build with Blackstone or invest in our funds, not just in fixed income. I really think you're missing out.
Please welcome to the stage Raymond J. McGuire, President of Lazard, and Robert E. Rubin, Senior Counselor at Centerview Partners and the 70th U.S. Secretary of the Treasury, for a conversation with Bloomberg's Lisa Abramowitz.
I want to welcome everyone here, and this is a forum to talk about investment ideas and a frame of reference. And we have the task of explaining how to navigate the current business climate. And these two gentlemen will explain to us how we can frame the current events that we're facing off with and how companies are grappling with them at a time where the business climate changes in 30-minute increments. Joining us here is Ray McGuire, President of Lazard, as well as the 70th U.S. Secretary of the Treasury, Robert Rubin. They have both told me that I can call them Bob and Ray, or Your Honor. I want to start with this question of where are
Your
we?
Honor, if you want.
Roberto.
That's Bob. That's what it is. Yeah.
Bob, Your Honor.
There were people in Congress who called me things far south of Bob, I'll tell you.
Well, hopefully we don't go there. But I do want to start with just where we are in the day's news, which is the tariffs. And this idea that we got 25% tariffs actually put on Mexico, on Canada, an additional 10% tariffs put on China. I want to start with you, Ray. How are companies making sense of this?
It is we're in the early stages of this tariff diplomacy, if you will, geopolitical diplomacy. And boards and senior managements are now trying to assess the implications. It's been advertised for a while, and today it's begun to be implemented. Having said that, there's also the suggestion that in April, there's going to be a reset, so there'll be a review. And most investors, most companies do take a long-term view. And so we'll see how this early move on the chessboard plays out. People are assessing, companies are assessing the implications. But for the most part, there's a long-term view that is now being contemplated. We've not seen this level of tariff, at least in modern times. We've seen it historically. The implications of which historically have been pretty dramatic, and we'll see today whether or not the implications are going to be equally as dramatic.
Bob, how do you take a long-term view when it's unclear what the destination is?
Well, I have the following view. I think these are going to adversely affect us with respect to inflation. They'll adversely affect us with respect to growth, adversely affect productivity. But I think there's an even bigger point in some respects, Lisa. We have treaty obligations with Canada and Mexico, and we have now violated congressionally approved treaties. What does that do to our credibility around the world with respect to our commitments? And that can adversely affect us geopolitically and adversely affect us economically. We have spent all these years since World War II developing alliances and allies, supported by all sorts of commitments on our part, and it's been enormously in our economic self-interest, all in our economic self-interest and our geopolitical self-interest. And I think we're putting all that at risk.
Ray, do you see companies thinking about it that way, or dealing with international partners who are calling into question some of the framework of being able to come through with
the answer is that, and I agree with Bob, companies are being forced to now contemplate variables that historically we haven't contemplated. Remember, the peak of U.S. manufacturing happened in 1979. Between 1979 and today, we have relied on a supply chain that has been so dependent upon our international partners, especially our closest ones being Canada and Mexico. And so as that begins to be challenged, how we onshore, or at some point we talked about nearshoring, and nearshoring was Canada and Mexico. Since we've now applied tariffs to those countries, it's unclear how U.S. manufacturers will navigate. So we're exposed. The corporate America is exposed, especially those in the industrial arenas. Technology, perhaps a little less so, although we have exposure to what's taking place on the chip front. But the implications here on the market we've seen today, you've seen a sell-off of $2 to $3 trillion. Risk is off today. Before today, you had a little bit more risk on. You look at the volatility index, which is the VIX. Historically, it's averaged 20. Now you're at 25 or so. If you look at the options on VIX 50, which gets to the high end of risk, we see more activity in those options than what we've seen in quite some time. So you now are in a relatively complex environment with interdependency having to do with the supply chain for all the goods and all the products that we consume. We're going to have to be able to manage through that.
Bob, you mentioned that this is going to cause inflation, and it's also going to cause some sort of deceleration in growth. People argue that tariffs in the long run are disinflationary. It's a one-time price shock, and then it gets absorbed, and it's sort of part of the mess to get to a final goal of bringing more domestic production, reviving more domestic production. What's your outlook? Do you think that it's going to look a bit different than that?
Well, to be a little bit technical for the moment, Lisa, you're right. It's a one-time supply shock, so that increases costs. And then it can level off, so the rate of inflation may not have gone up, but costs will be higher. To consumers, to our producers, the producers who compete with imported goods can now raise their prices. And I think in terms of the long run for us, I think it means less productivity, because the whole theory of trade is comparative advantage, so that every country gets the benefit of getting the most it possibly can for that which it is best suited to produce. And now we're interfering with that process, and it will cost us in terms of productivity and growth. I think this is about ideology, the decisions. I think it's about ideology, and I think it's not factor analysis grounded.
It raises this question about a time when, heading into this year, companies were talking about incredible dynamism, incredible expansionism, the idea of American exceptionalism. We were going to see a boom in deal making. Ray, do you think that that's just on hold, that that can come back? Or do you think that people are rethinking that in corporate executive offices?
Well, let's be clear about productivity and how it is that we transition. In order to rebuild the industrial infrastructure of this country, it'll take 5 to 10 years. So while we think about being able to remove ourselves from that supply chain dynamic, the reality is it'll take a while before we do that. Having said that, as I think about some of the tailwinds in this environment, you have, $10 trillion sitting on the sidelines, $7.5 trillion on corporate balance sheets, $2.5 trillion with the asset managers. You have $14 trillion or so of debt available, $2 trillion with the asset managers, $12 trillion with traditional banks. Will we need to somehow deploy that capital to continue to grow? The answer is yes, we will. So I have on the one hand a lot of capital that is pent up. On the other hand, notwithstanding the sell-off that we're seeing in the market today, which brings it back down to still what is a pretty historical high. We're trading at 20 some odd times next year's forward earnings. So I look at the dynamics of the resources that we have and how we deploy those resources and the pent-up demand for growth. So we will pause for a while as we understand and interpret the implications of the tariff dynamics. And once we get to a new normal, then at some point we will re-engage. Will it be at the same levels that we've re-engaged historically? Unclear.
Yeah, but do you think that we're going to have that boom in M&A, that boom in deals that everyone was expecting that's been propelling financial stocks higher?
Well, we had the prospect of that, didn't we? When we came in, we thought that there was going to be, because of the factors of the availability of capital, where the market was going, and we also thought there was going to be a relaxation in some of the regulatory environments having to do with what took place in the M&A environment last year, where regulators came in and upset a few of those transactions, said no to a few, implications which were pretty severe on a few of those companies that were not able to merge. And given the pent-up demand and demand for growth for these companies, and I think you will see some once the first move in the tariff environment, once that move gets digested, the implications of which are still going to be long-term, as Bob referenced.
Well, and Bob, something that you talked about is that one of the foundations to the business climate in the United States has been some level of predictability.
Is what?
Some level of predictability.
Oh, boy. Yeah, and I think what we're doing, absolutely, Lisa. And I think that goes even beyond that. The rule of law underlies our economy. And I think and that gives you certainty and predictability. And I think a lot of what is going on is adversely affecting confidence. It is now, and I think will more so in the future. Confidence in the rule of law. This whole discussion about retribution and the use of the law enforcement agencies in the United States to attack our opponents rather the administration is a good example. I think just as I said a moment ago, I think the violation of our treaty obligations to Mexico and to Canada. So yeah, I think that predictability and confidence are essential and underlie our economy. And I think another good example, if I may, of something I think is doing tremendous damage, which is DOGE. I've spent my entire career focused on fiscal discipline. We balanced the budget in 1998, first time in 30 years. I think we knew what the heck we were doing. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government and to the recipients of government services and government activities. Now, are there excess expenditure? Are there inefficiencies? And is there excess regulation? Yes. But you approach it with a rational cost-benefit analysis, not a burn and the burning down of what exists, and then the thought that you rebuild it. And I think we really are doing tremendous damage to government and to our economy.
Ray, you're nodding. Do you want to add in? Or you're like, no?
The answer is, the response is, as you think about the world, geoeconomically and geopolitically, the anchor, the sacrosanct anchor that the U.S. has is rule of law. It has never been a factor in any conversations that we've had up to this point.
Is it a factor now?
It is moving into the conversation in ways that we haven't visited historically. So we need to be very mindful of conversations that today, it is not central to the conversations, but it has now become part of the conversation where historically it hasn't been.
One thing that some people would argue, the Trump administration argues, is that this is an effort to rearrange a system that has been structurally disadvantaging the United States, especially when it comes to China. And they make the argument that you need to play tough and do different things to try to shake up the status quo. Are companies still talking like that? Do they expect this to just be a negotiation, that they're, to Ray's point, Bob, that there will be a new normal that will emerge, and that the second half of this year will have a more stable kind of foundation that's more visible for corporations?
Well, what kind of a new normal do you want to have, Lisa? I think that no, I'm serious. I think there's a new normal of irrationality, and I don't think that's going to be helpful to our economy. I think our new normal ought to be to return to sensible cost-benefit judgments about everything that we do in terms of public policy, and I think we're doing exactly the opposite right now.
What we're hearing from companies, Ray, is that there could be some reasons behind some of the tariffs, and some investors have come out and said that tariffs are a tax, but some have said,
Well, they are a tax.
some have come out and said that, that they can manage through this. The U.S. economy is strong and resilient, and once we're past this negotiation tit for tat, they can continue with the growth plans, and they still are optimistic about the consumer. Ray, have you heard anything different than that?
I think there is optimism still, but optimism maybe without the same level of conviction, right? So the randomness that appears to be at play here is not one that gives boards and CEOs a lot of confidence. So whatever the new normal is, will they react? The answer is they will react whenever we get there. If it's a new normal of continued unpredictability, then it's not quite certain how aggressive people are going to act. So I would continue to pay attention to the volatility index. I would continue to pay attention to the 10-year Treasury, which I think what the administration is currently looking to as guidance, and see if we get to a new normal, what that new normal looks like. It's not clear yet.
Bob?
Yeah, and if a new normal, Lisa, is the new normal in which the world has tariff walls, we have, because after all, we're going to have retaliation. We're having retaliation already. We'll continue to have retaliation. And if the new normal is a world of tariff walls, then we'll all just be less productive, less efficient, and less effective as economies. And our people will, as a result, do less well than they would otherwise have done.
You mentioned the 10-year Treasury yield, and Scott Bessent has made it, the Treasury Secretary under Donald Trump has made it very clear that the 10-year Treasury yield is his North Star in some ways, that he wants to bring yields lower. That is a requirement to deal with the deficit that we have. Is that how companies are thinking about it as well? Is this how people are thinking that actually 10-year Treasury yields lower?
How, pray tell, does he plan to do that? Seriously. Yeah. This is something I know a little bit about.
Oh, yeah.
How, pray tell, does he... No, I'm serious. I was at Goldman Sachs 26 years. This is what I did for a living, and I was at Treasury for 1 year. How does he want to bring 10-year yields down?
Well, he says that according to his plans, that there will be greater efficiencies through Doge, but also through cost cuts.
Doge isn't going to create greater efficiencies. What Doge is going to do is tear apart our government.
But then he also
What you need are greater efficiencies, and the way you do that is you look at the excesses in both regulation and government, and then you approach them with a reasoned cost-benefit analysis, not slash and burn.
Well, the 10-year Treasury yield has been down every single week since
What?
Donald Trump. The 10-year Treasury yield has been down every single week.
Yeah, because people are starting to worry about the economy.
So then I would ask you, Ray, at a certain point. No,
I'm now being excluded from the conversation.
I want to go back.
All right, no, I'll sit here totally quiet.
No, I would love to have, to further the conversation.
Oh, that's what I'm yielding to the secretary. And I'm looking at the chart here, and unfortunately, he happens to be right. So.
Well, no, this is really the key question. And actually, to your point, there has been this theory that if yields go down, you end up with more economic dynamism because companies will invest more. And that has been the Fed put, right? This idea that if they lower rates, that will encourage people to spend more. That is not what we're seeing in markets. That is the opposite. What we're seeing is yields lower, risk off, people scared.
Yeah, exactly.
To your point. And Ray, to your point, from your perspective, do companies see yields lower as a positive shift before when we were talking about the potential for rate hikes? Or are they growing increasingly concerned, to Bob's point, that this really represents a pretty massive and seismic shift in the economy?
Remember, we're responding real time, right? I got a pretty low 10-year, and I got a stock market that sold off $2 to $3 trillion today, and a VIX that's gone up by 20%. So the data is, and I got a conference call that's taking place now up north. And I got one that's going to take place tonight.
We're not letting you leave.
I got one that's taking place tonight that we're all going to witness. So the question is CEOs are waiting to digest as much, and boards are waiting to digest as much of this information as they can, and then somehow position themselves for what the world is going to look like after the next 2 days or so. But it won't be just that. They have to look at the entire supply chain infrastructure and how it impacts what they do, as will the U.S. consumer. And if you go through and look at the implications on the large retailers out there, both electronic retailers and food retailers, look at consumer staples. For some reason, consumer staples are up. I'm looking at some of the companies with which we interact every day, and their stock seems to be moving in the right direction. Well, right direction means the stocks are moving up. And I'm looking at this, and you're looking at the VIX here.
It's easier sometimes to talk about what the market's doing than to
You
really
have a
weigh
bot working here, so it's something that we suggest you put a slide up.
You can just keep talking about this, Bob. I want to come back to you about this idea.
I thought you were excluding me. Now you want to come back to me? I may not engage, having once been excluded.
I think you'll engage. I'm
You
curious.
nailed it on the yield, so she's a little bit.
You're talking about how you have quite a bit of experience as being the Treasury Secretary.
Ton of experience, but go ahead, yeah.
And and you said, how is he going to bring down 10-year Treasury yields? And right now, we see them dropping.
The best way to bring down treasuries is to have a sound economy, and then have, in response to that, have sound monetary policy, and then have treasury yields adjust accordingly. You don't want to have yields go down because people are concerned that we're going to have a weak economy or that we may run into growth problems.
It raises this question, even if these tariffs come off, even if they're rolled back.
If what rolls back?
The tariffs.
Oh, I'm sorry.
If they are being used as a cudgel of sorts, how long can this uncertainty remain before just the idea of having uncertainty is really pernicious for growth?
Keynes famously said that confidence underlies economic activity, and confidence is predictability. And I think that the actions we're taking, the tariffs, the immigration actions that we're taking, what we're doing with DOGE, as I said, I think doing tremendous damage to government and ineffectively addressing what is a real problem, which are inefficiencies and excess regulation. I think all of that have not only substantive effects, but adverse effects on confidence and unpredictability. And I think all this talk about retribution, of which there's been a lot of talk, I think feeds that lack of confidence and unpredictability.
Ray, from your perspective, how long can this go on before companies that are delaying some of their investment plans just take them off the table?
You know, I think it's early days. Again, I think you're in the early innings of this tariff diplomacy, and companies are pretty wise and thoughtful about how they engage. This still remains the largest, used to be the fastest growing economy that exists on the planet, so there's still confidence in what's taking place in the U.S. Notwithstanding the lack of predictability. A lot of reserves, a lot of capital reserves, a lot of pent-up capital that needs to be allocated. So I don't think there's going to be a rush to judgment. Having said that, the more the actions are unpredictable, then that goes to the level of confidence that exists with senior managers and boards. They will wait this out to see what the implications are and how severe are the implications, and then take a decision on how they're going to move forward.
Is the United States still the best place in the world to invest?
I would rather, that's a good question, Lisa. I would rather invest here than any other economy, but of course that a little bit reflects on what's going on elsewhere, China, Europe, et cetera. I mean, those are all places with tons of problems. But having said that, I think it's the greatest uncertainty. Having said that, I think it's the greatest uncertainty in the 26 years that I've been involved, or rather 60 years roughly, that I've been involved in decision-making of one sort or another with respect to markets and economies. And I think those risks have been substantially increased, as we discussed briefly, by the actions of the administration or the prospective actions of the administration. I think one other thing, if I may, Lisa, I think we have an unsustainable fiscal trajectory. And I think that is what the administration says. The problem is I don't think they go at it the right way. I think you can be rational about trying to save some money, and I think we can save some. But I think as a practical matter, that is a very limited, an opportunity, but a very limited opportunity. And fundamentally, we need more revenues. And if you look to tariffs for revenues, you'll get more revenues, but you'll be adversely affecting growth. And the offset of that is probably, and I've had this modeled for me actually, the offset of that is a very small, if any, net increase in revenues. But the answer lies predominantly on the revenue side.
Ray, your thought about whether the United States is still the place that everybody wants to invest?
You know, without reservation, longer term, yes. I look at the advances that have been made in technology, the
What about
Mac 7
short-term?
being examples, if I look at all the advances that we're making across the landscape, notwithstanding our dependence on supply chain in many ways, this still is the most attractive, the greatest country that exists.
What about next 6 months?
We're going to go through some challenges over the next 6 months. We'll be challenged. Will we get through them? The answer is yes, presumably. Now, the challenge I have is that it's a historical mindset. We've not seen factors come into play historically the way we see today. And so, and I say that with a bit of conviction, not necessarily the hope, but a bit of conviction. Hope will always be there, but conviction that we'll get through this.
We're out of time, unfortunately. I could spend all afternoon with the Honorable Ray and the Honorable Bob. Thank you so much for taking the time. Really appreciate it.
Thank you.
Don't use the playbook for the last 10, 15 years for the next 10, 15 years.
Please welcome to the stage Nir Bardea, CEO of Bridgewater Associates, for a conversation with Bloomberg's Sonali Basak.
So, Nir, people had heard you just say this, and I was paying attention to this too, because it was the last time you spoke to Bloomberg. You said that the playbook used by investors for the last 10 to 15 years can't be the same playbook that you use for the 10, 15 years ahead of us. And I've been thinking ever since, what is Bridgewater's playbook?
So just to expand, because I think things played out basically in that way. And we look at markets today, you look at the last month, and just to lay out how the world has shifted and therefore how Bridgewater's aligned itself with the shifts in the world. There are three big shifts that we've been watching. One, and I'll go through that really quickly, there's a macroeconomic paradigm shift. That's what I was talking about back in Doha, where we've come out of a period of decades of globalization that started with the fall of the Berlin Wall, China joining the WTO, that led to expansion of profit margins and enjoyed kind of disinflation. That was a long period of excessive gains in the world. And the problem is that those gains were distributed very unequally. They led to the rise of China. They led to emerging markets economy enjoying it, but they also led to the hollowing out of the manufacturing base in the middle class in the Western world. And as a result of that, it started a political shift that ended up bringing a new regime here in the US, in Europe, in Canada. And back then I was saying, hey, look, this tailwind that we're enjoying now is gonna end, and you have to embrace that change in the macro paradigm and prep yourself for a different reality. I said other two quick things and then kind of touch on how Bridgewater has aligned itself for it. The second thing that has happened during that time is that while wealth got distributed, I talked about Asia and China, the Middle East, portfolios actually got a lot more concentrated. If you look at our institutional investors, they have more than doubled their allocation to private assets. Even if you look at their liquid part of the portfolio, unbelievably concentrated in the US. I heard the questions kind of at the end of the last interview of, is the US still a great place to invest? Well, a lot of the investments has gone to US equities. 70 cents of every dollar in equities has gone to US equities. And that means that they are incredibly vulnerable going to this new economic paradigm. And the third thing, which I know we're going to talk about more a little bit later, is all this is happening when we are facing a once-in-a-generation technological disruption. We've been talking about AI for a long time, but it's here. The intelligence is here. And the macroeconomic impacts of that are just trickling in. So CapEx this year will double last year, and it starts to move the needle, but the questions around productivity and therefore employment and social implications is still outstanding. Bridgewater's playbook has been looking at this for a long time and saying, how do we position ourselves across these three things in order to be there for our clients when they need us most? And I'm happy to talk about that more.
Yeah, let's start with the last piece of that, because on a day like today, maybe everyone's thinking about the short term, but the long-term trend has been thinking about what AI would do. What is the good, the bad, and the ugly of it all?
So, man, there's so much words that are being said about this topic. And I'm going to add some words on top of that, but I'll kind of give you our framework to thinking about it. We've been forever thinking about the best combinations of humans and technology. Because if you think about our mission is to understand how the world works through combining humans and technology, because no one human mind can wrap their head around everything in the world. And that means that we've always searched for how technologies can replace what humans are doing so humans can do what technology can't do. And what I can tell you is that I think it's a fool's errand to try to be precise about how this is going to play out. I'll give you two examples of that. When I said technology is here, one school is saying we are headed to full agentic AI, which means we will sit back and everything is going to be replaced by AI. That could happen. Others are saying this is going to be general purpose technology, which is still very impactful, but it's wildly different than fully agentic AI. And people can be very specific about where they think that's going to land. I don't think anybody knows. And the most important thing is to prep yourself for a wide range of outcomes. I'll give you another example, which I think is really important to kind of process with regards to the macroeconomic paradigm that's shifting. And that is that, the optimists say, yes, we are in a modern mercantilist world, meaning the opposite of globalization, a world where we have less efficiencies because governments are trying to avoid the vulnerabilities of globalization. The optimists say, well, we are headed to a productivity miracle. It's going to be great because these technologies are going to more than offset whatever we lose from the less collaborative world. Okay, that could happen. It could totally happen. But the pessimists say, hey, the reason we're here in the first place is because there were massive gains in this macroeconomic paradigm that were distributed very unequally. We had big winners and losers. Well, the pessimists say AI is going to exacerbate that tremendously. When we have massive winners and losers, it's going to be disruptive to society. How those things net out has such a wide cone. And I think, again, it's a fool's errand to kind of try to predict exactly what's going to happen. So my advice, and what we do at Bridgewater, we try to be practitioners. So get your hands dirty, understand the technology deeply, and then prep yourself for a wide range of outcomes of how this could play out.
Speaking of getting your hands dirty, Bridgewater has been using AI for its own processes. Late last year, you launched a fund over at Bridgewater, starting with $2 billion, that uses machine learning as the primary basis for decision making. It was built on proprietary technology. What have you learned from this in terms of how machine learning-based investing is different from human-led investing?
So I'd say I feel very lucky. Because of Bridgewater's DNA as we're coming to this inflection point. I said earlier, from the 80s, the idea that no human brain can possibly get their head around everything in the world meant that we always try to replace humans with machines. So we are not moving from a human-led investment process to a machine-led investment process. We were using scientific calculators, and then we were using Excel sheets, and then we were using the most complicated expert systems. This is AI before AI. To make investment decisions in a systematic, fundamental way. So for us, this is another step along an arc. And what we have learned through this process of what we call AIA, this is the Artificial Intelligent Investment Associate. That's a strategy that we rolled out in the beginning of last year that it does the same thing our people do, but in a machine learning first way. We learned through scientific breakthroughs within Bridgewater that you can reason, that you can generate alpha in a machine learning first way. That strategy competes with our expert system in humans and generates unique alpha that is uncorrelated to what our humans do. That's been running now for a year and a half, and it's comparable, and that's mind-blowing in the space of possibilities of what could happen. And so one last thing, beyond the numbers that are happening this year, or in any given short period of time, the most important thing is it keeps us up to date on where things are going, not only within the asset management industry, but also as you think about how this is going to impact the macroeconomy.
So it's interesting, at the time of the launch, your co-CIO at Bridgewater, Greg Jensen, said the fund had the potential to change the hiring and composition of staff. What skills do you think the future employees of Bridgewater are going to need? And, you know, we were kind of joking a little earlier, maybe the junior analysts don't go away, but boy, do they have to be doing something different.
Which has always been the case, truly. Because when you have an expert system that does a lot of what humans do in other funds, as an example, you really start to move people to do what machines couldn't do. So we have been shifting the type of humans we bring into Bridgewater for 50 years. And that means from really looking for analytical skills and financial backgrounds to people that are conceptual and can ask philosophical questions and query, as an example, because they're going to be very levered with technology and how they explore their questions. That's been constantly moving, and I think this is a big shift, but it's a big shift in the same direction of what can humans do, the future analysts? What can they do that machines can't do? I'll say the one thing that is on my mind that I'm worried about. When you think about that arc, you have to think about what trains people over time. So there are basic jobs that people have in many places where you sleep under your desk and you do, you know, the tough work that then leads you to be able to do the higher level, more conceptual things. One of the things we're thinking about is, hey, we are well positioned already to replace a lot of the basic tasks with machines, but what does that mean to talent development over a long period of time? You have to be conscious not only of today, but what does it mean for your talent strategy over the long term?
You know, how does this fit into the broader trajectory of Bridgewater? When I think about where you stand today, you've inherited this firm that's now roughly a half century old. How do you position the firm for the future? This is all in the scope of positioning for the next 50 years. What is Bridgewater 2.0?
So I think the best way to hit this is to go back to the three things that I've said, because it's where our heads are at. There are things that are the bedrock of Bridgewater. Bridgewater truly, and I think I said this on this stage years ago.
Just after you were named CEO.
With Eric Schatzker. Bridgewater is about getting an incredible group of people together and have this very, very unique culture that puts in the center of everything the desire to be excellent and constantly learn, because that's the only way to accomplish this incredible mission of mapping the deepest understanding of how the world works in a systematic, fundamental way through a combination of humans and technology. That stayed the same. If you look at the three things that I've said, I said the macroeconomic paradigm is shifting, and because of that, that means that beta, the tailwind, is done. Alpha generation, the positive, uncredited alpha, the pure alpha as an example, return for 33 years is more important than ever. A deep understanding of cause-effect linkages of how the world works, more important than ever. We have to hold the hand of our clients in days like today and months like the last month, where they're asking, how are these new policies going to flow through the economy? What's going on? So tremendous focus on improving the quality of our understanding in our alpha. I said the second thing is concentrated portfolios for 50 years. You've said this. We're celebrating our 50th year this year. It's always been about partnering with CIOs and CEOs of the largest pools of capital in the world and helping them achieve their goals. These are investment goals, resiliency, diversification. We've been very, very focused over the last couple of years to make sure that we can increase the impact across their portfolio, because their allocation to pure alpha is going to be small, but in $1 trillion portfolio, they're going to want to know that you have the capability to invest, not in the US as an example. If everybody's investing in the US, we've been really focused on building the capability to invest in China. As an example, our onshore strategy last year returned 30%, and I say that not because of the number, I say that because it shows where our focus has been. And the last thing is what we've talked about, which is in a world that technology is going to disrupt us tremendously, making sure that you have a partner in Bridgewater that is the curve, that is where the scientific breakthroughs are happening, that you can lean on to show you where things are headed. Those are the big three areas that we've been focused on for us.
Now, we'll get back to where things are headed, but before we get there, I just want to give the audience a chance to get to know you a little bit, because the more I've learned about you, the more your story is kind of like nothing I've ever, it is like nothing I've ever seen in finance. So you didn't graduate from high school initially. You eventually went to Wharton, and then you started at Bridgewater as a 33-year-old intern. How?
I mean, Sonali, my Jewish mother, for you saying that I didn't graduate high school on this stage is probably like, her heart is broken right now. But it's true. And and I've never shared this actually, so I've said many times that I look different. I know I'm different. The amount of people that commented on the fact that I'm not wearing a tie today. I am different. I come from the other side of the world. I come from Israel. I've talked historically about being a third generation to grandparents that were Jewish refugees, family that was murdered in the Holocaust, and I talked about how the story of my life is connected to seeing them establish a country. And I talked about how an incredible group of people with values can do incredible things. And I always jump the story and say, and then I ended up in Bridgewater. To your point, if you double click on that story, and I've been reflecting on this a lot lately, I was a bad student in high school. I didn't get a diploma in the end of 12 years, and I was very, very lucky that in Israel, there is a mandatory service that everybody has to do at the age of 18. And because people like my grandparents that come from Libya and Hungary and Poland, looking different backgrounds, different languages, needed to come together to accomplish this really incredible task of putting a country together, they knew they had to make the most out of the total human capability and do that through the service. So the service ignores everything that happens up until the age of 18, and based on your merit, reassesses you. I tested at 18 thinking that I was incompetent and tested extremely highly. And that changed my life. It led to a very successful service. And the reason that's important is because 15 years later, you're right. I'm a 33-year-old, already with gray hair, winter intern at Bridgewater. It's me and 6 other hungover Dartmouth 20-year-olds. And my English is not great, and I'm out of context, and it's pretty confusing, and to say that I feel lost is not even the beginning of it. But again, I'm at an organization that is trying to make the most in a meritocratic way out of the human capital that it has, because they're trying to accomplish this incredible goal. And it leads me to kind of 3 big lessons. One, luck matters. Luck matters. I was lucky to be in a society where I got a second shot in the service, and I was lucky to come across Bridgewater. I could have come across a different organization. The second thing, and I connected back to the AI point that you talked about, differences in thinking and unique contributions are very valuable. And I think that's especially true in a world where a lot of the generic intelligence is going to be commoditized. And the third thing is the way to capture unique ways of thinking is to aspire at least to have a real meritocracy. That's true in Israel. It's true at Bridgewater. I think that is the key in us unlocking and facing some of the biggest challenges we have as corporations and as a society.
So another major part of your background, as you've been talking about, is your Israeli heritage. And you were talking about complicated geopolitics. In the past year alone, you've been back to Israel. You've spent a lot of time in the Middle East, including Saudi Arabia, Qatar, Bahrain, all in your capacity as the CEO of Bridgewater. What can you share about the trajectory of the Middle East, and do you see a path to peace when it comes to the conflict in Israel?
Wow. Let me start where I feel like I have to. October 7th is incredibly personal for me. And not just October 7th, but also what happened subsequently. There are still 59 hostages in Gaza. There's suffering in Gaza. There's suffering in Israel. There's suffering in the entire region. These are family members, my community. This is my community of Bridgewater. Some of them are neighboring countries. These are partners of Bridgewater in neighboring countries. It's been a year and a half of trauma, truly trauma. And my heart goes to everyone on this. It is important for me to say that I'm proud to be Jewish. I'm proud to be Israeli. I'm proud of my country, men and women, and I feel very lucky that I've had the chance in this job, to your point, to go around the world, and including in the Middle East, in places that matter, and represent, hopefully, the best of Israel, and learn about the best in many of the countries that you've mentioned. Forge real friendships with people and incredible, incredible leaders. And to your question about where things are headed, I've said this before. I have a deep belief that, look, tragedy and trauma and suffering leads to resiliency. And resiliency leads to evolution. If you look at the Second World War and the New World Order that came out of it, if you look at the Great Depression and the new economic paradigm that came out of it, if you look at the Holocaust and my grandparents, rising from the ashes and building a country, if I said that a great group of people can come together and share values and forge a different future, I go back to all the people that I've met in the Middle East, not just in Israel, but in Saudi Arabia, in Bahrain, in the UAE, There's an incredible, resilient generation that has suffered a lot. And I am actually more hopeful than ever that that generation can create a completely different future going forward in the Middle East and a 100-year peace.
What role does Saudi Arabia, does Qatar, does the U.S. play in negotiating peace here? And is there a 2.0 version of the Abraham Accords?
I mean, that's really not for me to answer. The thing I would say is, yes, I think that Saudi Arabia, the U.S., the UAE, Bahrain, when I say there's a generation of leaders that when I talk to these people, they're just like me. They have the same exact aspirations as I have. And I think a coalition of that group of people in Israel and in the region is the way to create what you call the Second Abraham Accord, and it's coming. I'm more hopeful today, Sonali, honestly, than I've been 5 years ago. Because out of this suffering, there's a crystallization, the realization that creates the necessity to evolve and take the region in a different direction.
And I want to get your thoughts clearly on this because the human toll has been devastating both in Israel and in Gaza and beyond, really, at this point. How do you see the conflict playing out, given that the ceasefire talks have stalled?
Well, if I said that it's a fool's errand to guess where AI is going, this is truly a fool's errand to guess. But I would say this, until the hostages are released, there's no solution. Also, until there is a future for the Palestinian people, there is no solution. And there are solutions that can be put together, but they will be put together by a new generation taking leadership and coming together and making sacrifices that previous generations were unwilling to do.
You know, a lot of people look around and they say, in the wake of World War II, when you look now, there are a lot of the protections that were put in place to make sure that the world didn't fracture again. Some of those protections are now under threat, particularly with the changing guards across countries. Do you worry about that?
I mean, personally, yes. I think that's a part of the macroeconomic paradigm that is also a geopolitical paradigm that has shifted. The world post-World War II, out of the trauma of World War II, started a series of events that led us to not only put protections and institutions, but increased collaboration decade after decade after decade, leading us to a long period of extreme collaboration over the last 30 years. There is no question that that paradigm, geopolitical and macroeconomic paradigm, is being undone. Now, there are reasons why that's getting undone. There are problems that were created that I mentioned earlier in this conversation that need to get fixed. But if that's not done well, you can, instead of correcting the problems that the system had, you can create a disaster. And I worry that, you know, between correcting the problems and causing complete chaos, we can easily end up being in chaos.
Before I let you go, this is kind of another bummer of a question, so I apologize, but do you think the world is more dangerous today than it's been in a long time?
The world is more dangerous today than it's been in recent history, but I think this is one of the problems that we have as humans. If you go back, not that long, go back 150 years. If you're in the US in the 1800s, it is tough. You have militias, women have no rights, black people have no rights. Then you have the Spanish flu, then you have the Great Depression, then you have World War I, World War II, you have the assassination of Kennedy and Martin Luther King. We have a bias to remember the last 30 years, which were particularly calm. So the world is more dangerous today, but this is not a bigger problem than we have seen in the history of our parents and grandparents. We can deal with this as long as we embrace reality, understand it well, and come together to find solutions.
Thank you for such a clear conversation. That is Nir Bardea, of course, the CEO of Bridgewater. Thank you for your time.
Thank you, Sonali. It's great to be here.
What a morning of discussions. I can't even remember what day it is sometimes, considering how much has happened since we woke up today. I hope you all are enjoying the conversation so far. I know I'm enjoying the interviews as well. It's lunchtime. Before you head off, I have some important directions for you, so bear with me for just a minute. because most of you, you're going to head out these doors, turn right, go downstairs for our general lunch. We have a special treat for you there this year. Bloomberg Intelligence's top analysts will be sharing their 2025 outlooks exclusively for you, all in person today. They will be leading some networking conversations at tables on global equities, private credit, ETFs, and more. And they are the smartest people that I have ever met in my life. So please be sure to talk to them. Also, while you're downstairs, visit Invesco QQQ and their new activation, Race for Innovation. It's a first-of-its-kind game that gives users a chance to race against each other, all while learning about their ETF products. And if you're registered for the Drivers of Return Lunch, proudly sponsored by Invesco QQQ, you can head out these doors and continue into the hall where you first walked in today. That session is located in Hub 1. And I will see you back here at 1:45 p.m. sharp. We have a huge afternoon. We have Gary Cohn, Fed President John Williams of the New York Fed, Apollo President Jim Zelter, ARC's Kathy Wood, and many, many more. We'll see you soon.
Didn't save you a seat, just find a lap to sit on, and you'll get something to eat. When they serve the tea, sugar dissolve. Just don't go confusing sugar with love. Sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy. My mama was cold, and she was told she'd never been young, so she never grew old. She took a deep breath and never exhaled. Lived the rest of her life from under a veil. I grew up quick, but I grew up strong. Didn't get to be her baby too long. Whenever I'd eat, I just craved sweet. What I couldn't get at home, I got in the streets. Sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar man, sugar man, sugar daddy, sugar daddy, sugar daddy, sugar daddy, sugar man, sugar man, sugar.
Stay right here, I'll be coming home soon. I just emptied my lungs to some empty room. So much to say, but I just hold my tongue. The whole world's for the taking, I'ma get me some. I can do no wrong. No wrong. stopping now, 'cause I'm due for arrest. Been accused of the worst by some blue ribbon best. There's no mystery, no, there's nothing at all. I'm just repeating myself since I wrote Southern Drawl. I can do no wrong. No wrong. No one really hurts me like you. No one hurts me quite like you do. Cut right through me with all that truth. No one hurts me quite like you do. I was the champion, but I folded my hand. I got lonely up there in that one-man band. And now I'm falling for a friend of a friend. I see my whole life coming up round the bend. I can do no wrong. No wrong. No
bubbly toes on the feet of a queen of the hearts of the cards, and her feet are all covered with tar balls and scars. It's a common as something that nobody knows, that her beauty will follow wherever she goes. Up the hill in the back of her house in the wood, she loved me forever, I know she could. Remember when you and me, how we used to be, just good friends, wouldn't give me none, but all I wanted was some. She's got a whole lot of reasons, she can think of a single one that can justify leaving. He got none, but he thinks he got so many problems, and he got too much time to waste. His dreams are like commercials, but her dreams are picture perfect, and our dreams are so related, though they're often underestimated. Simple as something that nobody knows, that her eyes are as big as her bubbly toes, on the feet of a queen of the hearts of the car, feet are infested with tar balls, and la da 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 da, la da 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 da, la da 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 da, la da 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 da. Well, I was eating lunch at the DLG when this little girl came and she sat next to me. Never seen nobody move the way she did. Well, she did and she does, and she'll do it again. When you move like a jellyfish, rhythm don't mean nothing. You go with the flow, you don't stop. Move like a jellyfish, rhythm is nothing. You go with the flow, you don't stop. It's a common to something that nobody knows, that a beauty will follow wherever she goes. Up the hill in the back of a house in the wood, she loved me forever, I know. She la da 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 da, la da 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 da, la da 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 da, la da 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 da. If you would only listen, you might just realize what you're missing. You're missing me. If you would only listen, you might just realize what you're missing. You're missing me. It's as simple as something that nobody knows, that her eyes are as big as her bubbly toes, on the feet of a queen of the hearts of the car, feet are infested with tar balls, and la da 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 da, la da 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 da, la da 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 da, la da 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 da, la da 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 da, la da 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 da.
Please take your seats. The program is about to begin.
What's going on inside your head? 'Cause if we're sitting in the silence, what's not being said? I just try to keep you laughing, to keep a smile on your face, always gauging your reaction. So I know.
Please welcome to the stage, from Bloomberg Intelligence, Gina Martin Adams, Global Director of Portfolio Strategy and Chief Equity Strategist, Eric Balchunas, Senior ETF Analyst, and Paul Goldberg, Director of Research and Senior Equity Analyst for Financials.
Hi, everybody. Hope you're enjoying your lunch. I'm Gina Martin Adams from Bloomberg Intelligence, joined by my colleagues Paul Goldberg and Eric Balchunas. We're going to spend a few minutes going through our outlooks for our various asset classes and then forward forward to joining you at your tables for a bit of chat. But first, we're going to run through my outlook for equities. I have 5 minutes to go through the entire outlook for the equity market, so buckle up. It's a very exciting time in stocks right now. We're going to talk about the five biggest risks to stocks coming into 2025. One of the biggest shifts, I think, coming into 2025, in particular relative to the last 2 years, in our models, we follow 17 different factors to identify direction for the equity market, but our models were saying this year was going to look different. And one of the biggest reasons this year was going to look different is because of sentiment. As of December, our Market Pulse Index showed manic sentiment in the equity market was pretty evident. Intriguingly, that manic sentiment survived through January and even February's correction. So with the recent weakness that we've had in stocks, our models are still suggesting there's a bit of mania out there. As a technician, this is incredibly important to our outlook for stocks, as I do believe tactically you want to pay attention to where sentiment is in the equity market, and the best time to put on risk is when sentiment is terrible. Second risk to note is policy. Obviously, this is hitting us in spades today with the tariffs as they're hitting the tape, but policy broadly is becoming a risk to U.S. equities on a number of fronts. Both upside and downside risks are likely to emerge from policy. We've done a tremendous amount of work on tariffs. There's a big deep dive from BI on your terminal today, so I would encourage you to look at that for the tariff risks across various industries and sectors. But for the market at large, tariffs are a risk because of the potential margin pressure that is likely to emerge with tariffs. We find that 40% of S&P 500 factories are now located outside of the United States. Almost half
high up in the summer air that takes you to a place, oh, you just like a dream. And ooh, you set my head and heart on fire. And ooh, wish I could go back to that night. There was something kind of magic, the way you walked in through the door. Through a crowded room you caught me, and I swear my feet stuck to the floor. When you made your way up to me, did I know you from before? I think you had me from that moment. I wish I never let you go. And ooh, you set my head and heart on fire. And ooh, wish I could go back to that night. And ooh, you'll be forever on my mind. And ooh, you set my head and heart on fire. Poured my glass of wine. You caught me some fireflies. Told me their names and how much they love their life in a jar. You twist around me like vines. You rub the stars in my bright eyes. And you sold me a future from the ones you had in the trunk of your car. You said I think too much. this moment. Wait until you see, and how mighty the truth can be. How her hammer and nails chisel beauty from grotesque things. You say I think too much. Tell me I always mess it up. Well, I'll break the glass and see if the fireflies agree.
Hey y'all, thank you so much for joining us for the special lunch session. My name is Brody Ford. I write about the tech industry at Bloomberg, and I mean what that's meant in the last couple of years is AI, right? Whether it's the vendors selling it, the companies implementing it, and I think in that that early cycle, that kind of early 2023, even through that year, a lot of us kind of got sick of the forward tense language, the we will ship, we will implement. And what's so exciting about 2025 is we're pretty much past that. I mean, a lot of this stuff is really happening in production. And so today we have 4 leaders from some of the most forward-thinking companies in this space going to kind of run us through what they're seeing and what they're doing. Feel free to take pictures, post quotes, whatever, on social media, LinkedIn. If you do, just, give us a shout out, give us a hashtag Bloomberg Invest. And yeah, we want to thank our title sponsor, Invesco QQQ. Could not happen without them. And with that, to set the stage, I want to introduce Ryan McCormick from Invesco.
Thanks very much, Brody, and thanks everybody for the time. Also, thanks Bloomberg. This has just been an incredible sponsorship. I think this is my 4th year at Bloomberg Invest, and it's an event that I look forward to every year, just with the caliber of speakers and the programming. I always take something away. So at Invesco, I'm a senior factor and core equity strategist. It's kind of a fancy way of saying I cover about 110 ETFs, and probably no one more well-known than Invesco QQQ. I'm really excited for the drivers of growth, because with Invesco QQQ, we try to figure out what has been the drivers of growth for this fund. We're celebrating 26 years of live track record this year, and in some cases we almost have to reverse engineer the story. It tracks the NASDAQ 100 index, which is comprised of the 100 largest companies listed on the NASDAQ exchange ex financials. And it's, when we look at performance, it's, well, why or what specifically has enabled these companies to be so successful? And we kind of land on the notion of innovation. These companies have been very innovative. We take it a step further. We try to quantify that innovation by looking at metrics like research and development spend. A lot of these companies spend more than their peers on R&D. That leads to considerable patent activity across a number of different disruptive technologies. And ultimately, we think that is the main driver for fundamental growth. But I think in this day and age, you can really boil it down to success is really tied to the ability to stay nimble or the ability to change. A lot of these companies look a heck of a lot different today than they did 10 years ago, 5 years ago, or even 3 years ago. So it's that ability to embrace and sort of cultivate change and stay ahead of changing consumer preferences, consumer trends, I think ultimately is what makes a lot of these companies successful. So with that, I'm very excited to hear about the drivers of growth from some of these leading companies, Bank of America, ServiceNow, Dell, and Goldman Sachs. And with that, I'll leave you to your lunch and to enjoy the rest of the programming. Thank you.
All right, we're going to be digging into what's driving growth at Bank of America. Aaron Levine's going to tell us all about it. He is a president of Preferred Banking. But before we even dive into that, Aaron, I have to tell you, it's been quite a day.
It has been quite a day, yeah.
So what I'd like to see if you can kind of set the tone. I mean, with so much volatility, tariffs, new administration, geopolitical concerns, what's the mood amongst some of your employees, among your clients?
Yeah, well, good to be with everybody. I mean, I think the first thing to remember is the mood has been very good. Put today aside for a second.
Okay.
Right? You know, we started the year, spending, consumer spending has still been strong. It's still 5 or 6% up year over year. So that's a good sign. And I know there's signs and there's different companies that came out today saying there might be some solace, but generally speaking, good, strong growth. You still have very low unemployment. You still have wage growth. You still have our clients. If you look at their balances and their banking and savings accounts from now versus 2019 pre-pandemic, it's still quite high, quite a level higher, and it was still up year over year. So what you're seeing, and especially in the cohorts that are sort of below 50,000, below 20,000, they actually have still some reserves. The upper levels, their money has moved more to high yield type alternatives, and so it's moved to the market. So I think you come into it with a fairly good set of stable things, right? But now, because of tariffs, because of increased uncertainty, you see what happens today, and people start reacting to it, and then we'll see where that goes.
And what about your employees? I mean, how do you talk to them throughout all this?
Yeah, well, our employees, their focus is always on our clients. And I think the thing that we keep reminding them is this is why you're important. And so we have 30,000 associates in financial centers across the country, and some of them work on lending, some of them work in small business, some of them are financial advisors. But all of them are there to support clients through these times of needs. And, you know, whether it's major events like we had in LA, and our associates are proud to support the community during those times, or it's more volatile market days like today, the associates know that this is what they add value, and they're supporting clients, and this is what's important about what they do.
Now let's get into where you're finding the opportunities with all this talk that we've had for today. Where, in saying consumer banking, where are you seeing the trends among spending, among saving, among investing?
Yeah, so as I said, spending has been up, and investing, what we offer our clients at Bank of America is really in a whole continuum. So everything from self-directed through our Merrill Edge platform, which we've seen enormous growth over the years. We recently hit a big milestone of $500 billion, we maybe we'll talk about, to then more guided, which is a sort of digital model, to then, of course, true advice through Merrill Lynch and the private bank. And I think what's really important is then clients of every level of wealth have someone to talk to, and really the focus in on thinking about long-term investing, thinking about what's important to them, what are their goals. And so what we hear consistently is clients who really want to sit down and talk to us about, I need to save for my child's education, I'm trying to save for retirement, I'm trying to think about buying a home, all these competing life priorities. And so that's the challenge. And, days like today just add some, maybe stress over thinking about it. But we keep making sure that we bring our clients back to what are you saving for? What's the long-term play? You're not playing the markets. You're investing for a goal that you're setting for yourselves. And you can't think of it in terms of what happens today. It's what happens over 1, 3, 5, 10 years.
So that's what you're saying, more long-term as opposed to short-term.
Exactly. Our clients are not necessarily looking to just play the markets. They're looking to really do something over time, and they're setting a goal, and we can help them think through that goal. And then how does a day like today maybe adjust, but it doesn't change your strategy.
So you said these life decisions. So what's kind of affecting them to go toward that long term? Are there other factors affecting that too? I know people are talking about it on social media too all the time too.
Yeah. Well, I think what the hardest part is there's a lot of goals. There's a lot of competing priorities, and I think our clients, especially clients that have lower levels of investable assets. This challenge of how do I think about, I really need to save for my child's college education, but I also have to save for retirement. I've got to think about health care. And I think for us, where we work with our clients the most, and we have a tool called Life Plan, which allows clients to really think about it. Sometimes clients just don't spend the time, right? And it kind of gets overwhelming.
We're busy.
We're busy. And, people's financial lives is always a thing to say, well, I don't really love talking about that, or I don't feel I know as much. So I think the obligation we've always felt we had was education. And it's really educating clients on A, what are the different options, and then B, how to think about return and risk over time, and how to think about different priorities.
Now let's get to that milestone that you quickly mentioned. So this is your consumer investments surpassing $500 billion in assets. What was driving that?
Yeah, so to give context, when we launched our consumer investments business, known as Merrill Edge as a brand, in 2010, we had combined some legacy from Bank of America and legacies from Merrill Lynch models, and had about $60 billion in assets and about 700,000 accounts. So between 2010 and here in 2025, we now have grown that to $530 billion and about 4 million accounts. And the North Star had always been about thinking about a Bank of America consumer client. They need banking, lending, and they need investing. And providing a platform, both self-directed for those who would like to do it themselves, and for us it was always world-class research that we were providing. And we have a guided model, which can be known as a robo, but in our case, our chief investment office is who sets the portfolios, and we have access to advisors in our centers. So it's really been about that combination of bank and brokerage and having the ability to invest on a platform that, you know, we've over the years invested in. And it's won a lot of awards, and it's a great way for clients to access the markets. And that's been what's fueled that massive growth over the last 10 years.
Now, you mentioned the clients who are using. Who exactly is using it? I mean, is it Gen Z? Is it boomers?
Yeah, actually, for us, it's really the whole gamut. We started off, again, because a lot of it is Bank of America customers. And so I'd say about 70% are sort of in the Gen X boomer. But over the last 3, 4, 5 years, we've seen a much bigger rise in Gen Z and millennials. So about 15 to 20% now is the younger generations. And so it's really the whole gamut, which is important. But what you're seeing more and more, and maybe fueled by social media, is younger investors who are saying, okay, you know, I kind of started off looking at the markets as a quick, almost gambling play. Now I want to think about it a little bit differently as I'm maybe getting a little older, getting my first job. And so we get a lot of those clients who've just gotten their first job and they're saying, I really want to start investing for the longer term.
Now, what about what sets it apart from the competition? Because there's other, you know, similar things. Is it the tech behind it?
Yeah, you know, the tech was one we're proud. We built it internally. We have an amazing technology organization run by a gentleman named DeepSeek and his team. But it's 3 things I would sort of point out. One, it is this ecosystem and this bank brokers integration. So it's all in one place, obviously bankofamerica.com. It's all digitally driven, but it's also combined so clients can look at all of their accounts in one place. That's certainly helpful. It's got a great client experience, so clients can actually talk to somebody. Access to advisors, as I said, which is rare for these more online brokerage spots. And then the reality of 3,700 financial centers around the country where someone can walk in, and even though they're investing in a kind of a digital platform, there's access to an advisor. And I think the other key part to our success has been when there's clients that have bigger need, more complex needs, greater wealth, our ability to partner with Merrill Lynch financial advisors or the private bank and their advisors, so make sure clients are getting what they truly need and not fitting them into a type of a model or an offering that isn't best for them. So we've really worked hard to make sure that across the continuum, clients are working with the type of relationship they need.
And we've heard so many stories. I mean, you're talking about digital. You're talking about, you know, brick and mortar stores. Where do you see most people going now? I mean, you've heard stories about, oh, we're closing branches, or maybe this is going to happen. Is there a reason for all that? Kind of explain.
Yeah, absolutely. Well, look, I will just say, bar none, branches at financial centers are still critically important. Right now, the question is, what are those branches used for? So the model from 10 years ago in which people were doing transactions, walking into a financial center, standing in line to deposit a check or to pay a bill or to do any of those things, that's cut in half. So from 2019 to now, half as many of that traffic is in the centers. But what's been replaced, and what we were one of the leaders to do, and we started introducing what we call financial centers back in 2013 and 14, is clients coming in to sit down with a financial advisor or sit down with a lending officer, talk about a mortgage or a small business banker. And so it's really, if you look at how we've redesigned our centers, the sort of teller line is in the back, and it's used less and less. And the entire front is sort of very nice office space. And clients are using the center as a place for guidance and advice. And that's really the transformation of how it's being used. So We still have over 600,000 clients a day coming to centers across the country, but the reason why they're coming has changed. A lot more of them make an appointment. A lot more of them are coming in and saying, I already took care of my deposit through an ATM, or I did it on my phone, but now I want to talk about what I was saying before. Well, what is my way to think about the future, and how can you guys help me? So the whole nature of the centers have changed, but it's become more relevant than ever. An interesting stat, because I think everyone always assumes young people don't want them. Right. What students say to us, and we have a huge part of our practice is opening up accounts for students, is they say, I may never actually walk into a financial center, but I want to know there's one there. Right? So just the presence and the brand and knowing we're there is very important to both young and old.
So is it more of like a reshuffling, say, like putting the centers in the center of the community? Yeah.
Well, yes. Well, it's always about location being really important, but it's the design of the centers is very different. So if you walk into one of our centers now, you'll walk in and it will look like, sort of Class A office space. And you'll say, where's the branch? Right? And so I think, and then there's obviously a lot more technology. We have someone who greets you at the door with an iPad and can do a lot of the things you might want right then and there, and then introduce you to someone to have a more sort of complex conversation. So it really is just changing the nature from all the transactional elements of a branch is absolutely moving to digital or ATMs. And the financial center themselves is a place clients can come and really talk about some of their financial priorities.
Okay, so let's stick with technology. How else is it changing the way, clients do business? I know there's AI as well. Yeah.
Well, look, for us, Erica, which is probably one of the earliest and actually useful forms of AI, early AI, we've had now 2.5 billion, with a B, 2.5 billion uses of Erica since we launched it. And I think it was 670 million just last year alone. So what does that mean? So someone who used to make a phone call and ask what's my balance is, or used to have to go find it, they can just say, Erica, what's my balance? And it pops up. Or Erica, move money, or Erica, do this. So this idea that now all that convenience and all those transactions and people sort of being able to, however many times they want, find out about their accounts, that's clearly very important. And that keeps growing, and Erica keeps learning, and there'll be new generations of AI to then allow her and that program to give more and more sort of advice and help people. But other than that, I think we're looking at lots of use cases across the company for efficiency, right? So our call centers, our technology organizations, every one of them is using AI now to test it and see how would it apply. And I think over the next couple of years, you'll see more and more actual uses of it.
Can Erica empty the dishwasher for me? Because I can't get my kids to do it.
No,
can't do that, okay.
We put that on our to-do list.
Thank you. The way people make payments, transfer money, that's changing too. Zelle is a big part. How is that, I guess, are more people using it now?
Well, yeah. Zelle there's 3 times more payments made through Zelle than checks. Right? And so Zelle has become the main way in which people, because again, it's all the different banks have come together, and so it has massive usage, and the way in which people transfer money between them make it so much simpler. The key has been the constant need for us to improve safety, improve soundness of it, really help people avoid, fraud and avoid scams. And so we've put a lot of energy across the platform to make sure we do all the right things to help clients. But it's been an incredibly powerful tool and really changed the way in which people transact with each other.
You mentioned fraud, so dig a little bit deeper. What is Bank of America doing to help deal with that?
So a whole host of things. Anytime we have the ability for you to set up alerts, and we have a massive infrastructure of team that is constantly looking at what's the behavior, and is there anything that just happened that deviates from the behavior that they can trigger it, send an alert so that the person says, oh, this is me or it isn't me. So that's one thing. We have what we call a security center on our application, which allows you to go through a whole series of steps to protect yourself, and it kind of gives you a step-by-step saying, here's the 10 things that you should do. Here's what you can do on the site, double authentication. Here's different, and then a whole series of tips. And we're constantly sending out, to our clients, hey, be aware of this, be conscious of this, make sure you don't do that. So it's a broad effort that we can do, and it's an effort that is in our financial centers, right? So we have triggers in which someone comes in and we'll say, are you sure about this? And make sure we try to educate them right then and there, our call centers and digitally. So it's something that we have to tackle every day.
Okay, and I want to end with a two-parter. So where do you see the banking industry headed? The first part is, what are your concerns, and then the second part would be, what you're most excited about. So let's start with your concerns first.
Yeah, the concern I touched on a little bit before. I mean, the idea that, kids in their teens and even younger are getting introduced now so rapidly to investing through social media, which can be not investing on fundamentally understanding how companies work, not understanding fundamentally about diversification and long-term investing. And so, for us, the education part of it is just really important. We've had for years a program called Better Money Habits. We've had a whole series of other programs to try to make sure that as, especially younger people are entering in and are interested in the markets and it's getting fueled by that they understand, A, the risks, and B, the difference between just, making a bet on something like you bet on a sports event versus actually understanding how to invest for the long term. So that's something that, we're very focused on being part of that solution.
And what are you excited about? What keeps you up at night?
Well, look, I think that the industry continues to be a great pillar of success and foundation. The strength of the banks right now in terms of capital and just liquidity and the strength, our ability. At the end of the day, we spend our day helping someone start a small business. We help people buy a home. We help people save for college. And I think that's what's important. For me, I have 40,000 associates around the country, and when I get to visit them, how they feel about the fact that they've just helped someone to do those things, that's really what's important. At the end of the day, it's about helping people with their financial lives. And then the work that we do in the community, times like this, I couldn't be more proud of what the team did out in LA and in other parts of the country. And so that's what I get excited about and what I appreciate my organization does.
Well, we appreciate you being here with us today.
Thank you for having me.
Thank you very much.
Appreciate it.
All right.
Thank you. Thanks, everyone.
All right, so next up we have three leaders in very different roles in very different companies, and that's why I'm so excited to have them all here in one place, kind of running through what we've been seeing in this current moment. We have Marco Argenti from Goldman Sachs, Jackie Canny from ServiceNow, and John Rose from Dell. And so, as we were talking about, 2025 is when AI tech's really in deployment. I mean, it's real at this point. It's not a hypothetical. And so I think I always love to start with just, give us one kind of cool, tangible example of how you're using it today. And I'd love to start with you, Marco.
So first of all, thank you for having me here. So you want an example of how we're using generative AI in particular? Or,
yeah, within the company,
or any form. I think one thing that I want to start with is it's been really a game changer in the developer experience, not only efficiency. I think there is more profound implications of generative AI than just thinking, hey, you know what, my developers are going to be 10%, 20% more efficient. It actually redefines what it means to be an engineer. It just requires a whole set of new skills. It's almost like comparatively to go from, people that used to flip bits on machine code to programming in a high-level language like Python, okay? And now it's about planning, it's about how you prompt. It's almost like having a coworker. And in fact, if I look at I've been running engineering teams now for too many years, and I tell you that this is probably the most profound transformation that I've seen, because it actually is not a matter of gaining efficiency. It's actually a matter of multiplying the resources that you have at your disposal. So I generally, and I make this kind of analogy. If you asked me like 10 years ago, how many servers do I have? I would have given you an exact number. If you ask me today, I can tell you I don't know. Maybe 10 minutes ago I had a lot, and right now I have Very little, because the cloud kind of goes up and down. I think in like 10 years, CIOs will tell you the same answer when you ask them how many developers do you have. I'm going to say, I don't know. Yesterday I had 100,000 developers because, but maybe 90% of them were virtual, were agents. And I think that's really the step where you see that AI is no longer suggesting code, but is actually doing things for you. And having lived through this transformation, we've employed generative AI now to, like the vast majority of our 12,000 developers. We're starting to see really a transformation on how people approach what it means to build software.
Nice, thank you. And Jackie, ServiceNow has one of the most kind of forward-thinking visions for how customers will deploy generative AI with Now Assist. But I'm curious, leading the company's people operations and teaching them how to use this stuff, really, I mean, what does it look like for you?
Oh, well, that was a great setup in what you said for what I talk about in the people role.
Yeah.
We have, I think never before in my career have seen so much opportunity for human capital transformation. Like we talk a lot about the tech, but really what it can do for people, and then ultimately your business has never been tackled before at the scale that we have. So I think about four things. There's the talent that we have. So how are we nurturing, hiring, bringing through the people that we need? We have 27,000. When I started 4 years ago, we were 16,000. So it's this pace that you have to keep up with. There's obviously the technology. So what are we doing to teach people the technology that they may not have come into the company with? There's the accountability that we believe people need to have. Like you need to be accountable if you work at ServiceNow to know that you have responsibility to understand AI to whatever degree in your job. You need to do that. So my team equally as much as our engineering, our product team, and our go-to-market team. And I look at this as a whole company action. We're doing AI 101. We're doing AI further when you have to have more skills. We're taking assessments. We're building an institute. We're taking external forces. I use advisors to help me because I certainly haven't grown up as an AI-first organization. And how do we systemically change the company? Because we have to transform too. We're only 20 years old. And I see that need, and it starts with our people.
Nice. And John, Dell has been going through a really interesting transformation, supplying a lot of the infrastructure that's powering the AI today. But, looking within your company, I mean, what are the initiatives that you found to really kind of fuel ROI?
Yeah, I have two roles. I'm the CTO of the entire company, which is about the long-term strategy and navigating the industry, and then I'm also the Chief AI Officer, which means I'm my own customer. I have to make sure we are customer zero. It's very interesting. The first year of generative AI, it was all experimentation because we didn't have tools we could even use. Last year, beginning of the year, we had RAG, Retrieval Augmented Generation, which allowed us to have like enterprise data within the AI ecosystem, but it was still kind of hard. This year, the ISV ecosystem has matured. We are seeing more off-the-shelf capability, more things that are consumable by enterprises. And so inside of Dell, that's translated into last year was the year that things went into production. And we took a very orderly approach. When we started the journey, there were 800 projects. It was chaos. Where we ended up was there are four areas we care about that are our priority: sales, services, engineering, and support, or engineering and sales. Sales, services, engineering, and support. There we go. Okay. Anyway, those four were the priority, and the reason for them was that they are the source of impactful ROI to the company. Those are places where we can make more money, we can control costs in a meaningful way, we can improve our profit margins, we can reduce risk in a material way. And the result is, literally 2 weeks ago, we declared victory on those four areas. We had major projects across all four of them. They are now all in production. The net is, today I have 40,000 services professionals that are augmented by a tool called Next Best Action that basically takes the collective wisdom of Dell and our real-time telemetry and injects it into every services transaction we have. 70% reduction of human intervention, dispatch rates are down, errors in shipments are down, customer sat is up. Every curve that mattered got bent by that one particular activity and services. In the engineering side, we adopted coding assistants and other tools. And I love the example. We actually claim today there's no such thing as an entry-level engineer in Dell. You come in, and in this environment, you are almost immediately productive, which is a huge transformation in how engineering works. Number three on the list, though, is around the supply chain. We have one of the largest global supply chains in the world, and it's driven by data. And it used to be very hard to use those tools, and today they are automated inside of our model farms. They are using generative interfaces to interact with them, and now using things like agents to actually make them work with each other. And then the last one, which was interesting, the longest poll was our sales force. How do we make our salespeople better? What does it mean? Do we create virtual salespeople? That's not really the right answer. Or do we make them more productive? And we discovered there was a particular metric that 40% of our sellers' time was spent preparing for sales meetings, sorting through content, getting organized. And if that wasn't a generative AI use case, I have never found one. And so, interesting enough, 2 weeks ago, we turned on 20,000 users across our sales force using something called Dell Sales Chat, which likely is going to hand our global sales force back a material amount of time to spend more time with customers. You know, I was very happy that, you know, sometimes you set a goal, we set a goal, these are the 4 areas we want to move forward on. 2 weeks ago, we can kind of declare victory, and the material impact on the company has been significant. You can look at our performance. You know, we had our earnings call last week, and you can see our revenue's up, and our costs are down, which is a very interesting thing. And it's not all technology, but people, processes, and technologies are becoming a really significant lever to improve productivity of enterprises like ours.
Super interesting. One gripe I hear, whether it's from the vendors, the CIOs, is, man, I built this really cool tool. People aren't clicking as much as I want them to. How do I get people to really feel like they want to use this tool and it's useful? You know, Marco, you say about, you know, your 12,000 devs have access to the AI assistant, but is it, you know, do you not have folks that are like, oh, I don't need this, I'm a good coder?
Yeah, so adoption is actually the key. And it's like every new technology, and I've seen that before with cloud, I've seen that before with mobile, I've seen that before with serverless, was an example that I was directly involved with when I was at Amazon. You immediately have a curve, a distribution curve of you know, you have the believers and the early adopters, and then you have the skeptics and people that just don't want to change their habits. And in fact, given what I was saying before, that generative AI for most of us is really about changing our behaviors and our habits, even some of the most kind of, you know, exercised muscle groups that we have, in a way that is completely different in many cases. And so one of the things that we've done is, first of all, to set up a very kind of, you know, thoughtful set of measures to understand actually what do we want to actually look at, what do we want to measure in order to understand what success looks like. So is it, for developers, is it the number of commits? Is it the velocity with which they burn down, you know, the backlog? Is it, how do you measure the quality of the code? Is it what percentage of the code has been accepted, and so on and so forth? For our junior bankers, for example, is looking at you know, how much time does it take to prepare a briefing, for example, to prepare a pitch deck, and what percentage of the actions have been substituted by automated actions. It's almost like we did what's called a time and motion study. You're looking at actual actions using, you know, tools that are looking at you know, what people are performing on the screens and all that. And so with that, then you kind of form an opinion of what success looks like. And in our case, for developers, was, for example, to achieve you know, around you know, 15 to 20% of efficiency, depending on the field. And then at that point, it's about activation. And activation is using kind of familiar techniques that work with the community. One of them is, first of all, setting clear targets so people know what is expected from them. And B, also using a little bit of peer pressure. So what we do is, like, you know, we actually have people, you know, like engaged in showcasing what they do in front of large groups. We do competitions. We've done even like a format that we called almost like Shark Tank, where people were presenting to a panel what were the most innovative ideas. And I tell you, especially with developers, like, the peer pressure works, especially if you have people that are considered and respected as, you know, some of the top developers. You definitely don't want to be less than them. And so I think that is kind of starting to create a snowball effect. And so it's a combination of that. But I think at the basis is doing your homework with regards to what you're measuring and what success looks like and what are the targets that you're setting.
Interesting. And Jackie, you recently added a pretty interesting second title, Chief AI Enablement Officer, which is so important right now. How are you approaching the new role?
Well, it says a lot about Bill McDermott, our CEO, and the board for seeing this as an imperative to put in one of his direct reports as title, and then to put it with the Chief People Officer. I thought was pretty innovative. But really at the heart of what change comes from. We can go back in our career, any technology that came, whether you were going from on-prem to the cloud or the cloud to now AI, there was always a change. And if you didn't bring the people along, it would let you down. And just like you were saying, like, how do you get adoption? You have to think about what's the experience we're driving for our people, our customers, our partners, and our community. We need 3 million learners in the next 2 years to be able to deliver on the revenue plans that we talk about. So this is nothing but the heart of our business to drive. And we use our own technology to do a lot of this work. So I believe in a product mindset that you think about what are we shipping to those people, our employees, our customers, our partners, our community, so that it is consumable, that they can learn our technology, that they can experience work if they're working at ServiceNow in a way that they get their jobs done faster. They're rapidly enabled, they're engaged, and the proof for me is that our attrition rates are like sub 4% for high performance, and we had 1.6 million applicants last year for 5 million jobs. So we're resonating in the market, we're resonating with our people, they're staying, and they're super engaged, and I don't take that for granted. It's this continuous, insatiable curiosity that we have to deliver learning, enablement, experiences in a way that they can, go get an Uber. And that's not easy to do, but it's absolutely at the heart of what we need to do.
Is it all carrot, no stick? So it's like, it's always just, hey, look how cool this tool is. It's never, hey, if you're putting together a pitch deck, you gotta use some element.
There's definitely some sticks, I have to say, and including in my own team. I hold the bar for the HR team just as much as we do for the rest. And there's often a quicker way. Like, it doesn't matter what generation you're from. Everybody has the same levels of ability to be curious. And the ones that show design thinking, that get the products right, that deliver on their ROI, their P&Ls, they are the winners, and we are high performance. Like, there's no shying away from that. But it is a culture that I'm trying very hard to create, that you can experiment and try. We have use cases that fail, that succeed, but keep showing progress.
Nice. And John, you mentioned, 4 kind of pillars. I'm curious, of these, which job has changed the most?
Well, I think they're all changing. I mean, fundamentally, one of the things that we realized when we started to figure out where to apply AI at Dell, I mentioned the first pillar is we're going after ROI. Make no mistake about it. We want financial impact to the overall performance of the business and the global market. But right behind that, the second thing was we didn't want to apply AI to processes that weren't the processes we wanted going forward. In fact, one of the mistakes people make today with generative AI is they use these tools to hide a bad process, to augment something that is wrong. Like, if you have an army of people just literally transferring data between one system and another because you haven't figured out APIs, putting a generative AI system on top of that is just masking a fundamental problem. So we had another dimension, which was something called Modern Dell, which is we asked and answered this question of, are these the processes that we want in the future? And fundamentally, I will not implement an AI project if it hasn't gone through that process, if it isn't aligned to a process that I really care about. And it turns out when we do that, the value is when you actually lean out a process and ask the question of how it should work in the AI era, you end up with a way easier process to apply AI to, as opposed to kind of hiding and fixing the sins of 20 years of legacy. And so and because of that, all 4 of those areas which meet that criteria have changed profoundly. The way we do software development is just changing everywhere. The way we do services, we're seeing a huge shift of human interaction to machine-driven interaction with customer preference. The customers like it. Turns out in services, the number one thing that matters is, do you get the right answer fast? They don't care if it's a chatbot or if it's a person. They just want the right answer. And if I can make them equally good at it, they bias towards the one that's easiest to consume. And that has a huge impact on supply chain. It's just fundamentally that we just do that as a matter of course. We have such a big supply chain that constant technology investment and, the results speak for themselves. We have a very good supply chain, and then in the selling side, we'll see. And it's a great observation around the learning process. We think the uptake in sales will actually be faster than the others, and it's because we've had an extra year to train our people. We ran something called Dell AI Fundamentals, and it was an optional course. It was 4 modules, took actually a reasonable amount of time. We put it out to the whole company, said, you don't have to do this, we'd like you to. 100,000 people did it. And it took reasonable time. We wanted people to understand what RAG was and what an LLM was and why these things work. And the result is we're going to watch really closely the sales uptake. And my guess is it'll be significantly faster than engineering, which was more put it out there and see what happens, versus an environment where people are well trained, they're comfortable with it, they understand it. There will be a few sticks, but mostly it's carrot and training. And I'm a big vocal advocate that if you don't have a skilling strategy in conjunction with your technical strategy, you're kind of hoping it's going to work. But if you have a strong skilling strategy and you're educating your workforce and they understand the process transformations, they understand the technology to a usable level, the adoption cycle just generally correlates to be faster.
Nice. Marco, you're leading developers in a pretty highly regulated industry. Most people in here also own regulated industries. How does that impact the way you approach it?
I think you need to use regulation to your, and also internal regulation to your advantage, because at the end of the day, there is more that we don't know about AI than what we know, and I think that's true for everybody. It's something that, it's a new super powerful technology that is like 2 years old at best. And if you think about agentic technologies, maybe 6 months old, and the research or deep research type of technologies, maybe 3 weeks old. And so one thing that we've been doing is really like trying to apply responsible AI in multiple ways, not just as a policy, but also as a characteristics or a feature of the platforms that we built around those models. A little bit like software development, right? Where you build, in the modern days, you build a pipeline or a CI/CD or SDLC, or you want to call it, to go from your desktop to production that embeds a number of controls. And if those controls fail, you don't push to production. It's the same thing around AIs. So imagine that GS AI platform that does what a power plant does around nuclear reactors. So you have the control rods in a way. And more specifically, you secure models from any type of data exfiltration, especially if you're using them inside the cloud provider, maybe in a multi-tenanted way. You're able to route between them so that you kind of get the best of all. And then you start developing controls around which data you can access. For example, what are the entitlements? In every bank we have the wall between private and public. And when you're using a model, especially if you're using the same model for both, you need to make sure that someone asking a question on the public side doesn't get an answer that is informed by the private side. And of course, entitlement is such an important thing there. That we have the right connections to the data sources, where the AI just doesn't make those data sources in a way taking them at face value and better, but you have mechanisms for grounding. Grounding means you're checking some other source. You're checking the web, you're checking internal databases, so you apply a filter before you just spit out an answer. You have controls inside the inputs and outputs. For example, prompt injection is a thing, is a new threat vector, and you need to protect against that. So we set up, from a governance standpoint, a sort of a two-body system where we have one group that essentially asks the question, should we do this? And it's more like a business group that says, okay, this initiative could have a high ROI, so it's worth investing. But then we establish a control group that asks the question, how do we do it? And then make sure that every group goes through a set of questions that need to be answered, such as, what kind of data are you using? Is it any APIs? Is there any, what users are you using? What roles can we use this? And also, what kind of biases do you see? How do you protect yourself from inaccuracies? Is there a maker-checker control? And so on and so forth. So robust apparatus, because I tell you that the natural tendency for people when they get super excited about a new technology, but in this particular case, something that sounds so good and credible, is just to basically kind of, suspend any disbelief.
And how often does that control group say, well, oh, come on, we can't do this?
We had, hundreds of use cases, and we ended up, approving a few dozens. And so there is maybe I would say that, maybe over half of that, they go back to the drawing board. And it is essential at this point to do that. And by the way, no matter if you're regulated or not, you need to self-regulate around AI. That is my single, piece of advice that I want to just offer to you. Because, those AIs make things really credible, really plausible. Sometimes mistakes are very hidden in things that are absolutely, look really, really good. And I like to say, poison, like garbage in, poison out. It's not even garbage in, garbage out. Because that garbage doesn't even smell like garbage anymore. And so you eat it, and then you feel sick. You need to be careful that you don't get food poisoning from your AI.
Watch out for that food, Jackie, agentic is the big word of the last 6 months. Obviously, ServiceNow is one of the kind of leading companies pushing that forward. And, the promise of agentic is that, there's some workflows that AI can kind of do itself. You don't need a human watching it the entire time. Within the company, what are you comfortable saying, all right, agents can handle this. We don't need someone just poring over it at all moments?
Yeah, so similar to what Marco talked about, we have governance and ways of sifting through these use cases as well. And we have had a good number of customers, almost 1,000 in just the last few months, that have signed up for agentic AI products. So we have adoption happening outside. And I think a lot of our customers are looking to us to how to think about that. And we're really pushing the envelope. There's opportunity where we've used AI and generative AI in the example of an HR business partner to assist them to what's the next best action, maybe about a person or what they should be doing. But now there's an opportunity where that can close the loop on the decision and say, not only is this person in your team ready to be promoted, they've demonstrated that they have skills, now they're going to get a raise, this is their new title, and it's closed. So creating a system where agentic AI can make that great is where I see the future for a lot of our work, particularly in HR, and I don't think it's that far away.
Nice. Now, John, I think a lot of people, when they think about, hey, we're scaling up AI, they assume that their public cloud bill goes up, that they're going to throw a bunch of money at AWS, Oracle, or whatever. But, Dell sells the AI infrastructure in many cases, and you're your own customer. And so I'm curious, how do you optimize cost when you're running a lot of this stuff on-premise?
Well, first of all, running it on-premise is almost always lower cost because you have control over your infrastructure. Now, the cloud era was great for certain things. If you have a workload that might be gigantic one day and zero the next day, having a flexible consumption model is a great idea. Our experience has been when you AI enable your service motion and you start deploying not just chatbots, but agents, which are orders of magnitude more resource intensive, these things run at high utilization levels for a long time. They don't stop working periodically unless you have no support problems, which is very unlikely. And so when you start talking about high utilization, the need to access your proprietary data directly, doing that all within an environment that you can control that's dedicated to you, just fundamentally has always had foundational cost advantages. There's a term called repatriation. Repatriation is the act of you adopted a cloud model and then you looked at it carefully and realized some of the workloads in that cloud model just simply don't require all the services of the cloud. And if you move them into an environment that maybe is in co-location or somewhere that is under your control, you can completely change the cost curve and the performance curve of it. That's going to be the world of AI. It will be a multi-cloud world. There will be public clouds. There will be private environments. There will be edges. There will be devices now for the first time with AI PCs that are all part of that end-to-end infrastructure, and picking and choosing where you run things from a performance perspective matters, from a cost perspective matters, and then the biggest issue is it matters from a regulatory and risk perspective. This is really incredibly valuable activity that you're describing. In fact, I'll give Jensen some credit for a comment he made a couple of years ago. He talked about, what is an enterprise? And he said an enterprise is two things. It's proprietary data and unique skills. That's what makes an enterprise an enterprise. First generation of AI with chatbots, it unlocked the proprietary data. The purpose of a chatbot, a RAG-based system, is to take proprietary data and make it generative. Great, we did that. The purpose of agents is to take those unique skills and digitize them. And when you do that, you are talking about an incredibly strategic asset that you need to maintain control over. You need to make sure it is something that you can preserve and reclaim if you need to. And so as we think about the strategic nature of AI, it's not just the cost equation. It's the control aspects of it. It's the ability to basically make sure that this system that is going to become the engine of your enterprise is fundamentally under your control, is predictable on the cost structure, and is working on your behalf. Doesn't mean you won't use public clouds. It just means that you have to be very, very thoughtful and strategic about your infrastructure choices in the AI era. This is way different than deciding to run a database in a container on a public cloud.
Yeah. And Jackie, I want to come back to you. As a chief people officer, there is so much talk around how does AI change our labor force planning? How is it for you all? Is it we need more salespeople, less engineers, vice versa? How do you think about it?
Yeah, we invest quite a bit in early in career talent too, which is another question I often get. And I think philosophically, you have to decide as a company, what is your structure for resourcing? We will always have a place for early in career. It's not something we're looking to, sort of take out of the pyramid, but to your point, make them productive the day they get there. So how are you taking everybody who joins your company, whether they don't have experience working, but they have great intelligence and desire and want to grow, or is it somebody that you're pulling out of another company that's never worked in your company? The shortening of that time in a technology company, a retailer, anyone is gold. It's money for the bottom line and the top line. And I think that's how we have to think about a workforce plan. Now, you can't think about a workforce plan without AI, because I think that would be naive, because it is taking parts of jobs. So again, who are you hiring? How are you hiring them? What are they learning? How are they training? How are they ramping very quickly? And that's your measure of what I think the new workforce model will be.
Nice. And Marco, I hear some companies tell me, oh, well, we don't need entry-level engineers anymore. We'll need senior. And some say the opposite. I mean, how do you think about the way you'd hire differently in the age of co-pilots and that?
First of all, I'm very excited about kind of the new generation. I have a 20-year-old daughter, and I tell you that she's more of an AI expert than I can possibly be. Because a lot of the kids in school right now, they actually, the more forward-looking, they know how to use AI every day in a very effective way. They're fantastic prompt engineers. And so I think I'm actually very excited about sort of the new generation coming in. And I think the answer to your question is more like a question itself, which is how do you define junior and senior? And to me, that is more like you plus your AI. How senior is that combo? And you could be, maybe you worked for a year, but you're so good at AI, and your AI that you're using has been trained on so many years of people's work that you might be able to be more effective than someone that has been there for 5 years and maybe doesn't know AI that well. And so we need to start thinking about AI plus human combo when you're evaluating performance. And then that combo, at that point, gives you a new definition of seniority, in my opinion.
Awesome. Well, thank the three of you so much. Super interesting chat. Marco Argenti, Jackie Canny, and John Rose. Thank you so much.
Thank you so much.
Appreciate it. Thank you. Thank you. Session 145 with Gary Cohn, Vice Chair of IBM, back out in the main area.
Good.
Yeah.
And I want to give one more shout out to our title sponsor, Invesco QQQ. Couldn't happen without you. Thank you.
We're having a technical meeting with some of your technical folks and a few other companies to try to sort out agentic interworking, which is a huge problem. We don't know how to make
together
a ServiceNow agent talk to a Salesforce agent.
Thank you. I'm like, what?
And we all agree at the technical level.
Please take your seats. The program is about to begin.
This is a Bloomberg Money Minute. We'll see whether Wall Street can get back on track after stocks took a hit in Friday's trading. Losses.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Citigroup moves $4 trillion a day. $5 trillion. It's larger than the GDP of France.
Wall Street used to be a place. Now it's more of an idea.
I love all these new Wall Streets. Y'all Street, Wall Street South.
I think it's everything in South Florida from Coral Gables to Jupiter, and there's finance all along the way.
It's one of the very few places that has no pretense of intellectualism. None.
It's kind of like a rat race. Everyone is running around trying to meet each other. It's like speed dating for hedge funds.
The power of being underestimated, it's a massive advantage.
There's no shortage of drama on Wall Street.
Please welcome to the stage Sonali Basak, anchor and global finance correspondent for Bloomberg.
Welcome back. I hope you all enjoyed lunch and got to meet many of your peers. And I'm hoping you enjoyed the video. That was the first time we've shown it in public, actually. So we'll be looking forward to your feedback. We just announced our new show, Bullish. Today will be out in May. We have so much more in store for you this afternoon. And in case you haven't done so yet, would love you to scan this QR code. It'll bring you everything you need for the event. You can find the agenda here. When you download the event app, you can follow our sessions and take part in the digital networking. You can schedule meetings with the people in the room today. And of course, you can find the Wi-Fi information. You're going to need that. This is also an area where you can submit questions to our speakers on stage. We will do our best to get to them. They will pop up on a monitor for us up here. And so we will look to you to see what you're thinking. There's also more information on how to subscribe to Bloomberg.com and discounts that you could take advantage of, because we have one of the best global newsrooms and finance and coverage around. But hey, I'm biased. You could also just ask the other 2,700 journalists we have around the world, though. I think they'll tell you too. And lastly, if you're active on social, you can use hashtag Bloomberg Invest for coverage. You can also follow us on @Bloomberg Live on all the major platforms. And I would also like to take a moment here to acknowledge our 2025 Bloomberg Invest Advisory Board members, many of which have been gracing our stages throughout the day, but they've also shared their time, their insights, industry perspective, and they've helped shape many of the conversations that you're hearing across the 2 days. And those advisory board members include TCW CEO Katie Koch, Goldman Sachs' Mina Flynn, Ray McGuire of Lazard, Stephen Meyer, and Ann Walsh of Guggenheim Partners. I thank you all very much. And another great activation we have at Invest this year, Bloomberg Lab for Desktop. It's a new way to analyze data that's on the terminal, and it enables users to access Bloomberg data in a programmatic environment. And you can get a live demo of it in action and enter the draw to win an iPad. The Bloomberg Lab booth is in the gallery next to the registration. You can make your way down the hall at some point and check that out. Now, speaking of innovation, for more to what expect around artificial intelligence, very excited to bring my colleague Matthew Miller on the stage with Gary Cohn. He's the vice chairman of IBM.
All right, thanks very much. I'm very excited to welcome Gary Cohn here to the stage and to interview a fellow Ohioan.
Yeah. Go Buckeyes.
Go Buckeyes, for sure. National champions this year. I can't believe we did it after that loss heartbreaking loss to Michigan. So I'm really fascinated. I anchor this show every day with Sonali and with Katie, and obviously AI has been really at the center of what we talk about. And lately, I live up in Westchester. I've been meeting a lot more people who work in machine learning at IBM. I didn't really know it was such a focus, but of course I remember IBM winning on Jeopardy, and so it does make sense in hindsight. You're now vice chairman after you spent obviously a long time at Goldman Sachs, then a little bit of time in the White House, and now you've been investing in tech until you moved it into the vice chairman role at IBM. You've known about AI, I think, for longer than many of us have. How are you working on it at IBM?
Well, thank you for having me. Thanks for the kind words. As you pointed out, at IBM, we have been involved in AI, machine learning, you can go back and call it if you want, for over 50 years. The AI that was used to win at Jeopardy or beat Kasparov at chess was a little different than the AI we have right now. During that period of time, you had to pre-program a huge database with all of the answers because we didn't have the real-time connectivity to the data around the world. Today, if you were going to play Jeopardy, you would completely do it differently. You would just allow the AI machine to go get the answer instantaneously. 40 years ago, you had to sort of put the answers in a room and hope that Jeopardy asked the questions in the categories you wanted. It was easier to program all the chess moves. Today, AI has evolved dramatically, and I think we're all living through this, I would say, evolution. I'm not sure it's a revolution, evolution of AI. We've gone from the concept, and if you look at sort of CEO surveys or corporate surveys, a year or two ago, I think it was about 90% of CEOs said they, clearly were going to be involved and use AI. And of those 90%, less than 10% could actually tell you what they were going to use it for. They just felt like they needed to talk about using it. Today, I think the amount of CEOs that are using AI continues to grow, but more importantly, they actually know what they're going to use it for. And the definitional outcomes of where AI can enhance your business is becoming clearer. That's where they are today. I think it's going to continue to evolve to where you can use AI in your business and where the paybacks are and how you create real productivity growth. I won't geek out on productivity growth, but at the end of the day, if you want to grow GDP and you want to grow your economy, it is all about getting more productivity, getting more units of work out of your labor force.
So I think about this a lot in a competitive sense. If you're a big business and you haven't figured out how you're going to use AI yet, are you too late? Have you lost out?
You're never too late. You're never too late. What you may be late is you may be at a competitive disadvantage to your nearest competitor, because they may be able to do certain things more efficiently than you, but you can catch up quickly. So you're not that far behind. So you have to sort of figure out where the opportunities are in your business, and it depends on size, scope, scale of your business. So like a very obvious place where in a bigger company, and this is something we did at IBM and we've talked about it, we like being client zero for all of our products. We did something relatively simple. It sounds simple, but it was not that simple. An HR chatbot. You think of what most people use HR for after the day one hiring experience. 90% of what they want is, they go buy an apartment, they go rent an apartment, they need a reference letter. What day did I start working? How long have I worked here? What was my last year's compensation? What was my bonus? And you want that sent like that minute. In a year or two ago, you used to call someone in HR, you used to give them the information, you used to tell them where you want it sent, and you hope and pray they sent it out quickly. Today, you're at IBM, you will type it into a HR chatbot, and the minute you said hit send, the letter will go out. So people are actually very happy. Oh my God, I get what I want. I get all this information. You have information about your benefit, information about your healthcare. We do it all real time. We cut 600 people out of our HR department. Now, we didn't fire them. We redeployed them to places where they can be more useful. And our satisfaction scores for our employees using HR has gone up dramatically because they get real-time answers. So it depends what you're trying to achieve in your company. There's a lot of people using AI today in code assist, in writing new code. So if you're in a big code writing shop or writing new code is important to you, and you're at a disadvantage because your competitors are using a code assist program and you're not, you're at a competitive disadvantage. You take a lot of people here in the financial services industry. Most banks happen to know what banks do. Most banks historically built a technology infrastructure on a sort of as-needed basis. And if you go pull back the covers, they've got lots of different systems in a variety of different languages. And when you try and integrate them and have them talk to each other, it's very difficult. So every bank during the course of the last decade or 20 years tried to think, how do I get all of my software? How do I get all my systems on a common language? It was an arduous task that was cost prohibitive. Today, it's not cost prohibitive. Today, you can get a code assist bot to basically port one language over to another language, and it's pretty flawless in how it happens. So there's a lot of places evolving today where AI is very useful, and it depends on your particular circumstance.
I want to ask you about the cost, because I think the reason it was so daunting in my mind, especially for a information technology company, is I was looking at OpenAI and thinking, you've got to invest $100 billion to create a large language model, and only a few of these giant hyperscalers in Silicon Valley can do it. Now, obviously, DeepSeek, although there are questions about how exactly they did it, how much it costs, shows that you can do it for far less.
Well, thank you to the Chinese DeepSeek for proving out what a lot of us knew in this country, but no one wanted to listen to. So if you look at what we've been doing at IBM, you look at what Meta's been doing, you look at what a lot of companies here in the United States have been doing, we've been building small models. What we have found, and DeepSeek sort of proved this out, the small models are much more efficient, they compute faster, they take less power, but they're not a model that can do everything. They're sort of targeted models. So the things that I was talking to you about, we have small models that are used for specific targeted goals. I think that is the future. We think that is the future of AI. We think most companies will engage with as many small models as they need to get done what they need to get done where they're using AI, and it will be vastly more efficient, vastly more cost effective for them. And I think this is the future where we're going. Look, will there be some large language models out there that are effective? Yes, but they will sort of be the catch-all models for everything.
So it still costs a lot of money to invest. I think Moody's estimated it's going to be $2 billion in investment over the next 5 years, which doesn't seem that far off when I look at the CapEx plans of these Mag 7 companies. You and I both lived through the internet bubble and watched so many companies put money into laying down fiber cable and build the infrastructure, the data centers of Web 1.0, for a lot of CapEx when they weren't getting a lot of return on investment, at least not for years, if they ever did. Do you see real parallels here?
Yeah. Yes. Look, as you're building technological infrastructure and backbone, you're building it based on what's available today and what you know today. The whole AI backbone, infrastructure, compute, technology, it's moving very fast. But you can't wait for version 2.0 or version 3.0 or version 4.0. You have to build based on what's available today. What's available today will be obsolete, a lot of it before it gets built, and it will get replaced by newer and newer versions. So there is a bunch of money being spent today that will have very low returns to no returns. But if you don't start investing, you'll never start. So you sort of have this prisoner's dilemma that I have to start building this data center, and I think I'm going to be putting XYZ chip in, but by the way it gets built in 2 years, I most likely will not be putting that chip in. And the amount of power I think I need to run that data center may be dramatically less because the next chip, I bet, is going to be a lot more efficient than the chip we have today. So a lot of this build, you can't wait for the efficient frontier because someone's always going to be out there. You have to keep building, and there will be a lot of waste to get there. I just think it's inevitable. And then, these AI models themselves are going to build upon themselves, and they're going to get smarter and smarter, and they're going to optimize and re-optimize, and everything's going to get better and faster and quicker. And ultimately, the AI of the data center is going to tell you how to build a better data center, how to build better connectivity, how to optimize the optimization.
What do you do, though, as an investor? I mean, as an IBM or as a Microsoft, or as you point out, they don't have any choice. They've got to build now. But what do you do as a private investor? What do you do as someone who's looking at markets? How do you analyze that?
Well, it's interesting. If you look at the history, and the history of technology is not that old. And if you look at, sort of what's going on here, ultimately, the bigger companies are going to have a real big impact in this. Now, it's really, and then I'll point out that all the bigger companies that we talk about today, whether it be the Metas or the Googles, I remember when Facebook started and it was a really small company. And I'm not that old. I'm old enough, but I'm not that old. So all these big companies, I remind people, start out as really small companies. So there are a bunch of small companies today that are going to be really big companies unless in that path, one of these bigger companies can buy them out. We've now got companies that can go spend $100 billion and buy out a company, relatively easily today. So if you were looking at what you think is the most likely path, I think the most likely path is the big, I don't know if it's the Mag 7, but the bigger companies who are spending the most in CapEx are the most likely winners. And they will, many of them will fund some of these startups. And almost all of the big companies have huge venture arms because they're trying to spend money in these startups. They're trying to get opportunities to let creative people create. And then as those products become really valuable, they're just going to buy them and merge them into the bigger companies. So, I guess my investment advice is, look, you can own some of these small companies, and most of them are private, and they're probably interesting to own a portfolio of them. But if you ask me where I think this is going to be a decade from now, I think the bigger companies are going to dominate the space.
Is that part of what you're doing at IBM? I mean, do you help Arvind Krishna maybe zone in on some targets?
We definitely have a ventures portfolio. We're always looking for something that's on the cutting edge that fits within our parameters, whether it's hybrid cloud, open AI, quantum, but we're very much in the open source, so we're going to buy open source companies. If it fits within our parameters and we think it's got an interesting opportunity, it's in our shareholders' best interest for us to get involved in the company early, not late.
By the way, a little bit detached from the specific AI conversation, what do you think about the M&A landscape right now? When we came into this year, me and Sonali and Katie were joking about an opinion writer who said maybe there won't be that many deals because everybody said this is going to be the year, that the regulators drop their guard and everybody can get together. Now it's starting to look like that may not be the case.
Well, that was the total market euphoria from November election to January 20th, was deregulation, ease of doing business. The FTC, the CFTC, the SEC, everything C is going to get easier and be much more pro-business. And we're going to have, this huge influx, this huge massive explosion of deals, of M&A deals, of IPO deals. Look, we're 45 or 46 days into this. I don't want to judge this book by its cover, but the first 45 days, we've not had an explosion of deals. In fact, probably based on what's going on in markets right now, market multiples, we probably lost deals. So I would say the calendar from January 20 to today is smaller than it was. That's not a regulatory statement, that's a valuation statement. And you also have to be reminded that some of these commissioners are not in place, heads of SEC, even the FTC doesn't have a full Republican slate. It's got 2 Republicans, 2 Democrats, so it's hard to get things through on a 2-2. These things take more time. So I think some of that euphoria is still there, but I think more people are taking the approach of, okay, you're going to have to show me it's a different environment than just trust me. I think we've gone from trust me to show me.
I want to get back to regulation in a minute as it pertains to AI, but you mentioned productivity. You don't want to geek out on it. We haven't seen much of an impact yet from AI on productivity. I actually have chatbot now open next to my Bloomberg screens every morning.
Does it make you more productive?
I'm actually getting a lot more detail into my newscast than I would otherwise. I use it as more of a glorified search, but we haven't really seen it boost the numbers economically. And I wonder when you think we're going to see that, and if it's going to actually have an effect on jobs. You mentioned that you've moved HR people out because you can replace them in that role with AI. Yep. Are we going to see, an uptick in or a loss in non-farm payrolls because of it?
So we've also created, artificial workers. So we now can create artificial workers in our consulting business. We now have artificial workers who, will work 24-hour days, which is kind of nice.
Just like Doge.
Yeah. So I don't know if I'm going to make that. You made that comparison. I will not own that comparison. So let's talk about your question. I think your question is, if AI is going to be successful, are we going to see a real impact to labor and employment numbers around the world, let alone in the United States?
Yeah.
So my pretty bold answer is, and I always say this to rooms full of people like this, who usually first question I get is, isn't this devastating to the economy? I say, look, I'll give you the rest of the time I'm up here, which is very short at this point, so it's not a lot of time. I'll give you the rest of the time I'm up here to come up with a major technological advancement that destroyed jobs. And you can go back and you can take anyone you want. And so let's just take the internal combustion engine. That was supposed to destroy jobs because all those people that cleaned stalls and put shoes on horses, they were going to all lose their jobs. Well, but all of a sudden the next day when we started putting internal combustion engines on the streets, we needed mechanics, we needed gas stations, we needed different skill sets, different people. But all of a sudden, there were more jobs created because people could go, 50 miles a day or 100 miles a day versus 2 miles a day. So their landscape, their business model expanded. It's no different than when the internet, I worked at a bank before we had email. We used to have, every floor had a person that printed the memos and put it in your mailbox and told you what time the meeting was or told you what time to go. What happened to that person who delivered the mail on the floor and printed the memos? They sort of disappeared overnight. Now, we didn't have less people. In fact, every bank, I guarantee you, since the invention of email, is double its size. Why? Because we got more productive. We got email coverage, so we could cover more clients. We could cover more people around the world. We could communicate quicker. We could communicate faster. I think AI is the next leg in this evolution of making us more productive. So, look, will there be a change in skill sets? Yes. Will people do jobs that they hate? No. The machine can input data. The machine can take codes out of an operating room in a hospital and input them into the insurance reimbursement system. By the way, that job in a couple hospitals has 40, 50% turnover rates because people hate doing that. They shouldn't do it. Those people in that hospital can now do a job where they try and work on recoveries and the hospital gets paid back. So I think you will see this natural evolution of people out of jobs that they don't like, jobs with low dissatisfaction ratings, to jobs that have higher satisfaction ratings that are more productive and grows the economy. That's the history of every other technological advancement we've seen. It's not overnight. That's why I call this an evolution, not a revolution.
All right.
And all this, by the way, and we probably won't have time, but remember, AI, I believe, is just a stepping stone to the real outcome, which is quantum.
Which is, I'm guessing you also think 10 to 15 years off.
No.
Sooner?
Sooner.
And how soon?
5 years. The strides that is being made in quantum right now are large. I mean, there's a lot more. Look, again, there's a lot of private capital going into quantum. It's big companies and small companies. It's all about error correction, how quickly you can correct error, how quickly you can compute. The data is pretty interesting right now. So, as we evolve, everything in this technology space is speeding up. So, 5 years.
All right, fascinating. I wanted to ask about regulation because you mentioned AI is going to help us create better AI, and I wonder what else AI is going to decide to do for us. Or do we need to regulate it? Do we need to have a heavy hand here, or is it okay to have a few South African billionaires just say, go?
I don't know what you're talking about.
Yeah.
I'll go to ChatGPT and ask what that is. So look, the answer is yes. And I sit on a couple of these big regulatory boards around the world. So I'll do this relatively quickly. If it's a regulated activity today, if you use A, it should be a regulated activity using AI. So an example of that is if I'm going to call my doctor and tell my doctor that I got a scratchy throat, a headache, a swelling of this, and he or she puts it in a machine, and they're going to diagnose my disease and prescribe me medicine, That's a highly regulated business today. The AI machine that does that and the program that does should be highly regulated. On the flip side, if when I'm working out tomorrow morning, Spotify chooses a bad song for me and I have to hit skip, which they do a lot, I'm not sure that needs to be a regulated activity. I can get through my workout in the morning listening to one bad song or skipping a bad song. So my view is, look, we've decided what businesses are regulated. We know what business should not be regulated. We should not use AI as a wedge to regulate more businesses. On the flip side, we shouldn't use AI to take businesses today that deserve regulation and take them out of regulation.
All right, we have one audience question here on tariffs.
It's amazing how you got an audience question on your card.
Does this strategy make sense to you as a way to deter illegal immigration and fentanyl smuggling from Canada? No, seriously. We've seen for a couple days in a row, markets really come down. We've seen rates come down from 480 to 420. President Trump has put 25% tariffs on our two closest trading partners after he negotiated possibly the greatest trade deal in history with them, right?
Yeah, USMCA.
Does it make sense to you? I mean, you were there. Yeah.
So, look, I think what we have to understand, and I'm not saying I understand this, but I think what we have to try and figure out is what is the objective of the tariffs? And that, to me, I think that's where a lot of us are struggling. Is the tariffs meant to make foreign products more expensive so the domestic product is cheaper? Okay, that's a good use of a tariff. The problem is a lot of the things that we import, we actually don't make here in the United States. So you can make the foreign product more expensive. It doesn't make the domestic product cheaper because we don't have it. So that's a question I have. But if we put that tariff on, does that incentivize CapEx to build the capability to make that product? You could argue, okay, that's not a bad long-term outcome because, look, if we took nothing else away from COVID, we should have taken away from COVID, there are some strategic needs of this country that we are just too dependent on the rest of the world for, and we better figure out how to be more self-sufficient on necessity goods and items. So, when it's coming to buying personal protective equipment and we have to import it from China and we need sterile gloves and masks from China, probably something we should manufacture in the United States. If we're worried about, toys and games, we can live without them. I don't think it's a necessity item. So I think we have to figure out what the objective is. If the objective is to raise money for the government, make that the objective. I'm not sure how you do that. And how do you do that with weighing the effects of inflation on the other side? And I think you have to think about that. So if we're just using it as a revenue raiser, it creates a higher cost of goods. It's a really regressive way to raise revenue because I hate to say it, the reality of it is poor people or less highly paid people consume 100% of their paychecks. Wealthier people consume a very small percentage of their paychecks, and they have to consume their paychecks. So the things that are being tariffed are things that everyday people buy, and it becomes a really regressive tax system. I don't think we want a regressive tax system. I'm the first guy here that's going to argue for a progressive tax system. The rich people need to pay more in this country. They should pay more, and they do pay more today. I don't think we want to flip that around through tariffs. So to me, the question is, what is the objective here? There may be a real robust, bona fide reason to have tariffs. I just don't know what we're trying to achieve.
And you would know, I feel like. Anyway, this is a thoughtful answer, and I appreciate your time.
Thank you. Thank you.
Thanks so much.
Please welcome to the stage Ryan McCormick, Senior Factor and Core Equity Strategist at Invesco, for a conversation with Bloomberg's Eric Balchunas.
All right. Thank you.
Thanks, man.
Thank you very much. So,
wasn't so bad, right?
The Qs. Just want to start. How many people own the Qs? Oh, you could sell some people here, Ryan. Okay. We are going to basically highlight the Qs. Okay, so I just want to start, and explain the NASDAQ 100. I work on a team with ETF analysts. We nerd out on all kinds of issues. We are just so fascinated by this index and the ETF, obviously, that tracks it. It's a weird index. We kind of call it the eighth wonder of the world. It captures the U.S. stock market in a special way. Do you know that it's doubled the performance of the S&P 500 since it launched in '99? I mean, and the S&P is a really good index, right? So what's going on here? I want to really explore what is happening inside this index and why it's sort of become, doesn't get as much flows as SPY and the other ETFs, but it's close. And I just think it's an interesting ETF. Obviously, the performance has to make it pretty easy to market this ETF, right?
It does.
I mean, yeah.
I mean, it's the 5th largest in the world. It's the 2nd most actively traded. I mean, a pretty robust derivatives market around it, whether that be QQQ, some of our other NASDAQ 100 strategies, or just the index in and of itself, right? A lot of derivatives that are tied to it. So there's just a lot of notoriety, and the fact that it's been around for 26 years, like a lot of people have crossed its path. So,
ready for another fun fact? Actually, I'll turn this into a trivia question. You guys are financial nerds. Maybe somebody here, this is a tough one. This is like Jeopardy level 1000, okay? In the past 15 years, only one active fund has beaten the Qs out of thousands. I mean, we did a study. My colleague David Cohn did it. Only one person. Can anybody name the fund or the person? I'll take either. Yeah. Yes, Barron. This guy, Ron Barron. Okay, do you know how he beat it? Yeah, his fund's 50% Tesla, okay? Which is kind of, it's not legal to just put 50%, but he got it small and just let it run. And so the only thing you could do to have beaten the Qs was just buy a ton of Tesla. That's how hard it was to beat. What is the NASDAQ 100? I mean, it's not really beta. It's not totally tech. What's going on? Like, how would you describe it?
You're right, but I wouldn't go as far to say that it's like a factor ETF, right? I mean, it's beta-like. It's comprised of the 100 largest companies that are listed on the NASDAQ exchange, ex-financials. So what you wind up getting is this sort of like growth leaning, just when you're looking at the sector breakdown. You know, you're getting some tech names in there, you're getting some discretionary, some telecom, but you have these sort of like, of course, Mag 7, these kind of growth-oriented leaders of the past 10, 15, 20, 25 years that have all gravitated to this exchange and then by extension this index. So it's this sort of like growth leaning product that is beta-like is probably the best way that I can describe it, because there really isn't anything like it out there in the market.
Okay, can I give you my theory?
Yeah,
okay.
shoot.
This is just a theory. I think this index really started, it's similar to Nike and Michael Jordan. Steve Jobs decided to list there in 1980 when he was like 25 years old. I mean, NASDAQ was not that big. He went there instead of the New York Stock Exchange where IBM was listed, probably because he wanted to be different than IBM. And I just think people who are creators and founders and visionaries, they really love Steve Jobs, similar to the way basketball players would like Michael Jordan. And he kind of, you know, Michael Jordan went to Nike when it was the third sneaker after Adidas and Converse. And I find a parallel there. Steve Jobs chose it, and then when Steve Jobs Part 2 came in the 2000s, game over. Every single, it was like it became cool to go there if you're in this sort of tech visionary world. Is that, what do you think of my theory?
I think you're spot on, right? Yeah, Steve Jobs was probably the first. I mean, you can make the argument that Intel in the 70s, but I don't think Intel was as cool as Steve Jobs, right? Like he was kind of a tech rebel. And then I think as success started to come to companies like Microsoft and Apple and Intel, like you started to see the early 2000s, which you referenced, right? You started to see the Amazons in the late 90s. You started to see the then Googles, now Alphabets, the NVIDIAs long before it was NVIDIA, the Teslas. And it's almost like, you know, a snowball effect where if I'm an up and coming kind of like tech or technologically oriented CEO, right? And it's, hey, you could be listing where Apple and Alphabet and Amazon do, or you can go somewhere else and, you know, be sort of like a large cap value, almost like a stodgy feel. I think most of them would say, wow, like I could be in the same kind of realm of Apple and Amazon. I want to go that way. And, you know, I think we've seen that kind of perpetuate. I mean, the NASDAQ has won more listings than the New York Stock Exchange now for, you know, I think it's 40 plus quarters.
Wow.
So, they continue to sort of attract that sort of that sort of company. And I think it was all based on the fact that it was the first electronic exchange. And Steve Jobs said, all right, this is where I'm going.
Yeah, I'm trying to find the person who fielded that call. I've been digging hard. If anybody knows, let me know. I think it would make a great little mini documentary for my podcast. But anyway, I digress. So one interesting thing is research and development. When we think about these tech-oriented companies, a lot of what I think, we just talked about this recently with Steve Howe in our index group about research and development here versus other regions. It's so strong in the United States, and that is somewhat of our secret sauce. Yeah. Can you talk about the amount of R&D and patents that are embedded in the index?
Yeah, it's pervasive, and like from our perspective, right? Like this is one of our few funds at Invesco that isn't necessarily like factor driven or smart beta, right? So it is. I don't want to say purely passive, but it has a passive feel to it. So it's almost we need to like reverse engineer the story, where it's okay. Well, what has made this very small subset in terms of number of companies so successful? And so, the notion of innovation, the ability to change, and you look at kind of what companies have had the staying power over the past 25 years. And a common thread that we found was the fact that they spend more on R&D than their peers. In our last observation period, on a weighted average basis, I think it was 15.6 billion. S&P x NASDAQ 100, it was 1.5 billion. So an order of magnitude of 10x. And then, as a percentage of sales, over 11% of sales reinvested back in R&D. So like that's a very long-term and significant commitment that these companies are making. And then you kind of take it a step further. You peel the onion back one more layer, and we start analyzing patents across all these different disruptive technologies. And again, this like rather small subset, small in number, 100 companies, file a staggering percentage of patents globally for things like cloud, of course, cybersecurity, but things like speech recognition, image recognition, NLP. I mean, the last observation period, it was over 45% of every patent that related to NLP was filed by NASDAQ 100 constituents. So I think like the IP has become such an important part of not only the index, but under the hood, almost every individual company's growth strategy, that it's always front of mind for them, and that's become sort of a hallmark of them for the past, 1-2 decades. So it's something that is in their in the front of their minds. And I was just on a panel with some of these companies out at Consumer Electronics Show, and each one of them was 25% or more of revenue reinvested back in through R&D. All talking about human capital, attracting top talent. And again, it's one of those things where it sort of feeds itself. They are able to solve these kind of complex client problems, and in doing so, they develop and start to retain IP.
And one of the things people will say, well, it's all Mag 7. I mean, I think it's all close to half of the index now is Mag 7, maybe 42%, something like that. S&P also getting full of Mag 7, but this journalist Sam Rowe on X one time pointed something out that just changed my way to view this, which is that these Mag 7 companies are like 4 or 5 what could be other companies inside of them, right? They all own a lot. And I think if you look at them as the Mag 35 or the Mag 40, it makes you a little less paranoid about, we've got this concentration risk. Thoughts?
Yeah, I mean, I think these companies have spent a lot of time, money, and effort to diversify their business lines. I mean, you can make an argument that a lot of these companies could fit in multiple sector boxes. So without a doubt, I think like diversifying the revenue streams and basically the underlying components that make up the whole, I think that does help to address the concentration issue a little bit.
And we have only in 30 seconds, just give me one stock that isn't one of the more famous ones that has stuck out to you in the past couple months that is interesting.
Yeah, I mean, I think performance-wise, it would be a company like Netflix. I mean, Starbucks was interesting, with their turnaround and their new CEO. But I mean, something that people wouldn't expect would probably be something like IDEX Labs. So a mainly veterinary company. I mean, I don't think Most people hear QQQ and they think, oh, I'm going to look at healthcare, but names like IDEX or Intuitive Surgical, there's a couple of biotech names in there as well. I mean, there is some exposure to healthcare, and I think people learning that IDEX Labs is in the NASDAQ 100 would probably raise a couple of eyebrows.
That's a good one. I didn't know that. All right, well, we're up. Our time is up, and I want to thank Ryan here for a great conversation. Thank you.
Thanks so much, Eric. Appreciate it.
Start a process at some point to bring interest rates back to more normal levels.
Welcome to the stage, John C. Williams, President and CEO of the Federal Reserve Bank of New York, for a conversation with Bloomberg's Michael McKee.
Well, we'd like to thank John Williams for joining us today. He is, as you know, the President of the New York Federal Reserve, and your best bet for moving the markets today, if we can get him to say something that would do that, which I know you're going to work against me on that one, right? John, we got to start with I guess you'd call it the orange elephant in the room, the tariffs that the president put on today. For a long time, you've been saying to me, it's too early to know the effect of the tariffs. Well, now we've got some details on the tariffs. Your reaction?
Right. And I think the reason I was saying to you it's too early is because it really matters. It matters, which goods or where tariffs are applying, what countries, how long they apply for. So there's, when you look at the research that looks at the effects of tariffs on the U.S. economy, one of the things that's highlighted, it depends whether it's consumer goods, it depends on whether it's goods that lots of countries produce, and a lot of things like that. So, it really made sense to let's wait and see, find out more about what policies may be put in place, and then kind of, come to, I would say, conditional judgments about what does it mean for the U.S. economy. And as you said, we are seeing more actual actions on tariffs in different dimensions. I would still highlight there's a lot of uncertainty. We don't know how long the tariffs will apply. We don't know what other countries may do in response to this. We also don't know what else may happen in this, in the kind of realm of trade policy. My own view is that based on experience from previous episodes, based on analysis, is that tariffs on consumer goods especially, they do feed into import prices pretty strongly. That does filter in to prices that consumers pay. That happens relatively soon. Tariffs that feed into kind of intermediate inputs, the things that companies use to make other things and to make other things, those tend to pass through more gradually and have maybe last a little bit longer in terms of their effects. My view is that based on what we know today, given all the uncertainties around that, I do factor in some effects of tariffs now on inflation, on prices, because I think we will see some of those effects later this year. Not yet, but maybe later this year. I also, you have to factor in how does that affect economic activity, decisions by businesses to invest, consumers to spend. And that's where I think another big uncertainty is. We've seen some kind of movements in the data in the last couple of months. I think some of that's in anticipation of tariffs, so it's hard to really read the tea leaves there. But that's something else I'll be watching carefully, is to what extent is that affecting consumer confidence, business confidence, the uncertainty around this and the effects of the tariffs economic growth and employment and things like that. So still a lot of uncertainty, I think directionally, somewhat higher prices in the outlook, at least in my kind of thinking about what's happening, but also a lot of uncertainty about how the economy responds to this.
The 2018 playbook for the tariffs in Trump 1.0, basically outlined by the staff in the Teal book that year, suggested that you basically had two options. You could raise interest rates to fight inflation, risk recession, or you could look through, ignore the tariffs, assuming that they would be a one-time rise in the price level, but not an ongoing cause of inflation. What do you think this year? Which of those two playbooks should you follow?
Well, you're going to get a little frustrated because I'm going to answer the same way I answered the last question, Mike, and that is it depends on how these, what goods, the tariffs apply to, which countries, how long they're in place for, how big they are. So it'll depend on a lot of factors about how big the effects are and maybe how long these effects will last. I do go back to the broader context of monetary policy. It's not just about tariffs or trade policy. There's a lot of factors that influence the U.S. economic outlook and the global economic outlook. You have to take all of those into consideration, look at the totality of the data, look at the risks and uncertainties and what that means for achieving our maximum employment and price stability goals. So from my perspective, if you go back to the 2018 kind of briefing we got, clearly you want to think about how long-lasting these are, how big the effects are. But I would just reinforce this point. There's a lot of uncertainty about that, and we need to be guided not only by our economic analysis, by our absolutely fantastic staff who does all this work, but also what are we seeing in the data? What are we hearing from business leaders? What are we seeing in out there in the economy? And then from that information, kind of get a feel for which direction the economy is going, both in terms of inflation and employment. I mean, the good news here is the U.S. economy is starting in a very good place. Unemployment is 4%. The labor market is stabilized after cooling from red-hot conditions a couple years ago. Inflation is 2.5%, and it's been gradually coming down towards our 2% goal. So we're starting with the economy in a good place, and I would argue we're starting with the monetary policy in a good place, ready in a good position to adjust as needed, depending on how the data and the outlook and the risks of the outlook evolve.
Well, given the uncertainty you talk about and the time span before we might see things show up, is it fair to say that it's too early to consider changing interest rates at the March meeting?
Well, in my view, I think we need, I think monetary policy is in a very good place. It is, modestly restrictive. It is helping keep the economy, I think, in good balance. I expect the economy to continue to grow this year, roughly in line with, the economy's potential. I expect inflation would over time move down back to our 2% goal. So I think monetary policy has got the right, kind of balance right now. It makes sense to collect, some more information, not only about what's happening with trade policy, but obviously there's also what we're seeing in terms of other policies and fiscal policy and regulatory policy. So getting that whole picture, and then watch what's happening here in our country, but around the world, and put all of those together to see where monetary policy, what the appropriate stance of policy will be. But to answer your question, I think the current place where policy is good. I don't see any need to change it right away.
All right, there you go. There's one market-moving headline. You mentioned what information you're trying to collect from the companies that you speak to. Are the CEOs as lost as the Fed and the rest of us in terms of what the impact of all this is going to be?
Well, I think when you talk to business leaders, the first thing that they tell you is they have to prepare for whatever happens. They're not sitting there having to guess, well, this is what will happen or that will happen, but really think through strategically about how to manage, different scenarios and how to behave. And I think one thing you're getting more of a sense of from some business leaders is kind of a view of, let's be cautious about making big business decisions right now. Let's get that additional information around what's happening in terms of this broad set of policies before making decisions. I mean, measures of uncertainty are pretty high right now, and I think people are taking that into account as they think about, maybe collect that more additional information before they make those decisions.
Well, as they try to put these things together, what's their underlying view of the economy and what they would do, and then how is this laid on top of it?
Well, my view coming into this, setting aside, say, some of the trade policy issues that we're talking about, is the economy is very strong, very solid growth. We've had very good productivity growth. We have a solid labor market, and the economy is in good balance, and inflation is coming down. So I think that's your starting place. And then the question is, what happens with various policies, and how does that, what adjustments do you have to make in your thinking relative to that? But I firmly believe that we're starting the year not only in where we are today, but the momentum we have is good growth this year, slower growth than say last year, but inflationary pressures coming down. Now, of course, you have to add to that any policy changes that affects that.
Well, that's the big question. What are companies telling you about their plans for dealing with tariffs? Are they going to pass them through?
Well, I think, again, it depends on which industry you're talking about. It depends on, some tariffs may apply to some industries or goods and not to others. I mean, right now, I don't hear people literally saying, here's how it works. I do go back to the experience of 2018 that you talked about, 2019. And also some of the experience of the pandemic. I mean, when producers or retailers are confronted with much higher costs, they have to figure out what to do, and they're going to try to pass that on to their customers as much as they can. They're going to try to find probably some ways to adjust other margins of cost or prices, and other competitors and things may take actions as well. So I think there's no kind of plan that every business has for that, but based on history, what we've seen is, we see a pretty high pass-through of tariffs at least into import prices.
Well, in 2018, you were looking up at the 2% inflation target, and companies had no pricing power, and we were all very excited to go online and shop and get very big discounts. That all changed after the COVID pandemic. So does that set us up in a different way to deal with rising prices? Are companies going to say, hey, we did it, now we can do it again?
Well, I do think that you're absolutely right. The conditions back then where inflation had underrun our target, moderately for about a decade. We were looking for inflation to get a little bit higher on a sustained basis at 2%. And the economy was strong. The unemployment rate was low in 2018, 2019. So we're in a very good economy. And the actual policy actions that happened, both on fiscal policy and trade policy, I mean, they clearly affected the economy. We saw, I think, some boost to inflation, short-term boost to inflation. But it was in the context of economy that was, hadn't seen inflation for a long time. The experience of the past few years has shown that businesses have become much more attuned to how to figure out how to pass on cost increases. They feel they have more pricing power. They've flexed that pricing power quite a bit during times of shortage. And I think households also very sensitive to prices, a high cost of many goods. So I think it is a different situation today. And you see this in surveys and other forum. We talk to people. It is different than it was in 2018, where really there was almost a decade of no inflation. So I think it's a different context.
Well, speaking of surveys, recent surveys that have come out show people think inflation is going up, even at the longer term. The Michigan numbers for 5 to 10 years are up. Are you worried that Americans are going to be much quicker to sort of de-anchor their inflation expectations?
Well, it's obviously something I watch very closely. Inflation expectations, whether in surveys or from market measures or from economists, are something that's really important for us to study, to understand where the people are thinking about inflation, how they view future inflation, and that feeds back into the economy. So it's a really important topic. I can't help but point out that the New York Fed, we carry out our own survey of households, a survey of consumer expectations, and study every month the results from that survey. So it's something I take seriously. So what am I seeing in terms of the surveys? I think on the Michigan survey, clearly it's the most recent readings have moved up quite a bit. That's something to watch closely. I'm not going to say it's not important. I do think that there are some aspects of the Michigan survey that might make it a bit sensitive to some spikes and things. We've seen that in the past. particularly kind of how they ask the question, how they collect the data. There's nothing wrong with it. It's just that we've seen that sometimes you'll get a big movement that gets reversed. In our survey of consumer expectations that we've done, at least for the data we have, which is not the most recent data, we haven't seen much of a movement in short or longer run inflation expectations, but it's something I'll be watching closely. One thing that definitely happens, and I think we're hearing from businesses, and I think we are getting this from, some of the survey data, like in the Michigan survey, is the talk of tariffs, the sense that there's, higher prices, out there is clearly influencing how people are thinking about inflation this year. I'm not seeing as much of an indication in most of these surveys that that's about long-run inflation or inflation in the future, but more about inflation in the near term. And clearly, people are experiencing some higher prices and are maybe more focused on that right now.
You have to come up with your own survey answers at the March 19th meeting. In December, when you put out the last summary of economic projections, it was widely assumed that was sort of a dead letter when you put it out because nobody knew what Trump was going to do, and by March, you'd have a much better idea. Do you have any better idea, or is this also going to be something we'll look at and go, we'll see you in June?
Well, if you look at my website, I have this thing about research interest, and it says monetary policy under uncertainty. And I think that's a good description of my job, because you always have uncertainty. You have uncertainty about policies. We went through the pandemic. We've gone through various events over the past several decades. So you're always dealing with that uncertainty and needing to make the best decisions. I do think relative to December, clearly some of the actions that have happened, even the discussions in Congress around fiscal policy have provided a better idea of the types of policies that we will or likely see. I still think that I don't have a lot of confidence in, say, the base case, that this is my forecast for the economy, this is where it's going. I'm much more in the kind of the mode of thinking there's a bunch of scenarios that could happen. We could see this happen, the tariffs be very short-lived, and then we move forward. Where there's others where it's much more permanent or different. And so it's really thinking through these scenarios, thinking through what the risks those imply for achieving our maximum employment price stability goals, and then how do we position policy for that. So it's not about getting the right guess about where everything's going to happen, but it's really just getting policy position right. So that's how I'm thinking about it. So do I have more information that helps inform that? Yes. But it's still, I think that the base case I would, or the one that we're asked about is kind of the most likely scenario, is not the only one that's important. You really have to think through all the different paths that we could be on.
Well, along with the summary of economic projections comes everybody's favorite diagram from the Fed, the dot plot. In December, you said 2 this year. The consensus median was 2 rate cuts this year. As of today, we've priced in 3 in the futures markets. Do you think 2 is still a baseline, or do you really have no idea at this point?
So Mike, my whole attempt to say I'm not putting a lot of weight on my base case didn't work at all, right? So I try it again now, I'm kidding. I think it's really hard to know. I mean, right now the markets, as you say, they're pricing in 3 to 4 rate cuts this year based on futures. If you look at the modal expectation in the market based on options, it looks maybe more like 1 or a little bit more than 1 cut this year. And again, these are market expectations. I'm not making a prediction. I think that's actually really kind of informative. Market participants are trying to figure out, well, the modal case is something like 1 cut or maybe a little bit more, but there's just a wide dispersion of views out there. And it gets back to these scenarios. If you're in the market, you have to think about what are the different scenarios and position for that. Clearly, market participants are kind of thinking about some scenarios where they're protecting against scenarios where the Fed needs to cut some more than the base case. And I think what that's just reminding us is just there's a lot of uncertainty about the economy, about the policies. I'm always just focused on one thing, which is how can we set policy and hopefully set a path of policy that best achieves our goals. We're starting in a good place. Let's just try to keep the economy on the right track to get the inflation down to 2% over the next couple of years and keep the sustain the strength in the economy and the labor market.
I want to switch over to the balance sheet because there's still a lot of interest in it. There are projections basically are going to stop QT roughly the middle of this year. But there's also a paragraph in the last minutes that suggests that you might stop it early if the debt ceiling is not resolved, because that could affect liquidity. Is that a real possibility?
Well, let me explain that notion. I mean, right now, our strategy hasn't changed. The strategy is we want to continue to reduce our holdings of Treasury and mortgage-backed securities until we get the level of reserves to what we say is somewhat above ample. And that's something we study very carefully. We have a lot of information from market participants. We have various statistical and other analysis we do to try to measure are we providing enough reserves into the banking system to achieve our interest rate control goals. So that is a strategy we put in place a couple years ago. We're still executing on that. One of the things about that strategy is we need to be monitoring what's happening in money markets, what's happening in the repo markets, the Fed funds markets, what's happening, in all these different indicators we're looking at. And with the debt ceiling dynamics that we're talking about here is that during a period of the debt ceiling, what happens is basically the Treasury spends out a lot of their money that they hold in account at the Fed. That actually increases reserves. As the debt ceiling is ended, that switches. And so you get big movements in the amount of reserves out there. There's really not driven by the demand by banks or the financial system, but kind of artificially moved around by kind of the dynamics resulting from a debt ceiling issue. And so the point that we're really making is we want to have a good view of what's happening in the money markets, in what's happening in kind of in general there. And this is, in a way, making it harder to see what's happening because these other movements driven by the debt ceiling dynamics are kind of clouding that picture. So the idea of either pausing or slowing the shrinking of the balance sheet temporarily was really just to make sure that we're, during a period where we don't see things as well, that we don't inadvertently get to a place where reserves are lower than we intend. So it isn't a change in the strategy. It isn't a change in kind of what we're trying to do, but it's really about how do we best execute on that strategy in a way that achieves the shrinkage of the balance sheet without any market disruption.
All right, we're getting a little low on time, so I'm going to shorten my questions. We'll do something of a lightning round here. We know the Fed defends its independence as important for good monetary policy. Are you worried about Fed independence over the next 4 years?
I'm not worried about Fed independence. I am obviously, feel that Fed independence or independence of central banks in general is extremely important. We carry out our decisions, our analysis. Everything we do is to achieve the goals that that we've been given by Congress of maximum employment and price stability. We're just, everybody who works in the Fed is just committed to achieving those goals as best we can. It's not in any way influenced by partisan or political influences. I think the evidence internationally is having an independent central bank gives you better outcomes for the economy, for the people of the country. So it's not like I like independence because it feels good or it's comfortable. It's because it's been shown to yield better results in terms of inflation and economic results. And that's why I think it's really important.
You've started your review of the monetary policy framework. What is it you're expecting to find or do? There's been criticism of the Fed letting the economy run hot for too long. Do you need to get back to perhaps anticipatory rate moves to keep inflation in check?
Well, obviously we are in the process of reviewing our framework, and that will be a very thorough discussion of a lot of lessons learned. So I won't comment on that. I do think one important thing was with the previous framework, which was instituted in 2020, was heavily influenced by the basically decade of very low inflation, interest rates near zero for 7 years, and a very unusual environment, and designed to address some of those issues. But at the same time, it was designed to be able to set us up for success if the opposite happened, if we had high inflation or too. So although a lot of the attention on the 2020 framework was about the changes we made then, from 2012 through today, our framework has always emphasized the importance of achieving 2% inflation price stability, always emphasized the importance of well-anchored inflation expectations. And I think just it has always been founded on this notion that price stability is essential for economic prosperity. So that's always been there. That's not going to change. And I think, and again, I'll just say, there was never any confusion about that, or in any way did our framework interfere with us making the decisions we need to make sure that we ultimately restore price stability.
Let me tie it all together in one last question because we're basically out of time. But given what's happening on the fiscal side and in Washington, given your review and given where we are in the economy, are we looking at a regime shift in the U.S. economy, one that would lead to changes in the way you think about or perform monetary policy?
Well, I think the U.S. economy is amazingly dynamic. I know that's a theme here. We are the leaders in innovation. We are the leaders of dynamism in the global economy. So you're always operating in a changing environment. Fiscal policy is part of that. Other policies are part of that change. But in my 30 years in the Fed, I've been through many different cycles of fundamental changes in our economy. When I started out, we didn't have the internet. We didn't have a lot of things we take for granted. But I think, from my point of view, we always need to be open to the fact that parts of the economy, parts of the global economy are changing. And again, how do we take that into account, do our best to understand what that means for achieving our goals and make the right decisions? So are we seeing changes in fiscal policy or trade policy? Yes, but in the broader context, I would say my whole career has been a time of various changes, and we just have to be good at adapting to a changing environment and carrying out our mission.
John Williams, thank you very much for joining us today.
Please welcome to the stage Ryan Tolkien, CEO and Chief Investment Officer of Schoenfeld, and Jim Zelter, President of Apollo Global Management, for a conversation with Bloomberg's Sonali Basak.
Thank you both for joining.
Happy to be here.
So it's interesting, the perspective both of you are going to bring, because we have the private market perspective, we have the multi-strategy hedge fund perspective. Everyone knows what this week in the market looks like. It's pretty brutal, to say the least. Ryan, how have you been navigating what's going on? How are you looking at the most recent moves, the most recent volatilities in the broader scheme of things?
Thanks for having me. Let's take a step back. We're 40 days into a new administration, and I think a lot of what we've seen is probably what many of us expected, but what the markets failed to price. And so over the last 40 days, we've seen a pickup in that base level of volatility. Uncertainty has clearly risen. We're clearly seeing a consumer that is a bit worried. We're seeing retail sales lower, University of Michigan confidence numbers lower. We're starting to see uncertainty in the corporate boardroom. And I think that's starting to price into equity markets as well as fixed income markets. We've seen the 10-year rally from what was 480 to now 415. We've seen equity markets sell off 5% plus from the highs. We've seen a correction in the Mega 7. And so we're starting to see some of that uncertainty that's getting priced in through a combination of economic uncertainty and geopolitical uncertainty in the markets. And so for us, what we're trying to focus on in the end of the day is which ones of our strategies are ultimately in a position to benefit from that. How do we set up our portfolios such that we are leaning into the strategies that are more positively convex, that benefit more when the market ranges increase, that benefit more when ultimately the correlation factor of stocks is greater than where it was over the last 12 to 15 months. And that's really what we're starting to see.
Jim, that interest rate part of the equation has been really interesting to see that drop off from 480, as you said, to 415. Stunning move since the middle of January. What is your tariff takeaway at the end of the day? When you look at the market, it seems to be screaming growth scare.
Yeah, I think that, I look at this as really an intersection of, when we came into the year, a lot of, tremendous animal spirits on taking risk on in virtually every asset class. And now we're at a collision between macro paralysis. And so when you talk to folks that are inside boardrooms about strategic M&A, about IPOs and other large capital formation activities, there's just really a standstill right now. And certainly in the short term, the conversation about stagflation with the tariffs and other activities and tax cuts, that's got to be a short-term conversation. But, as Ryan said, heightened volatility, access to some companies are sometimes in question. Those are periods when we as a franchise and the world of private capital, private credit, we welcome these opportunities because There's always great companies that need to get financed. But certainly you have a white-hot marketplace that has been punched in the face the last 5 to 6 days about the reality of not 1 or 2 initiatives out of the White House, but a dozen initiatives and 70 executive notes in the first 32 days. So it's an extreme time that many of, or if not all of us, have never been through before.
To that end, Schoenfeld has actually held up well against its peers in this environment. It's been brutal. A lot of people, as you say, Jim, have definitely felt punched in the face by this market. What's working in this market?
Sure. So as I said before, I think some of the strategies that we deploy that tend to benefit as the ranges of individual stocks expand is what's working. So for us, we've got a big quantitative trading business. When market volatility and market volumes increase, as we sometimes see in these periods of uncertainty, that can be a really beneficial market for some of our quant trading strategies. Some of our short-term trading strategies that can take advantage of some of the momentum or the reversal of momentum in some of the stocks that ultimately probably got to valuations that were too high based off of some of the animal spirits that Jim mentioned. You know, leaning in and deploying more risk in those type of strategies has certainly worked, as well as some of our volatility strategies that ultimately benefit from the breakdown in the correlation regime that we've seen over the last 15 months. And so those are the things we're leaning into. Of course, some of the strategies that are short vol, that in the end of the day are more momentum oriented, that outperformed, you know, in the post-election period up until Inauguration Day. Those are the areas and those are the parts of the portfolio that are struggling. And so trying to figure out as investors how we square some of our risk in those areas and make sure that we're set up for the uncertainty that's likely to continue going forward. I mean, if what we've seen over the last 40 days is any indication of what we're going to see over the next 4 years, we need to be prepared for consistent tweets, consistent executive action and things of that nature. And so as such, it's really important that we start to reposition some of our portfolios.
You know, it's interesting. And Jim, I have to give you credit because doing this conversation with the two of you was your idea. And I first asked what you both had in common, and it's the Duke endowment, interestingly enough. So you're not only watching this market from the perspective of your own firms, you're also watching it from the perspective of a large institutional investor. A lot of soul searching going on in this market right now. You mentioned animal spirits. Apollo talks a lot about market concentration in particular. What do you think the new truths are going to be about this market as people realize being so overweight, just a small handful of names is maybe not the path forward?
Well, I think there's a lot of questions there. I think we've been very vocal that the evolution of the marketplace, the evolution what's gone in the area of credit, which certainly we feel we're front and center in, and Ryan can talk about his franchise. But if you look at the role that we play today in capital formation of companies, and you know, there's a couple of big misnomers. Private credit is not just the non-investment grade sponsor lending. That's an interesting asset class. We're a big player. It's a $2 trillion asset class. We've been very vocal that the opportunity set is much bigger in the 40 trillion asset class. And I do think that right now, what the backdrop that Ryan described is we've had a very concentrated market, tech-led, and there's a greater degree of dispersion of company outcomes. That's good for real investors. If you're a real money investor, I think that's a way for you to outperform instead of being involved in a passive index or a concentration. So from our perspective, this is the kind of environments that we like, that we expect. There's still a tremendous amount of, with all the initiatives that have been announced, there's a tremendous amount of capital needs from a variety of investment grade companies. And we're poised to be able to participate and provide that capital. But I will say, you know, base rates right now, low fours, mid fours, high fours, when you can look at where you can be a lender in the world of credit around in the US today and in some parts of Western Europe, it's a very, very provocative asset class in terms of the appeal of the duration of that coupon, the compounding, and when you lay that against what's going on right now in the world of equity with volatility. But the basis of my conversation for leading us here is that people really don't think of a multi-strategy firm like Schoenfeld and Apollo having a lot in common. But I think if you see what's going on in the asset classes over 25, 30 years, there's a reason why we both ended up in these situations.
To that end, what are you seeing in terms of the ability to kind of dive in as investors start to spread out? General commentary here. I mean, what do you make of the fact that investors were so long NVIDIA and maybe nothing else?
Yeah, I think that's where the opportunity is. And so to the extent that we see the breadth of the market expand, that's really good for our business. Ultimately, we benefit from dispersion, as Jim was saying. And so our job is to identify relative value opportunities across a combination of the asset classes we trade. Sometimes they're more in the equity space, and we can take advantage of that. Other times, we've built out businesses like our macro fixed income business because there are more opportunities there. And so what we're trying to understand across all the asset classes we trade is where is the risk premia mispriced relative to the volatility and the liquidity that exists within that asset class. And when we see meaningful dislocations, which we've started to see, and which, if this uncertainty continues, I expect us to see in an even greater magnitude, we're poised to take advantage of that. And by having experts across a combination of credit and vol, long short equity, quant, and each of the different strategies we run within our multi-strat organization, we have the insights, we have the analytics to be able to compare where that risk premia is mispriced and how we can ultimately lean into it. And I think that's what we're trying to do. And to the extent that volatility increases, I think you see more of that mispricing.
Jim, it'd be a missed opportunity if I didn't ask you if your thoughts were changing about your broader view of the world here. You have a lot of investors starting to think about stagflation, maybe even a recession, complex situations around sticky inflation, but slowing growth. How do you navigate what's your base case here?
Well, I mean, Torsten really is our spokesman for the economy. We still think the underlying economy is quite strong. There's a bunch of curveballs with regard to the Doge activities and government, cutbacks with 300,000 people and the multiplier on that. But, I think all the things that Ryan's been talking about, whether it's volatility, in the marketplace, concentration, that brings a conversation to investors to a firm like ours where people are saying, there's a pension deficit. They want to allocate more to private capital, private credit, because the simplicity of compounding and getting a coupon every year. And so in periods like this, we always find ourselves busier than usual. There will be a period where the public markets have a dislocation. There may not be perfect access for many companies. And so for us, like this is the reason we were built for these types of markets, to be robust, to be in business, to hang our shingle 24/7, and such that when companies either facing an M&A opportunity, a strategic purchase, whatever it may be, that we're open for business and can write $5, $10, $15 billion commitments across the debt and equity vertical and horizon. That's what's important to us.
And I want to go back to what you said about base rates still being elevated. You mentioned your fixed income business too. I presume it's part of the same reason. You have base rates elevated. How attractive is the fixed income opportunity to you right now? And would you ever consider privates?
Sure. So for us, we focus a lot on liquidity. And the reason we focus on liquidity is ultimately it allows us to pivot as market conditions change. And so we have stayed away from the private credit space. Jim's the expert in the private credit space, but we've built a credit business. We've built a fixed income business to trade across a variety of the more liquid and tradable, credit asset classes. And that's been beneficial for us in that, when the opportunity is in investment grade credit, we'll be there. When that opportunity shifts to high yield, we can be there. When that opportunity is in Europe, we'll be there from a geographical perspective. And so we think there's enough to do in the more liquid credit markets that's consistent with our conviction and belief in having liquidity and being able to pivot, especially as market volatility increases. And so for us, I think that's the name of the game.
I think the idea of liquidity brings me to, I think one of the most interesting stories for structure in private credit, the ETF that was just put out by State Street that involves Apollo. You have a trading desk now, Jim, also that looks to trade private investment grade debt. What's the grand plan here? How liquid can these markets get at the end of the day? Apollo talks so much about the convergence, but what's the timeline and what's the scale?
Well, again, let's take a step back. Why we're both up here today, I think that when you look at the evolution, I've been doing this is my 39th year in the industry, and when you look at where the credit markets were, the role of the old Goldman Sachs, the old Bear Stearns, the old Merrill Lynch, and then the consolidation of global banks, it's not a surprise post the GFC that you've got some very large platforms, ours being one of them, and the same parallels happened in the multi-strategy. Back in the early 90s, it was all about single manager hedge funds, and it was a star system. That still may exist today, but not to the same degree. So the breadth of capital, changing our liability, we have long tail liabilities, taking our cost of capital from 20% down to 6%, and being able to bring in the best and the brightest from the sell side. It's changed the complete dynamic of our business. So when you ask what's the end game, having done this for a while, there was a period of time in the early 90s where loans did not trade. Believe me, in 1990, no one traded a loan. Now it's a $2.5 trillion asset class that has plenty of ETFs and trades very actively. Last couple of years, the CLO liability market, AAAs, they were used in the past, they were bought by 7 banks within 3 blocks of the train station in Tokyo. Now there's a $22 billion ETF on CLO AAAs. And so what we're trying to do, I can't directly address it with what you asked, but the reality is there's an evolution into a lot of these asset classes. Our focus is on the investment grade part, not the old traditional leverage lending part. And as more investors come in that are focused on transparency, on information, and on financing those assets, there will be a marketplace for those.
I know you're begging for this question, right? When you think about all the activity that's moving outside of the banking system to you, does that pose a new systemic type of risk?
We've been very clear the U.S. banking system is the healthiest in the world, and the fact that over the last 25 or 30 years that the banks have systematically dispersed risk by the syndicated loan market, by a massive investment grade bond market, by a securitization system that really, whether it's synthetic risk transfer or other trades, there's a reason why we're the healthiest market in the world. There's a reason why one of the largest, most growing economies in the world, or the largest and most robust economy, why private credit has succeeded here. So we would vociferously have the view that we have mitigated a tremendous amount of risk with less levered balance sheets and longer duration liabilities.
And just to add to that also, the fact that the banks are much more focused on market-making activity instead of the proprietary trading activity, and that proprietary trading activity has shifted to buy-side institutions, whether that be the Apollos of the world or the Schoenfelds of the world. And so a lot of the types of trading businesses that we run today are trading businesses that existed inside the banks that, in the end of the day, do take risk and do, ultimately take the other side of certain transactions. And I think whether it be the index rebalance business that was very popular in the banks, in the 2010 to 2015 era, that's now much more popular on the buy side, or some of the Delta One businesses, or certainly some of the macro fixed income businesses that both Jim and I both run. I think these are all examples of things where that risk has shifted from the sell side to the buy side.
So when you look at them, yeah, go ahead, Jim.
And I would say, when you think about, I think from our perspective, we've partnered with the banks as strategic partners from origination, whether it was Citi or BNP or large financing arrangements with Standard Chartered. We found a spot where either we're pari passu with a longer tenor, or we're senior junior, or whatever it may be. The same can be said certainly for the prime brokerage business and the securities lending business, where the largest institutions are focusing on the largest multi-strat funds. And there's a degree of dialogue and senior leverage that occurs across our organizations. And we both have seen the consolidation of resources and dialogue and flow, and want to make sure we position our firms collectively to be able to be the partner with the banks in those areas.
In the hedge fund world, the multi-strat world has gotten such a big role in the world of hedge funds more broadly. So what risk are you most worried about then? People talk about concentration, leverage, but what is it for you, Ryan?
Yeah, I mean, clearly the largest risk is ultimately crowding risk. And so, I think given the way in which some of the risk has transferred to the multi-strats and the multi-PM organizations, you have to focus and understand where people are positioned, where the crowd is. And so what do we do about that as an organization? we try to invest and we try to build businesses where there are larger barriers to entry, where it's not so easy to stand up and replicate a business like some of the things we do overnight. And so we touched on the quant business earlier. One of the reasons why, if you look at our risk allocation to the quant business as compared to many of our peers, we are more allocated to that business, is there are a lot of barriers to entry. It is hard to stand up a quant business. The costs are high. The cost of acquiring talent is high. The cost of building and maintaining a data platform is high. The cost of investing in consistently upgrading execution infrastructure is high. We've been doing it for multiple decades as an organization. And so we have the benefit of not only the long-term investments we've made from a CapEx perspective, but also the recognition that we have a bunch of proprietary data that ultimately cannot be bought off the shelf. And so when some of our peers tell us that they're trying to build new quant businesses, we sit there and we say, good luck. It's really, really hard, and the barriers to entry are high. And so the way you protect yourself from the crowd to a large extent is you make sure that you have more risk allocated to some of these businesses where the barriers to entry are just higher.
And in our example, the comparison, again, to compare and contrast, we had a view that in many asset classes, the perception and the reality of investor is size is an enemy in many asset classes. In the world, the reason why we are so large in credit is scale is a massive advantage. We've taken our cost of capital down dramatically. And when Ryan talks about the quant business, you've heard me talk about it, Sonali, we are focused on the origination business. Many asset management firms are focused purely on raising capital as the competitive benchmark to success. We think it's all about your ability to originate proprietary deal flow. And so for us, we spent a decade, spent almost $9 billion, 16 origination platforms, 4,000 people that every day come on in and produce that safe, secured yield for us. So for us, we had a vision 15 years ago where the industry was going, and we wanted to build a machine that would really be able to take that on, ready for this prime time activity.
I keep making a joke that origination is the new hot job on Wall Street, but stick with that for a second. You have done something else that's been fairly new for Apollo's history, which is acquisitions. And you look around the industry, and in the private credit world in particular, just an enormous amount of consolidation. What's the strategy here?
Well, we've done a variety of smaller tuck-in acquisitions, and before I got to Apollo, I spent 20 years on the sell side at Goldman and Citi, and having been through a few acquisitions, they're culturally challenging. Embedding a culture, an investment culture, a risk-taking culture with new people is always hard. So we've chosen to do very, very small, add them into our business, whether it was Gulfstream or other things that we've done, or Stone Tower in our credit business, or mid-cap. We've chosen to be very small, have them get up to speed in our business for a while, and then really scale it over time. So I do think just having a toolbox with lots of different brands in it and showing that to a borrower, I think that's a cumbersome toolbox. For us, we need to be really on the same page.
Look, and just to add on to it, in our space, I do think that throughout our history, looking at different acquisitions and thinking about how we grow through a combination of partnership, joint venture, or acquisition has all been a part of the Schoenfeld story and the Schoenfeld DNA. I think about how we ultimately stood up the Asia business, and we considered a bunch of different alternatives before we decided to expand into Asia. One was to try to start a business organically, but ultimately we chose the path to first form a joint venture with another asset management organization, and ultimately when we had the opportunity to then actually go out and acquire that business in Asia. And I think about that business, and to Jim's point, at first there was a lot of cultural challenges as it relates to the integration of the two businesses. It was roughly 50 people at the time in which we acquired that business. But today, that business is 225 people for us. It's roughly 25 to 30% of our risk. We made probably 30 to 35% of our P&L in 2024 out of the region. But it was ultimately sparked by some acquisition.
But would you be open to more in the future?
Yeah, of course. I think we've got a business development team out there that's roughly 30 people. And we're out there looking for different opportunities every day. Sometimes those opportunities just come from bringing some new talent, into the organization. And sometimes those opportunities come from acquiring new businesses. And so when I look across the suite of strategies we trade, certainly as it relates to expanding some of the existing strategies, there are acquisition opportunities that we're considering right now. When I think about expanding into new strategies, it's always easier to think about and look at if somebody's been there and done that before. And so when we built out our macro fixed income business, that was an acquisition opportunity. That was a business that was going to think about getting started as more of a single strategy fund, but recognize that there were economies of scale in ultimately bolting on that business to a broader platform that traded a variety of different investment strategies, where ultimately the data, the insights, the analytics that we have within the platform could be shared to create something better than what a single strategy fund does.
Before I let you go, I'd love for both of you to lean in, because both of you have talked about your people. There is a talent war going on that is very significant in both of your businesses. How do you win it?
Being Apollo. We have an amazing brand. No, we're very fortunate. We have, for every position that we post, there's a line over the transom of great applicants. It's not just been the last 6 months, it's been the last 15 years. And you don't grow like we've grown with great senior talent across many parts of our organization. And again, I think, Ryan talked about it. Whenever you want to do a new business, it's buy versus build. We find that when you go on your own, there's a tuition you have to pay. So a small acquisition that forces you at the edge to figure things out, we find that's the better way to go. But the human talent, we are in the ultimate human capital business. It's what drives us. Marc and I spend so much time talking about it and leading by example. So listen, by no means is it over. It's a constant marathon.
I'll say two things on the topic. One,
you can't steal the answer, so.
Great talent attracts great talent. And so if in the end of the day you put great talent in leadership seats, that's the number one path to victory. The other thing that we say at Schoenfeld is ultimately talent development and talent retention ultimately is the tool toward talent acquisition. And so if we have great risk takers and ultimately we build great businesses with those risk takers, they become the greatest ambassadors for us recruiting future risk takers into the organization. And so that's how we've gone about trying to build our business at Schoenfeld, which is have an industry-leading talent retention rate.
Thank you both so much. Very complicated market, but a lot of change in your businesses. We really appreciate you taking time with us today.
Thank you.
Thank you.
Please welcome to the stage Raj Danda, partner and global head of wealth management at Ares Management, and Mina Flynn, co-head of global private wealth management at Goldman Sachs, for a conversation with Bloomberg's Katie Greifeld.
I'm Katie Greifeld. I'm joined now by Mina and Raj, and we're talking about the pulse of wealth management. We're going to take the pulse right now, and I think a nice scene setter would be to just talk about how you guys work together, how your two worlds intersect. Mina, you are the co-head of global private wealth management, also the co-head of One Goldman Sachs, and Raj, you're the global head of wealth management at Ares. So Mina, I'll start with you. How do you see your two worlds touching?
Sure. So we have the fortune with working with ultra high net worth individuals. And our portfolio construction has roughly about a 25% allocation to alternatives for those individuals. Within alternatives, one of the sub-asset classes is private credit. We spend a tremendous amount of time at Goldman diligencing managers. And we diligence them both on the investment side as well as on the operational and the risk side. And a handful of managers we do put on our platform for our clients then to be able to implement their alternative exposure through. And so we are fortunate to be partnering with Ares as it relates to our private credit allocation within alternatives.
And Katie, we have the benefit of partnering with really just a few global platforms like Goldman, and our mandate is to deliver the best of what Ares Management does globally. So whether it's solutions that fall under durable income or private equity or real assets, and whether it's education or portfolio construction, we partner with a few of the global wealth firms, and and bring our best strategies to them, and that's the relationship, and it's global and it's across all the markets.
Well, let's talk about what that looks like. What a wealth portfolio that includes private assets looks like. And Mina, you mentioned that you work with ultra high net worth individuals. So my first question would be, what is the current definition of ultra high net worth, and how do you think about what asset allocation looks like in those types of portfolios?
Sure. So ultra high net worth we define as $25 million over in investable assets. In terms of the allocations, as you would imagine, it's very bespoke and customized. But at a very high level, I would say if we've got a moderate risk individual, we would roughly have about 40% of their portfolio in public equities. We would have 25% in alternatives, and then we would have the remainder in high quality fixed income. The portfolio construction is just super important. It's the number one conversation that we have with clients, both upfront and then on an ongoing basis. And the reason why this is really important is that you want clients to be able to withstand the volatility when you've got markets such as we've got today and not be taking so much risk that they sell and crystallize a loss versus actually staying put or buying more. But on the flip side, you also want to take enough risk such that you offset inflation on an after-tax, after-spending basis, which is why it's that diversification of both high-quality fixed income, equities, and alternatives.
And you think about the past few weeks we've had, I'm sure there's plenty of investors who would prefer not to mark to market right now, but this brings me to a point that I think about a lot when I think about allocating to privates versus the public markets. And I realize it's not a black or white scenario, but there was a really interesting conversation that Eric Schatzker had with Dawn Fitzpatrick of Soros earlier today, and her view was that basically that private investors, those who've shifted from publics to privates, are in for a world of hurt, because up until the last few weeks, I mean, you could get 20% back-to-back gains in the S&P 500. And Raj, I wonder how you think about that from where you sit. What you're giving up in terms of liquidity and potentially returns when it comes to the private markets.
Yeah, of course. So the advisors we work with and their clients have actually been quite frustrated with the public markets over the last 3, 4, 5 years. And it's led to this real ramp in flows for firms like Ares. And it's very client driven. The public markets have become highly concentrated. So the 6 or 7 largest names represent 50% of the trading activity.
The magnificent ones.
The Mag 7. And you contrast that with the fact that 90% of companies with over 100 million in revenue are private. So you've had this sort of push and pull. Public markets are extremely volatile, concentrated, and as such lack diversity. And I say it somewhat in that it's ironic. 20 years ago, this wasn't the case. But today, private market solutions spans infrastructure, real estate, private credit, private equity. And that really enables you to rethink the investment landscape. I think of it as you would have a bucket of equity exposure, a bucket of credit, and an allocation of real assets. And in each case, you can have public and private allocations. So I don't know who's in a world of hurt, right? I mean, the volatility just since the new administration has been here has made it really difficult for advisors to keep their clients invested. And what we do is, and when we partner with the premier brands like Goldman and their advisors, it's quite easy because if day trading is one extreme and wealth creation is the other, we get to partner with advisors that think about portfolio construction across all these attachments, private and public.
Well, Mina, I'd love to hear your perspective on that. That obviously, again, it's not black and white, but how do you think about that, the different return and liquidity profiles?
Yeah, I think we've been investing in alternatives since the 1980s, and so our clients are very familiar with alternatives through multiple market and economic cycles. Just to pick up on what Raj said, I think one of the most important things about alternatives is that while they are illiquid, they actually put the emotional side of investing to the side because they don't mark to market on a daily basis. And so it actually helps clients stay invested instead of getting really nervous and selling when you probably should be buying. And so, one is it puts the emotional side of investing aside. The other, also in terms of what Raj said, is if you look at the last 25 years, the number of public companies outstanding has decreased. And the number of private equity-backed companies and private markets has increased sixfold. So the investable universe is much larger. And then the last thing I would say is because there is so much capital now in private markets, the ability for these companies to fund themselves in private companies and really transform their businesses and have a significant amount of value creation is there. And so these companies are skipping small, mid, large cap before they do go public or M&A or just stay private.
Yeah.
And so I do think that it's a very attractive asset class. But to the overall point also of how we started this, it is illiquid, right?
Yeah.
And so you really do have to be mindful as it relates to where do you put your capital before it gets called, as well as how much of that capital are you comfortable being in illiquid assets?
Yeah, I mean, those are some interesting points you made. And to your point that, we've seen the public markets, the investable universe of public equities that are out there, people, or companies rather, just skipping up and IPOing as large caps. The point has been made to me that that's why you would want to be in alts, that, you're missing out on all that growth. It's not necessarily happening out in public, but if you can get private market exposure, you can still actually participate in some of that.
Absolutely.
Yeah. So
actually, to that point, one of the things I would say is we actually did recently increase our allocation to growth and to buyout in alternatives, and we actually took it out of international equities. Still have exposure to international equities, some of the best companies in the world. But, just again, to your point a little bit, when you think about the innovation and value creation and growth, and then if you look at buyout and specifically more middle market or upper middle market, the amount of value creation that these managers can bring and help these companies through, and then they really also have multiple paths to exit. And so the operational excellence really help the company create more value, and then you have multiple paths. And so we recently actually took our allocations up to alternatives to take advantage of that.
And Raj, come in here because, what we're talking about, obviously fundraising is one thing, and we were having this conversation in the green room that deployment is a totally different conversation. So as, we just see private markets get hotter and hotter, it feels like the headlines just get even heavier each day. How are you viewing that from where you sit?
Well, so Ares has been around now almost 25 years, a little more than 25 years, and it sometimes is assumed that you can't keep innovating throughout that long a period, but sports is an interesting area that, as an asset class, it took a firm like Ares to develop the right solutions to owners of the different teams. And we think of the opportunity to invest in sports as a case where the solutions expanded the addressable market. And today, across leagues in the U.S., opportunities globally, it's a asset class that has come about really since the beginning, since just before COVID, and into a whole nother democratized opportunity. So that at a really simple level, we don't think of it as alternatives anymore. We think that term is a bit backwards. We think the public markets is a great alternative. And we think that the private markets allow you to do a lot of different, to access a lot of different opportunities that you can't actually do otherwise.
Yeah, well, I'm sure you guys have heard the idea that the public and private markets are converging. And you talk about financial innovation. I think we have to talk about the private credit ETF that launched last week from State Street and Apollo. Probably not the product for ultra high net worth individuals, but you think about the fact that this product even exists, the idea that you will put a liquid asset, such as the type that we're talking about, into an extremely liquid wrapper. I just wonder, what your high level thoughts are.
Well, I mean, any sort of innovation in the product space or further democratizing these solutions, we applaud, and we think it's a step forward. But actually, today you can recreate a lot of that exposure. You can invest in a public BDC, you can put that together with public fixed income options and create that. So we'll see how that does evolve over time. What we're really focused on is, and I think this is where the sort of sweet spot of Mina's platform is too, is that investor that has between $1 million and 100 million and their allocation, certainly 1 to 5 million, is still in the mid-single digits. Perhaps not on the Goldman platform is sophisticated enough, I'm sure it's more, but that's a $80 trillion addressable market. It grew last year to almost 100 trillion. And that's where we're spending a lot of time providing them the education and the portfolio construction advice to grow their private markets allocation.
Right. And Mina, I don't think that necessarily you're buying ETFs for your clients, but I am curious how you are actually getting exposure to the private markets, what that avenue actually looks like.
Yeah, I think one of the things that we think is really important when we are investing in private markets is that you take a 5 to 6 year approach to actually get invested. And so you want to take a vintaging where you're starting to build a portfolio over a full market and economic cycle. And that goes for your overall level of exposure, as well as the sub-asset classes within alternatives. And roughly when you get to 5 to 6 years, you start to get capital back, and then it starts self-funding itself. And so, I do think that one thing that's really important is just thinking about it from that landscape versus putting all of your money to work at once.
Right.
That being said, even for the ultra high net worth client, there are points that are attractive, whether it's an ETF, whether it's an open-ended fund or a semi-liquid fund. And I'll give you an example. When you had private credit dislocate a couple years ago, if clients want exposure, they don't want to have some don't want that entire J curve in terms of waiting for capital to be put to work. And so that's a very attractive way to be able to gain exposure on a real-time basis.
Yeah.
And so we do see, as well as for some of the other accounts beyond the matriarch or patriarch.
Well, and some of this innovation that Mina's referring to has really only been around for 5, 6 years, and it does allow individuals to allocate on their time horizon. So as we refer to them as semi-liquid offerings, one of the benefits, they're open-ended, so the client's own liquidity needs or opportunities drive their time horizon. And that's a really effective way to build a portfolio.
Somehow we only have 5 minutes left, and a topic that we spent a lot of time on the prep call talking about, and I know that we all want to get to, is this idea that there's going to be a wealth transfer, both when it comes to women, which is something we've talked about, but also when it comes to generations, this generational wealth transfer. And in these wealth management roles that you have, I wonder how much of your job is getting to know an entire family, not just one client, one decision maker, but really getting to know all the different generations?
So we have 1,000 advisors, and we work with 17,000 families. So you do the math, it's 17 clients or families per advisor.
I'm glad you did the math for me.
You get to know the family really well, and it's one of the things that we really charge our advisors with. And family members have different objectives, they have different risk tolerances, they have different lifespans, and so it's important to customize for actually each family member. To your question about the wealth transfer that's going on with women, it is a really interesting demographic shift, and effectively what's happening is that women tend to marry 2 years older. They tend to outlive men by 5 years. And so the first passing of money tends to go with the baby boomers from the patriarch to the matriarch. The second thing is that women are making more money. And the third thing is more are managing the money for their household. And so you're seeing women much more in the driver's seat now versus maybe what we would have seen 5, 10 years ago. And, we're adapting to that.
Yeah, and it's interesting. And Raj, I promise I'm going to get to you. But you think about Sally Krawcheck actually had a really thoughtful column a few months back. Of course, Sally Krawcheck of Ellevest. And Without playing into stereotypes, she mentioned, one of the points she made was that women interact with their financial advisors in a different way. It's a different type of relationship, and that's something that I think about a lot.
Yeah, I would say that there's a few things that I would say as it relates to women as clients. One is that I think they actually tend to start the conversation with financial planning and then actually get towards the investment portfolio. So think about, what am I trying to accomplish? What do I want to provide for my kids, for my company, for my, for the community? What do those returns look like? How do I do that efficiently? And then actually plug in the investment side versus going with a perspective of, I'm looking for 8 to 10% returns. How do I do that?
Right.
And then I would say very focused on financial education, both for them and their family. And then the last thing I would say is that I think there's a misnomer out there that women are more risk averse than men. We don't find that, actually. We find that they're risk aware and they really want to do scenario analysis to be able to understand various scenarios in terms of how a portfolio would perform under different environments. But that is not something that we see. There's still a tremendous amount of interest in alternatives, in equities, et cetera.
Look, I think I have 3 children. I don't have the same math you do on touch points with women advisors, but I do think the next generation is much more interested in pre-IPO opportunities, whereas our generation thought about the IPO as where you get an entry point. And so, and I think they're also a bit weary of volatility, and so I think this massive wealth transfer is going to further broaden the private markets, and I think the next generation is going to be all about those opportunities.
I mean, and it brings us back to what we were talking about 15 minutes ago, that all of the excitement, a lot of the growth, it feels like, is in private companies. That's, I think about SpaceX, Stripe, et cetera. We have 10 seconds left, so I'm going to make the choice to end it here. Before we do go, I do have a script to read you on the topic of wealth management. Wanted to give you the chance to scan this QR code. I think it's right up there. That will allow you to unlock an exclusive preview of our latest Bloomberg Media Financial Advisor study. It delves into new insights regarding the mindset of financial advisors, current industry trends, and effective strategies for creating meaningful connections with them. So you can go ahead and scan that. I see a few people are. Meena, Raj, I so enjoyed this conversation. Thank you for joining us.
Thank you. Great to be with you.
Thank you, guys. All right.
Intelligence tool is going viral.
It's called ChatGPT. When ChatGPT came out, it really quickly gained traction. You might ask it, write a poem about unicorns, and it might spit out something that sounds just like it was written by someone. That really struck a chord with a lot of people. It also struck a chord with investors.
Tech companies and their investors have sunk billions of dollars into building AI systems with the bet that these tools will keep getting more sophisticated and one day prove wildly profitable.
There's this concept in AI that if you just sort of keep feeding an AI model more and more data, more and more compute power, that it will start to just sort of teach itself and become smarter and smarter. But progress seems to be getting a little bit trickier for some of these big companies.
As expenses skyrocket, an industry known for moving fast and breaking stuff could be slowing down.
I think the progress is going to get harder. When I look at 25, the low-hanging fruit is gone.
They're trying to figure out, how do we make these models that are getting increasingly expensive, eating up increasing amounts of computing power, worth that trade-off, right? If you're not getting this incredible boost in performance, what do you do?
Please welcome to the stage Kathy Wood, founder, CEO, and Chief Investment Officer at ARK Investment Management, for a live recording of Odd Lots with Bloomberg's Tracy Alloway and Joe Weisenthal.
We're just going to get the mics placed real quickly. How are we looking? We're good? Okay. Great.
All right, well, hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Just before we begin, a reminder, this is in fact a live recording of a podcast, so please make sure your phones are switched off. Please try not to make too much noise. You can laugh, you can, well, you can,
Boo.
no,
boo.
don't do that.
No, don't boo.
Don't do that. But please try to keep noise to a minimum. And so without further ado, we are going to start with our guest, Cathie Wood, founder and CEO of ARK Invest. Thank you so much for being here.
My pleasure, Tracy, and Joe, really happy to be here with you and with you.
So the big story in markets right now is a widespread sell-off in the past couple of days. But even before then, we saw something specifically focused on AI. And the worries seemed to come out of nowhere. Suddenly, everyone was talking about DeepSeek, this Chinese AI model, and we saw a really intense sell-off. Were you aware of DeepSeek before that day? And how big a problem do you think something like that is for US AI?
Actually, we were aware of DeepSeek R1. I think the paper came out in December. And so our analysts had pored over it and thought it was a very interesting model. I think the surprise and the question was around, wait a minute, did this take only $6 million to build this large language model? And did they really do it on a high-end workstation? Are we going to need all this data center capacity after all? And I think with time we've learned that they did a lot of pre-training before. Apparently, they have a 50,000 cluster of GPUs, which help with the pre-training. Nonetheless, as some of our finest technology experts, Sam Altman and Jensen Huang included, they commented they were terribly impressed by the algorithm itself. And I think what we were impressed by is it's open source. Anyone can use it. So here we go. Meta Platforms was really the open source platform, large language model. Now we have DeepSeek, and I think yesterday another one came out, Kung Fu.
Oh, I totally missed that one. I love trying the new ones. I'll try it tomorrow. Right now, we're recording this March 4th. When the market sold off, there was this concern like, oh, will the greater efficiency mean at the margins less demand for chips or less impulse to build out data centers? And there's no hard evidence of that, but there's the big tech companies, enormous CapEx budgets every single year, and they're throwing out these unbelievable numbers. There are hints here and there. Have you observed anything tangible, say over the last several weeks, that to you suggests that there is some change at the margin, DeepSeek aside, in how much businesses, hyperscalers, et cetera, are throwing at AI right now?
I have not seen any change in momentum.
There's no evidence of a slowdown.
The power of these models is profound. And if anything, we just had a conversation with one of the largest LLM. We're under an NDA, so I can't talk about which one, providers. And it's clear that nations, educational systems, and enterprises are all saying, we have got to do this. This is transformational in so many ways. Many are talking and thinking about productivity and efficiency. But others are thinking about deep research, especially with the new reasoning models, and deep research is one of them, and are just blown away by the results that we're getting. So I'm not seeing any slowdown at all.
So you mentioned the fact that DeepSeek is open source, and that was a big differentiator between it and some other models. I know you're a big fan of open source. How do you incorporate that aspect into, I guess, an investment analysis? And also, did OpenAI make a mistake by not going open source?
Well, we've been tracking closed models and open source for ever since the ChatGPT moment. And what you'll see is the closed models have been ahead of the open source models. But if you look at the slope of the line of the performance improvement, open source is actually a steeper slope. So the reason I love open source is it is helping along the competition, helping the movement along, helping it go faster. And I think that open source nipping at the heel of closed is a very good thing.
So, ChatGPT came onto everybody's radar, I guess, late 2022. And I think objectively, anyone who spends any time with these tools, in a sense, is just absolutely jaw-dropping, right? Are you surprised, however, that we're like this far into it and the tools are so, in some sense, extraordinary, but we could talk about some of the flaws and limitations, and yet we really haven't seen much of a macro impact from their use. We haven't seen some sector of the economy or the labor force get laid off. We haven't seen some major surge in measured productivity gains, although that's infamously hard to measure. Are you surprised in any sense by the existence of the technology and what seems like sort of a modest macro impact?
So I do think productivity has been boosted to some extent. And you're right, it's very difficult to measure this. My background's economics, and in the 80s, productivity was a big question mark, and we saw how flawed the measurements are, and probably still are. So I can only tell you the rate of uptake is so much, is that enterprises are seeing a difference. Maybe if they're not laying people off, they're not hiring them. And we know that, and that's because these AI tools are making their own, especially engineers, so much more productive, right? So you just don't have to hire that next person. If you've seen the number of coding employees in the United States has dropped like a cliff. I mean, off a cliff. Actually, it hasn't dropped like a cliff, it's dropped off a cliff. And I don't know if you've seen that chart, so that very much has happened as engineers just become more and more productive. One of the things that we're wondering is, okay, what part of the software stack will the traditional software stack, will this impact? And we think the AI revolution is what we see already losing share to some extent. It is still growing, but losing share is software as a service. And, I think we're all paying very close attention to the revenue growth dynamics of these companies. A Salesforce.com, revenue growth isn't picking up. In fact, it continues to decelerate. I think it's next quarter will be, 7% down from 9%. That's not what's supposed to happen here. And so I think that might be what you're referring to. Wait a minute, where are the top line dynamics? Where are they coming from? Well, I think we have a lot of entrepreneurs in a lot of garages or in R&D centers who are creating the next big thing. And, we look at two profound ramifications of AI that we understand. We've been researching them for so long. The largest AI project on Earth is robotaxis, autonomous driving networks. We think that's going to drive $8 to $10 trillion in revenue globally in the next 5 to 10 years, up from zero now. So that's called embodied AI. The most profound application of AI, we believe, is going to be in healthcare and the convergence of sequencing technologies, artificial intelligence, and new technologies like CRISPR gene editing are already curing diseases. Sickle cell disease and beta thalassemia cured. CRISPR Therapeutics has that cure. It is generating revenue now. People find this one very hard to believe because it hasn't happened before. But the R&D explosion in healthcare is like nothing I've ever seen. And we think we're going to return to the golden age for healthcare. I started in the 80s when Genentech had taken off and created the golden age for healthcare back then. Returns to R&D back then were in the 30% range. Today, for the broad-based pharma biotech field, the returns are down in the 4% range. We think with all of these new tools and the incredible productivity being added to research and discovery in the healthcare space, we're going back to the golden age where returns on R&D could be 30-40% plus.
Shameless plug for the podcast here, but we have a really good episode coming out on biotech that walks through a bunch of the AI implications as well. But since you mentioned robo-taxis, we got to talk about Tesla.
Of course.
Obviously a big component of your portfolio. Elon Musk seems very busy nowadays, to put it mildly. As an investor, do you worry at all that he is perhaps distracted from ostensibly the day-to-day running of the company?
We've been getting this question practically since the beginning. So Tesla, and then he starts all these other companies, right? And people are saying, does that not concern you? So I'll answer that first, then we'll bring in the government overlay. The reason it doesn't concern us is Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies, really catalyzed by AI. And he understands that the name of the game in terms of who's going to win all this, through all of this, are those companies that, number one, have deep domain expertise. They take AI seriously and they're investing in it. And perhaps most important, they have data that no one else has, proprietary data. Think of all the data spewing out from all of these companies. Even Neuralink, that's biological data. And the most prolific data explosion out there is in the healthcare space. We have 37 trillion cells in our body. And they turn over every quarter. And now we have something called single cell sequencing that we can combine with AI to unlock the secrets of life, health, and death. And that's what we're going to do. He understands that. Neuralink's a part of this. Okay, overlay in the government sector. I agree, he's doing something certainly for his country. I know he believes that.
He's tweeting a lot, that's for sure.
He's what?
He's tweeting a lot.
He always has tweeted a lot, right? He always has tweeted a lot. Anyway, so he's, I think what we have found with his companies, and we own in our venture fund, the private ones, as well, of course, as Tesla, and as we go through the quarterly reports and dialogue with management, critical to us is that he is keeping his eye on the technology balls that are his competitive or barrier to entry. And what Elon is expert at doing is if there's a bottleneck, he'll go in there and blow it up. And he will use first principles thinking. And he's surrounded himself by business people and engineers who want to work on the hardest projects in the world, the hardest projects that are going to help transform the way we live and work and so forth. Doge is another big project. It's not his full-time job, even though one would not know that. But we have talked to our counterparts, and we aren't talking to Elon as much these days, but to other very important decision makers, and they're really not skipping a beat. Now, the politics of what's going on have hit sales. And so, yes, that is true. That is why, and we knew that was going to happen. So there are a couple of calls this year, actually probably 3. We knew Model Y was going to be completely refreshed, largest selling car in the world. That is beginning to happen throughout the world. And if the Model 3's refresh is any indication, this should work out very well. Perhaps more important is the lower cost car that they are going to put out in the first half of this year. So $30,000 or less. and think less, especially with different credits. This is going to open up Tesla to a whole new market. A lot, as Elon says, and people don't believe him in this political dynamic, but its problem isn't demand. There are people who have been waiting for a car, they just can't afford it. And they're very excited to have their first Tesla. So that's the second thing. The third thing, and we've watched this very closely, as you all know, autonomous. We do believe, well, they're launching in Austin in June, another important milestone. Now analysts have to integrate into their models what autonomous will mean for Tesla. And so anyone who's been viewing Tesla as an EV manufacturer is going to have to go back to the drawing board and realize that the gross margins of its autonomous network, its autonomous platform, will be in the 70 to 90% range, whereas their EV gross margins are in the mid-teens right now. That's a double take. This is turning into a software as a service model. And that finally, I think, will bring technology investors and analysts into the stock. They understand SaaS and how different the model is compared to an EV model. And the other thing about the AI opportunity in autonomous is it's winner take most. And we do believe that Tesla will be is in the pole position here in the United States. Anyone who's tried a Waymo car, as I have in both San Francisco,
big Waymo fans.
Big Waymo fans.
Big fans. If you look in Big Ideas 2025, which is our annual report, you will see why, and kudos to Waymo. I agree, it's a delightful ride. But in terms of the economics for Waymo, their car is uneconomic, totally uneconomic. It's going to be very difficult for them to scale without deciding to lose a lot of money.
Right.
And you'll find that delineated in Big Ideas 2025.
Since you mentioned the stock and the idea of like tech investors coming back, let's talk about tech stocks, because obviously they've gotten really hit hard over the last week. But overall, you know, there was that furious post-election rally, sometime, you know, with various peaks in things December. There's been this decline. What's going on? Is there a macro story behind the tech sell-off? When you look at how the market's behaved, what's your answer?
Well, I think, I mean, fear and greed is a constant trade-off, and I think after the election, the day after the election, the market started broadening out enormously away from just the Mag 6 towards our kind of stock. And the reasons for that include deregulation. Deregulation or regulation has been a menace for innovation generally, but even the FTC not allowing M&A and not allowing strategic price discovery to say, hey, this new innovation is going to be worth a lot and we need it.
Now the FTC is keeping the same merger guidelines.
Pardon?
The FTC is maintaining the merger guidelines. So we haven't seen this big M&A whip. Anyway,
I think we will see it. I think deregulation is critical to this administration's mandate. It feels it's one of the most important variables, because if you think about what was going on before, no M&A. Even if companies didn't compete directly with one another, they disallowed so much M&A that, you know, the big companies kind of could sit back, fat, dumb, and happy, and their shareholders didn't want them to buy anything because that would take away from their own whether it's share repurchases or profit sharing and so forth. So. I think that this administration is going to provide a really beautiful runway from a regulatory point of view for innovation. And I feel that what is also behind this, as you might imagine, China with DeepSeek, as we were talking about, okay, they're on our tail, right? Well, the Trump administration is extremely competitive and has China in focus, shall we say? So this is a good news thing. So let's do this. The other reason I think the market took off, or there are many reasons, but I think tax rates coming down broadly, which I think they will, as an offset to some of the tariffs. And I understand tariffs. I don't like tariffs. Tariffs are taxes. But if you listen to Kevin Hassert, it seems there's a quid pro quo developing here where, wait a minute, in the early days of our country, all of government was funded by tariffs, all of it. And now very little of it. I think they might be into a little bit of a rebalancing game. And what the clue there is, in terms of tax rate reductions, what are the first ones they've announced? Tips, Social Security, and overtime. Those are very appealing to the lower to middle income demographic, right? I think lowering all tax rates is going to be much more acceptable with that kind of dynamic at work as well. He's looking out for the little guy like he said he would, right? And so I think as a student of Art Laffer, lowering tax rates, deregulation is, we think, it's going to recreate something like the Reagan Revolution, but I think it's going to be bigger. It's going to be bigger because there are 5 innovation platforms now, 14 different technologies, whereas back then it was the PC. It was the PC. Now we have 5: robotics, energy storage, AI, blockchain technology, multi-omic sequencing. 5 at the same time. They involve 15 different technologies, and they're converging. Autonomous taxi networks, convergence of robotics, energy storage, and AI. Those are each one of those has its own S-curve, and now they're going to be feeding one another. I mean, I think the Reagan Revolution, and I was there, and it was so enjoyable. It was the heyday, golden age of active equity management, and I think that's coming back. I think it's coming back big time. I think this will dwarf that, and that was pretty good.
I want to ask a sort of general question about your investing strategy. And I know you emphasize that you're making long-term bets on transformational technology like AI, which we've been discussing, or robo-taxis. I guess my question is, at some point, the promise of that world has to come to fruition and actually be monetized. Do you ever set yourself deadlines for positive returns, or is there a time frame you have in your mind for when this will pay off?
So our investment time horizon is 5 years. What's very important about the way we do our research, the most important variable in terms of determining how quickly these technologies are going to scale is units. Now, and something called Wright's Law. I don't know if you want me to go into it. It's a relative of Moore's Law. It's a way to understand how quickly the costs associated with each technology are falling. So we have had a good sense of all of these technologies' cost decline dynamics. What was one of the biggest things that happened over the last 5 years? Unit growth plunged during COVID. And then we faced all of these massive supply constraints. That hurt the rate of change for some of our technologies. We're on the other side of that. We are on the other side of that. In fact, we're on the other side of 3 major headwinds over the last 4 years that really hurt our strategy. First was the boom bust associated with COVID and all of the excesses around that. Second, interest rates, very importantly, a response. 24-fold increase in little more than a year's time. That was a major shock to the system. Now, do higher interest rates always hurt our strategy? Not at all. In fact, 2017 and 18, we had some of our best years, one in an up year, one in a down year for the market when we were up. Interest rates going up both years. I think we've just been through a very unusual circumstance. So we're done with the interest rate headwind. And we're done, if you think about it today, the long bond yield hit 4.12%. I don't know where it ended, but who expected that a few months ago? That's telegraphing something, and I'll get into that in just 1 minute. But interest rates, they're not going up. We do not believe they're going up. Second was the concentration in the market towards the Mag 6. And that really started after 08, 09, this desire for large cap, lots of cash, and yes, touches something sexy like AI, right? So that went into overdrive. We've never seen a more concentrated market in our history, not even the Great Depression, which was a binary, will this company survive or not back then. So to see the same kind of underlying fear and crowding into a few names tells me there's been a lot of fear out there. I think the first order impact of the election was, okay, some of that fear can dissipate. Now we have a whole new set of fears, but we can talk about that in a second. So we think that the market it has started and will continue to broaden out. This market, if it continued towards Mag 6, not a healthy market, just not. By definition, a broadening, two things happen after a major concentration, one of two things. Either a bear market, like tech and telecom bust, and early 70s, the end of the Nifty 50, or the other four major episodes of concentration, the other four major ones ended up in bull markets that broadened out. We think that has started. There will be to and fro's. Maybe the most important and surprising to many people of the headwinds, which we are no longer facing, is valuation. If you look at enterprise value to EBITDA, which is our chosen metric, so the entire cap structure divided by EBITDA, which is not subject to financial engineering, you'll see that our portfolio, and we worked with S&P, adjusting for SBC and R&D, and we can go into that if you want. Our portfolio basically hit a market multiple during the yen carry trade unwind. And after these last few weeks, we're getting close there again. Relative to the S&P, our portfolios really are at the low point in terms of that valuation metric throughout all of our history. So the valuation headwind is gone. I think what's shaking the market up right now is a recession. Now, we have been saying since the Fed jacked rates up so quickly that we've been in a rolling recession for the last 3 years. And the housing market certainly agrees with that. Autos, punk. Small businesses have been decimated. They couldn't get credit for a time there. Their net income is down 30% over the last three-ish years. So one sector after another gave way with small and medium business. Really, that's the backbone of employment, right? The last shoe to drop is consumer. Walmart just telegraphed, we're beginning to lose the consumer. And Walmart had been saying high-end had been a source of their incremental surprises to the upside. Target and Best Buy today. So I think we're at the last leg. It is the consumer. And why is this happening? I think the velocity of money is slowing down dramatically. And in fact, if you look at sequentially, it dropped in the fourth quarter. And it looks like it'll drop again. What does that mean? It means people are holding on to their money. Why? Well, I'm going to say, if you include federal, state, and local government and quasi-government in the healthcare and education space, we're probably looking at 30% of the people out there saying, I don't know if my job is safe.
Right.
And then you've got another layer of people out there in the higher income end of the spectrum saying, wait a minute, AI can do a lot of my job. What's going on here? And you see that with the coding fall off. So you've got uncertainty right now. But what is this going to do? It's going to give President Trump's administration and Chairman Powell all kinds of degrees of freedom if we do have negative GDP growth. We're already seeing long rates coming down. What's that telling us? Yep, real activity is coming down, but I think the shocker going forward, consider the source, I've been saying this for a while, is that inflation is going to surprise shockingly on the low side of expectations.
Kathy Wood, thank you so much for joining Odd Lots at Bloomberg Invest.
Thank you. Thank you very much for inviting me. Thank you. Thank you, Joe. Thank you. Thank you so much. Thank you, Tracy. Yes, thank you.
Thank you. Thank you, thank you, thank you. Thank you so much, Tracy, Joe, Kathy. Be sure to subscribe to Odd Lots on all of your platforms. I listen to it all the time as I'm on my way into work, and very happy every time I do. And that's it for this stage today. Thank you all so much for being such a great audience, and thank you to our speakers and our moderators so far. I'm grateful for all of you. Stay with me for just 2 minutes, a couple of announcements. I would like to thank our title sponsor, Invesco QQQ, as well as our presenting sponsor, MassMutual, and our supporting sponsor, TIAA. We'd love for you to stick around. We have networking and refreshment downstairs, so head out these doors, spend some time with us. I could use a glass of wine myself. Later this evening, if you are registered to attend, this one is a really fun one. Alex Rodriguez and Jason Kelly will be interviewing Ariel Investments' Melody Hobson in a live recording of their podcast, The Deal. There might be a few seats left to attend that, so if you're interested, talk to our staff if you'd like to join. And Invest isn't over yet. We have an amazing day of programming for you tomorrow. Excited to bring you all of that. Doors open at 8 a.m., starting at 8:45 a.m., the innovation stage, proudly sponsored by Invesco QQQ. We're going to kick off with some great conversations on all the private capital floating in AI, longevity and life in portfolios. A breakfast proudly sponsored by MassMutual starts at 8:45 in Hub 1, and our invite-only CFO roundtable begins at 8 a.m. And we start back on this stage again at 10 a.m. sharp with Carlyle co-founder and Bloomberg host David Rubenstein and former Treasury Secretary Stephen Mnuchin. We'll have timely conversations as well with the CEOs of TIAA, KKR, and Brookfield. Thank you all again. See you back here tomorrow.
Look how they shine for you.
a storm, you are my rescue. In at dawn, you are my gold sunrise. When I'm torn, you are my go-to. When I'm lost, you are my guiding light. In a war, you are my refuge. When I'm cold, you are my warmth at night. When I'm scared, you are my comfort. I would love to love you for life, so stay in my arms, girl, I'm keeping them open. Don't play with my heart, I don't wanna be broken. When the clouds roll in, the sky looks dark and gray, but you're my sunny day. La da da, la da 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 da, la da da, la da da di da, la da da, la da 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 da, la da da, la da da di da. You are a rainbow on a summer day. A dose of you would take the clouds away. Every little thing you do is like a firework inside my mind. Something magical in your design, girl, you ought to know. You're my sugar plum fairy girl, lovely little dream. You're a shooting star to the heart, perfect as can be. You're a pixie dust, sugar rush, magical and wild. You're the reason I believe in love, I'm smitten by your style. So stay in my arms, girl, I'm keeping them open. Don't play with my heart, I don't wanna be broken. When the clouds roll in, the sky looks dark and gray, but you're my sunny day. La da da, la da 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 da, la da da, la da da di da, la da da, la da 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 da, la da da, la da da di da. I'm so in love with you, I got my eyes on you every move. I see my home in you. Thank God took its time when he molded you. You give your love for free. Girl, you don't know just how much you mean to me. You're my everything, and everything is you. It's true, stay in my arms, girl, I'm keeping them open. Don't play with my heart, I don't wanna be broken. When the clouds roll in, the sky looks dark and gray, but you're my sunny day. La da da, la da 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 da, la da da, you're my sunny day. La da da, la da 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 da, la da da. I love you forever, girl, stay in my arms, cause I'm keeping them open. Don't play with my heart, I don't wanna be broken. When the clouds roll in, the sky looks dark and gray, but you're my sunny day. La da da, la da 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 da, la da da, you're my sunny day. La da da, la da 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 da, you're my sunny day.
To forget you is too hard. There's still so much left to recover. If only we could start again, pretending we don't know each other. I could not come back the same. This city's changed, it's not what it was back when you
Hey, check, check, 1, 2. Testing, 1, 2. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Hey. Yes, we are. Hey, hey. Oh, sorry about that. Check, check, 1, 2. Testing, 1, 2. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Hey, hey.
Check, check, 1, 2, 3.
Good afternoon, everyone.
10. Check, check, check.
Hey, hey.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
Hey, hey.
How do you like that mic? You like this mic? Check, 1, 2, 3, 4.
Good afternoon, everyone. Good afternoon.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
Hey,
Sound
hey.
okay? 1, 2, 3, 4, 5.
Check, check, 1, 2.
So this is just your radio mic. This is not the house.
This is a microphone test.
Okay.
Testing levels. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
1, 2, 3,
Yay, yay. Microphone test.
1, 2, 3, 4, 5.
Hey, hey.
6, 7, 8, 9, 10.
Check, check. 1, 2. Let's get it. 1, 2. Hey, hey. How we doing back there, Jerry? Good? Okay, I'll take that as a yes. Check, check. 1, 2. 1, 2. There's no issue, right? Sits a bit too low. Whoa. Ring a ring ring. Check, check. Hey, hey, hey. Whoa. Check, check, 1, 2. I wish I had something to read. Just gotta go off my intrusive thoughts. I want to say some crazy stuff, but I'm kind of holding myself back. I don't know. I kind of want to rap a little bit. I don't know. Tell a joke, but all my jokes are, I don't know. That's a good thing. Hey, hey. Yes. Yes.
Can you turn the show right now?
Welcome, Bloomberg. Check, check, 1, 2.
Check, check, 1, 2.
Hey, hey.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Hey, hey.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Hey, hey. Check, check, 1, 2. Ooh, those lights are pretty bright. Yeah, I definitely picked the right position. I hate being on stage with these lights this bright, so definitely wouldn't want to be the person in front of the camera. No, this will blind me crazy. No, I wouldn't want to do this. No way. I'm right here. Are you ready for me? Oh man, Jerry, are we good back there? Hey, hey, check, check. This is RF2. RF2. Hey, hey. Testing 1, 2. 1, 2. 2. Check, check, 2. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Hey, hey. Who's there?
Orange.
Orange who?
Orange, you glad I didn't say orange? I know no jokes.
Yeah, I'm not a dad, so I wouldn't know any dad jokes.
Yeah, I know bad jokes. There's two nuts walked into a bar.
Two
nuts walked into a bar.
Okay.
One was assaulted. Yeah.
Oh, wow. Okay.
Really bad.
Yeah.
How's it going over there?
As far as I could see, there was a star staring back at me. I won't forget what you said. I won't forget what you said. Why can't you show me your love, my love, your love, our love, yeah. Baby, sometimes we want, sometimes we need. You make me wanna stay, then you say you gotta leave. Who knows what you'll find, but in the meantime, I'm just here to show you my love, your love, my love, our love, yeah. Hang on where you're going to now. If it gets lonely, let me show you.